Hello CAinter students, now you can improve your performance in costing subject with our detailed marathon video. So this is recorded by Professor MP Raju sir, having more than 25 years of immense teaching expertise. This 12 hours extensive marathon is crafted for an extensive revision of all the topics to score 60 plus marks easily. After watching this marathon, you will feel that costing is not at all a tough subject. Here are the details of the chapter-wise coverage in this 12 hours of extensive marathon. So chapter-wise timestamps information is already provided in the description of this video. Generally, in marathon videos, you can notice that the content is either extracted from pre-recorded videos or recorded in recording theaters. To provide you with near classroom experience, this marathon is recorded in face-to-face classes. If you appreciate this video, then kindly hit the like button so that YouTube can recommend this to more number of students. If you gain useful insights from this video, feel free to share it with your friends so that they will also get benefited. After watching this video, leave your feedback in the comment section, which will surely help us to improve our services. Exclusive material which the faculty has shown while recording this marathon is available for free download, and here is the detailed procedure to download the same. In Android mobile or Android tab, install our app Masterminds Online Classes from Google Play Store. In the home screen, click the 3 horizontal lines icon in the top left corner and select free material option. In the document tab, you will find the required folder. Open it using either Acrobat Reader or some other PDF reader app, and you can download or share it, or you can even take a printout of the same. So stay tuned to our channel as we are about to upload the videos of remaining subjects of CAinter as well. Subscribe now and activate the notification bell icon to receive immediate alerts for our latest video uploads. Now you can start enjoying the marathon. All the best, my dear students.
Welcome to my costing marathon classes for CA intermediate portion. Now what you can expect from this marathon is summarized review of some important chapters like cost sheet, material cost, employee cost, overheads, absorption costing method, standard costing, marginal costing, process costing, activity based costing, cost accounting systems, and last one, budgetary control. These chapters can be covered conceptually with the questions. You can expect the score 60 marks from these chapters. You can understand concept and ensure the problems are solved. Questions about what we discuss in this class are available at the below link, especially for online students. Let us start. First chapter, cost sheet. Cost sheet. Before going to discuss the cost sheet, I ask you one question. Interest on long-term borrowings. What is the treatment in cost sheet? Okay. Yes. Ignore. Correct answer. Ignore correct answer. Next, technical assistant fee. What is the treatment in cost sheet? Don't worry, I will tell you the answer at the end of the chapter. I will tell you the answer at the end of the chapter. So, online students, whoever watching this video, I will give the answer at the end of the chapter. If you know, please will give the answer in the comment box. Okay. Next. Cost. Cost means it refers to the total expenditure incurred on the production and sale of articles or products. So basically, two things. One is production activity. Second one is marketing activity. Marketing activity. Marketing activity. Production activity performed by production department. Production department. Marketing activity performed by selling and distribution department. Okay. Production department. Next, marketing department. Marketing department. So, production department activity, product making activity. Here, marketing activity. Marketing activity. Back end department, that is office and admin department. Office and admin department. In making activity, what are the elements? One is raw material issued to production, wage cost incurred in the production, direct expenses incurred in the production. Next, overheads incurred during the time of production. So finally, direct material cost, direct wage cost, direct expenses. Next, raw material issued for factory repairs and maintenance, indirect material cost. Next, payments to indirect staff, nothing but indirect wage cost. Next, indirect expenses relating to factory, that is the factory indirect expenses. So here 6 transactions. One is direct material cost, direct wage cost, direct expenses cost. Next, factory indirect material cost, factory indirect wage cost, factory indirect expenses cost. So these three collectively known as factory overheads. These three collectively known as prime cost. So prime cost plus factory overheads equal to factory cost. Sometimes 100 units introduced into the production process. Out of that, 80 units fully completed, 20 units partly completed. So that 20 units cost is calling as cost of closing work in progress. Cost of that should be deducted. That should be, so prime cost, add factory overheads, we'll get gross factory cost, less cost of closing work in progress, we'll get net factory cost. We'll get net factory cost. Next, first department completed. First department completed, production department completed. Next department, office and administrative department. This department rendering services to production house and production department and also selling and distribution department. So here expenses incurred. Whatever it may be incurred, simply called as indirect cost. Simply called as, because admin department not involved in production activity. Admin department not involved in. So whatever it may be incurred in this house, simply called as indirect cost. Suppose material cost incurred in admin department, indirect material cost, because admin department not involved in production. There is no production activity in admin department. So here whatever it may be incurred, that is material cost, nothing but indirect material cost. Wage cost, nothing but indirect wage cost. Expenses, indirect expenses, collectively known as office and administrative overheads. Out of that, only two elements, except two elements, remaining all is calling as general administrative overheads. Remaining all, only two elements, that is salary paid to production control manager. Next, production planning office expenses. Only these two expenses are known as admin expenses related to production. Remaining all general administrative expenses. General administrative expenses. Sometimes in the examination, administrative expenses 1 lakh, but there is no specific information. Is it related to production or is it related to sales? In that case, take the assumption general administrative overheads. Clear? So here two parts. One is admin related to production. Admin related to production. Admin related to sales. Admin related to sales. Admin related to production charged to net factory cost. Then we get cost of production. Then we get here a small adjustment. For example, during the production process, scrap is arising. That scrap also having a market value. That realizable value should be deducted at this place. So net factory cost, add admin expenses related to production, less sale of scrap during the manufacturing process. Next, protective packing is necessary. So then add the protective packing cost. Protective packing cost, another name is primary packing cost. In case large companies definitely maintain research and development team and quality control, quality inspection team. So in that case, quality inspection cost and research and development cost also added to net factory cost. So final format, direct material cost to direct wage cost to direct expenses to prime cost to add factory overheads, we get to gross factory cost, less cost of closing work in progress, we get net factory cost. Net factory cost. Next, add admin overheads related to production. Next, quality inspection cost, research and development cost. Next, here less sale of scrap during the manufacturing process. Last one is primary packing cost. We get cost of production. We get cost of. Next, good ready. Then here adjust the inventory levels of finished goods. Opening should be added, closing should be deducted. We'll get cost of goods sold. We'll get cost of goods sold. COGS. Next, general administrative overheads. Next, selling and distribution overheads. So here marketing, this is the marketing expenses, nothing but selling and distribution expenses. Charge it to COGS. general admin expenses charged to COGS. These two expenses varies with sales volume. These two expenses varies with sales volume. Above elements varies with production volume. Above elements varies with the production volume. Okay. So, add general admin expenses, add selling and distribution expenses, add secondary packing charges, add secondary. Last one, very, very important. Interest and financing charges. Interest and, that is the interest on short-term loan or short-term finance, nothing but working capital finance. That is also included. That is the interest and financing cost. Interest and financing cost. Finally, we get cost of sale. Finally, we get cost of sale. Compare with the sale, we'll get profit as per cost records. Profit as per cost records. Suppose sometimes questioner is asking calculate profit as per financial books. Same information. Calculate profit as per financial books. How to calculate profit as per financial books? Take sales amount. Less returns, sales returns and rebates. We'll get net sales. We'll get. Then less cost of sale. Sir, cost books, cost of sale, financial books, cost of sale, both are same. One condition. Suppose there is no specific information about the materials. Material cost is same in both books. There is no specific information about the wage cost. Wage cost is same in both books. If there is no specific information, expenses also same. Next, overheads. Sometimes estimated overheads, actual overheads are both are same. In that case, cost of sale is same in both books. In both books. So take the cost of sale. We will get the operating profit. Operating profit. Next, less non-operating expenses. Less non-operating, nothing but non-cost related items. Less pure financial expenses. Add non-operating incomes. We'll get net profit as per financial books. Net profit as per. Sometimes questioner mentioned just same information but asking profit as per financial books. Profit as per financial books. So net sales, less cost of sale. If there is no specific information, cost of sale is same in both books. Then we get the operating profit. Adjust the non-operating activities. Less non-operating expenses. Less non-operating expenses means non-cost related items. Less pure financial expenses. Add non-operating incomes. Non-operating incomes. Non-operating incomes examples. Interest credited on bank fixed deposits. Next, dividend received on other company shares. Interest received on other company debentures. Another company debentures. So these are the non-operating incomes. Adjust the non-operating incomes. Finally, we'll get profit as per. So one thing is clear. Cost records profits didn't agree with the financial records profits. Main reason, pure financial expenses, non-cost related expenses and non-operating incomes are appearing only in financial books, not in cost books. Clear? Clear? Right. Now, pure financial expenses list. Any expenditure incurred in connection with the collection of debtors, bad debts, reserve for bad debts, reserve for bad debts, cash discount allowed to customers, cash discount allowed to pure financial expenses. First one is any expenditure incurred in connection with the collection of debtors, bad debts, reserve for bad debts, cash discount allowed to customers. Next, any expenditure incurred in connection with raising the capital. At the time of capital raising or fundraising, preliminary expenses, underwriting commission. Next, expenses on issue of shares or debentures, discount on issue of shares or debentures. So these are the examples. Next, any expenditure incurred in connection with serving the capital. So at the time of serving, expenses, interest on debentures, interest on loans. Interest on loans. These loans are long-term loans. These loans are interest on long-term loans. Next, dividend on shares. Dividend on shares. So these elements are appearing only in financial books, not in cost books. Non-cost related items. Non-cost related items. Expenses having no direct relation or indirect relation with production. Capital expenditure, capital losses, capital expenditure, one example, capital expenditure. Purchase of any fixed assets, capital losses, loss on sale of fixed assets, loss on sale of investments. Income tax, nothing but direct taxes. Direct taxes. Next, non-operating incomes. Non-operating incomes, best example, interest credited on bank fixed deposits, share transfer fees, dividend received from other company shares, interest received from other company debentures. So these items are appearing only in financial books, not in cost books. So first read the format perfectly. Direct material consumed. Here some adjustments. First, opening stock of raw material, purchase of raw material, add carriage on purchase. Add carriage on purchase. Suppose sometimes trade discount also mentioned. In that case, less trade discount. First, invoice value of raw material. Invoice value of raw material. Next, trade discount. Then we'll get net invoice value. Net, any taxes and duties levied on only net invoice value. Only on net. So first, calculate net invoice value. Invoice value of raw material price less trade discount will get net invoice value of raw material. Net invoice value of next taxes and duties levied by the government. Suppose in case ITC available, no need to charge. ITC not allowed, then immediately charge. Next, sale of scrap of raw material should be deducted. Sale of scrap of raw material should be deducted. Then finally, net cost incurred for raw material purchase. Then adjust the inventory levels of raw materials. We'll get the cost of raw material consumed. Next, direct wage cost. Direct expenses. Direct expenses, industry to industry, names varies. So, for example, for mining sector, royalty paid for production. Royalty paid for production. Hiring charges for using equipments like this. So, all these summation is nothing but prime cost. Add factory overheads. Factory indirect material, factory indirect wages, factory indirect expenses collectively known as deduct. Sorry, add factory overheads. We'll get gross factory cost. Gross. Next, adjust the inventory levels of work in progress. Net factory cost. Next, add admin related to production. Only two elements. Salary paid to production control manager. Next, production planning office expenses. Production planning office expense. Out of total admin, only two elements related to production activity. Add that. Next, quality inspection cost. Next, research and development cost. Less sale of scrap during the manufacturing process. Add primary packing cost. We'll get cost of production. Adjust the inventory levels. Adjust the inventory levels of finished goods. We'll get cost of goods sold. Add general admin. General admin means admin related to sales. Add selling and distribution, add secondary packing, add interest and financing charges, we'll get cost of sale. We'll get if there is no specific information about a particular element in financial books, same amount is the cost of sale. Okay, so cost of sale ready, then compare with sales. We'll get the profit as per cost. Profit as per. Sometimes questioner is asking profit as per financial books. In that case, gross sales less returns, sales returns, we'll get net sales. Cost, less cost of sale, less cost of. If there is no specific information, cost of sale is same in both books. Deduct operating income. We'll get operating income. Next, adjust the non-operating elements. Then we'll get the net profit as per financial books. So, this is the format of cost sheet, sir. The following figures are extracted from the trial balance of GK company on 31st March. So, here this is extracted balance sheet, sir. Extracted balance sheet. Sorry, extracted trial balance. Extracted. So, here some ledger account balances extracted, sir, from company books. Ledger account balances extracted from company books. So, here debit row and credit, sir. First, inventory, sir. Finished stock, that means finished goods inventory. Here also closing inventory is mentioned. So, that means these are the opening inventories. These are opening inventories. So, opening inventory of finished goods, closing inventory of finished goods, treatment adjusted to cost of production. These two adjusted to cost of production. Opening should be added, closing should be, we get cost of goods sold. Next. Sir, opening inventory of raw material, closing inventory of raw material. These two elements adjusted to raw material purchase. Opening should be added, closing should be deducted. We'll get the raw material consumed. Next, work in progress inventory levels, sir. Opening inventory of work in progress, closing inventory of work in progress. Adjusted to gross factory cost. We'll get net factory cost. Net factory cost simply called as factory cost. Next, sir, here office appliances. This is the office asset. This is the nothing but purchase of asset. Nothing but it is capital expenditure. It is appearing only financial asset side of the balance sheet. Asset side of the balance sheet. But depreciation is allowed in cost books as well as financial books. Depreciation is appearing in both books, but purchase cost is appearing only in financial books, not in cost books. Here depreciation rate, sir. Depreciation rate. Depreciation on office appliances 5%. So 5% of 17,400. 87. This is general administrative overheads. General administrative overheads. So depreciation on office appliances, general administrative overheads. In office and administrative department, material cost incurred, labor cost incurred, expenses incurred. These three indirect costs. Out of that, only two elements related to production. Remaining all elements, general admin expenses, general administrative expenses. Next, plant and machinery. This is also purchase cost of an asset. Purchase cost of an asset, nothing but capital expenditure. This element is appearing only in financial books, not in cost books. Correct? But depreciation allowed. Depreciation allowed. Sir, rate of depreciation on plant and machinery. 10%, sir? 10%. 46,000. Depreciation on plant and machinery is nothing but factory indirect expenses. Factory indirect expenses, nothing but it is a part of factory overheads. It is a part of. Next, buildings. This is also purchase asset cost. Asset cost to 2 lakhs. Then nothing but capital expenditure. This element is appearing only in financial books, asset side of the balance sheet. But depreciation allowed in both books. Rate of depreciation. Rate of depreciation 4%. 8,000. Now, student raise a doubt. Sir, building, office building or factory building or marketing building, selling and distribution department building. But here clearly mentioned in this building, 3 activities, sir. Factory, office, selling. So, proportion 8/10 factory, 1/10, 1/10 office, 1/10 selling. So, depreciation also a portion in this ratio. This is total depreciation 8,000, sir. 8,000. So, 8,000 into 8/10. 6,400. Next 1/10. Next 1/10. 800. This question is very, very important scenario based question. So, present to as per new syllabus, part 1, scenario based questions given and ask the MCQs. This is very, very important. Next, capital expenditure completed, sir. Next, sales. 7,68,000. Calculate cost of sale. Compare with sales. Next, sales return and rebates. So, nothing but it is deducted from sales. Net sales amount. 7,54,000. 7,54,000. Next, material purchased. Material purchase, nothing but it is a part of prime cost. It is a part of. So, here purchased material 3,20,000. Freight incurred on material 16. So, here purchase returns also mentioned 4,800. So, 3,20,000 minus 4,800 is equal to net purchase. 3,15,200. Add freight on purchase 16,000. 31,000. So, this is the net cost of raw material purchase. Net cost of, sometimes insurance charges incurred on material transit, that is also added to raw material purchase cost. That is also added to raw material purchase. Insurance incurred on raw material transit, this is also added to raw material purchase cost. Raw material purchase cost. Next, adjust the inventory levels of materials. Here, inventory levels of raw material opening and closing. Opening should be added, closing should be. Then we'll get the cost of direct material consumed. Cost of direct material consumed. Next, sir, here direct employee cost. This is also a part of prime cost. This is also a part of. Next, here one adjustment, sir. Outstanding expenses, direct employee cost 8,000. So this is paid amount. This is paid amount. Still payable out, that is the outstanding is 8,000. So this is paid amount. Paid amounts plus outstanding. Outstanding amount 8,000. This is called direct wage cost incurred. Direct wage cost incurred during this period. So direct wage cost incurred, find the direct wage cost incurred 1,68,000. It is a part of prime cost. So outstanding is given as adjustment. Simply it is added to corresponding expenses. Simply it is added to corresponding expenses. So 1,68,000. Next, the next one, indirect material cost or indirect employee cost. Sir, indirect employee, is it related to factory or is it related to admin or related to selling and distribution department? Is there any information? No information, sir. So, if there is no specific information, assumed related to factory. Assumed related to factory. Amount, sir, 18,000 rupees. Next, here outstanding, sir, 1,200. 1,200 outstanding. 19,000. 19,200. Okay. So, outstanding expenses is given as adjustment. Simple. It is added to corresponding expenses. Next one. Factory supervision. Factory supervision means factory supervisor's salary. Nothing but factory indirect expenses. Factory. Next. Repairs and factory upkeeping services. So this is also factory overheads. This is also factory overheads. Next, heat, light and power, sir. Sir, power and fuel is given single item, then it is treated as a part of direct cost. Any third element is added that is related to factory. Simple logic. Power and fuel is given as individual item, that is direct expenses. Suppose any third element is added, that is factory overheads. This is also factory overheads. Next, rates and taxes. Rates and taxes of building. This building related to 3 departments. So definitely rates and taxes also separate, sir. Rates and taxes, 2/3 factory and 1/3 office. 2/3 means, so 6,300 into 2/3, 4,200. Next, 1/3, 2,100. So this is general administrative expenses. This is factory overheads. Next one. Miscellaneous factory expenses. Nothing but factory overheads. Nothing but factory overheads. Sales commission. Nothing but selling and distribution overheads. Sales traveling expenses. Selling and distribution overheads. Sales promotion expenses. Selling and distribution overheads. Next, distribution department. This is also selling and distribution. Office salaries, general admin overheads. Sir, interest on borrowed funds. Is it long term or short term? There is no specific information. Assumed as long term. As per ICAI study material, if there is no specific information, it is a long term. So interest on borrowed funds assumed as long term, sir. So this is pure financial expense, ignored. 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 Sir, here interest on borrowed funds outstanding also ignored. Also ignored. Okay. So A completed, B completed, C completed, D heat, lighting, heat, light and power also apportioned, sir, in the ratio 8:1:1, sir. So here heat, light and power mentioned separately. So specifically given in the problem, 8 by 10 related to factory. Here amount, sir, heat, light and power amount 65,000 into 8 by 10. 52,000. 52,000. Next, general office 6,000. Selling and distribution 6,500. Right, completed. So rates and taxes completed. Depreciation also completed. So all elements one by one discussed, sir, right? Completed, sir. Now, what they are asking this question? With the help of the above information, you are required to prepare a condensed profit loss account. This is not full trial balance. This is not full trial balance. This is extracted trial balance. Extracted trial balance means only some ledger account balances are given in this trial balance. So that's why it is condensed profit loss account statement. Profit and loss account statement, nothing but profit as per financial books. Profit as per. So profit as per financial books format. Sales less returns and rebates. Net sales less cost of sale. Will get operating income less non-operating expenses less pure financial expenses. Add non-operating incomes and non-operating income. Then we'll get the profit as per financial. Sir, how to calculate cost of sales, sir? Simple. Here, there is no specific information. Cost of sale is same in both books. Cost of sale is same in both books. Material cost is same in both books. Labor cost is same in both books. Direct expenses cost is same in both books. Overheads, estimation, actuals both are same. Then cost of sale is same in both books. Cost of sale is same in both books. So, how to calculate cost of sale? Simply format, cost sheet format. Calculate the cost of sale. Next, selling and distribution expenses. So, here logically first prepare the administration expenses list. Next, prepare the selling and distribution expenses list. Next, prepare the cost of sale. Next, prepare the cost of sale. These are the supporting workings. Supporting workings. Supporting workings completed. Then statement of profit for the year ending 31st March. 31st March. Start income statement. Gross sales less sales, returns and rebates. We get net sales less cost of sale. Here cost of sale is same in both books. Operating income. Next, less non-operating expenses. Less pure financial expenses. Here one element is there. Interest on borrowings and outstanding. Am I right? Interest on borrowings 2,000. Outstanding 2,000. Total 4,000. Total 4,000. Next, add non-operating incomes. Here non-operating incomes nil. Finally, we'll get profit as per financial books. So here mentioned, sir, gross sales less returns and rebates, net sales, cost of sale refer to schedule 1. So net operating profit 39,980. Interest on borrowed funds 4,000. We'll get net profit as per financial books is 35,000. Clear? So this is the cost sheet. Okay. So next chapter. Material cost. Material cost. Sir, cost sheet technical know-how fees. Answer direct expenses. Direct expense. Technical assistance fees or technical know-how fees. Direct expenses. Okay. Right. Next one. Material cost, sir. There are some techniques to be used for material cost controlling. Money. What are they? EOQ, stock levels, stock levels, ratios, pricing issue methods, ABC answer. Sit down. First concept, EOQ concept. Next important concept, stock levels. Next important concept, ratios, inventory turnover ratio. Pricing issue methods, ABC analysis, last category. So primary section 3, EOQ, stock levels, inventory turnover ratio. Objective of EOQ. Objective of EOQ. To minimize the additional cost. EOQ objective to minimize the additional cost. There are some additional costs incurred along with the raw material purchase cost. What are they? Total ordering cost and total carrying cost. There are some additional costs incurred, sir, along with the raw material purchase cost. Here raw material purchase cost is same, but additional cost is very, very important. Throughout the year, raw material purchase cost is same. Additional cost is important. So the main objective of EOQ is to minimize the additional cost. To minimize the additional cost. EOQ can be calculated in 3 methods. Chakradhar, what are they? Number 1, trial and error method, formula based method, graphical method. Graphical method. Formula based method, square root of 2AO by C. 2AO by C. So here A stands for annual demand of raw material, not annual consumption, annual demand of raw material. O, ordering cost per order. C, carrying cost per unit per annum. Carrying cost per unit per annum. So here, trial and error method, sir. Select the trials. Select the trials. Where TOC and TCC summation is minimum. Where TOC and TCC summation is minimum. That order size is calling as economic order size. Clear, sir? Next, graphical method. Graphical method, draw the 2 lines. One is TOC line and TCC line. Relation between order size and TOC. Sir, last person. Inverse relation. Order size increases, ordering cost decreases. What is the relationship between order size and total carrying cost? Direct relation. These 2 lines, intersection point is very, very important. That intersection point very well. Draw the perpendicular line towards x-axis. That order size quantity is nothing but economic order size. Economic TOC line, TCC line, intersection point. Suppose on x-axis, order size. On y-axis, cost, ordering cost and carrying cost. Ordering cost or carrying cost. So here order size and ordering cost. This is TOC line. This is TOC line. Next, order size and carrying cost. That is TCC line, total carrying cost line. This is total carrying cost line. So order size increases, total carrying cost also increases. Order size increases, ordering cost decreases. So order size, ordering cost relation, inverse relation. Order size, carrying cost relation, direct relation. Draw these two lines. Then this is the intersect point. This is called EOQ. This is called EOQ. This is called EOQ. So first method, formula based method, square root of 2AO by C. A stands for annual demand of raw material. O stands for ordering cost per order. C stands for carrying cost per unit per annum. Easiest method. Next, trial and error method. Trial and error method. When it is suitable, sir? If the unit price varies with the order size. That means supplier sometimes offer a discount prices. In that case, trial and error method is suitable. In that case, formula method can't give the result. Definitely we can use trial and error method. Suppose order size changes, unit price also changes. In that case, definitely we can use trial and error method. Formula method can't be used. Formula method can't be used. So, trial and error method very, very important. So, according to trial and error method, how to decide the order size? How to decide the order size? Where the summation of TOC and TCC, where the summation of TOC, where the total ordering cost and total carrying cost is minimum, that order size is nothing but economic order size. Economic order size. So, this is the part of EOQ. This is the part of EOQ. Right. Right. CRD, once material cost, listen. IPL Limited, this is also scenario based questions, sir. Scenario based questions are very, very important for part 1. So, first part, first question, sir, in material cost, IPL Limited uses a small castings in one of its finished product. The castings are purchased from a foundry. So, supplier, foundry. Company purchased 54,000 castings. Purchased 54,000 castings. Nothing but demand. Nothing but demand. Annual requirement or annual demand. So, annual demand. Annual demand. Annual demand of raw material. Sriram denoted by A. Denoted by A. So, 54,000 castings. Next, here unit price of raw material per casting 800. Unit price of raw material 800 rupees. Rakesh, purchase cost. Raw material purchase cost. I think 432 lakhs. 54,000 into 800. Rakesh, sit down. So, raw material purchase cost 432 lakhs. Raw material purchase cost 432 lakhs. So, here unit price throughout the year same 800 rupees. Demand 54,000 castings. Annual demand or annual purchase of raw material, annual purchase quantity of raw material or annual demand of raw material Next, the castings are used evenly throughout the year. That means here daily usage is uniform. Here castings are used evenly throughout the year means daily usage is uniform. So 1 year equal to 360 days. 1 year equal to, so 360 days usage equal to 54,000 castings. Therefore, normal usage of raw material, normal usage of raw material per day, 54,000 divided by 360 days equal to 150 castings. 150 castings. 150 castings. First bench, third person. Maximum usage of raw material, sir, per day. Chakradhar, maximum usage of raw material per day. That is also 150. Reason? Here raw materials are used evenly. In that case, maximum usage per day, minimum usage per day, normal usage per day, in all cases answer is 150. 150. Name? Right. Right. Normal usage of raw material per day, 150 castings. Next, the company estimates that it costs 9,000 to place a single purchase order. Ordering cost. Ordering cost per order. Ordering cost per order. Denoted by 9,000 rupees. Dedipya, what are the elements involved in ordering cost? Material handling cost. That means loading and unloading charges. Next. Next. Documentation charges or billing work. Next. Freight charges. Freight charges. Documentation charges. Material handling charges. That is the loading and all these elements collectively known as ordering cost. Here ordering cost per order equal to 9,000 rupees. Sometimes freight charges, documentation charges, handling charges, names given directly. Simply add these three, you will get ordering cost. You will get ordering cost. Next, carrying cost per unit per annum, denoted by C. So here clearly mentioned about 300 rupees to carry one casting in inventory for a year. 300 rupees to carry one casting in inventory for a year. That is the holding cost. In carrying cost, what are the elements involved? Storage cost, interest cost, insurance cost, cost of obsolescence, cost of these four important. Only four elements. Raw material storage cost, insurance cost, cost of obsolescence, interest cost. That is the interest on capital invested in raw material purchase. Interest on capital invested in raw material purchase. These four collectively known as carrying cost. Sometimes two elements mentioned, sometimes three elements mentioned, sometimes four elements. So here in number of elements, sir. Here one is storage cost and high carrying cost result from the need to keep the castings is carefully controlled temperature and humidity conditions and the high cost of insurance. So clarity is given. Sir, hello. Here two elements, sir. One is insurance cost, second one is storage cost. Storage cost and insurance cost, two cost elements. So summation equal to 300 rupees. So carrying cost per unit per annum equal to 300 rupees. 300 rupees. So carrying cost per unit per annum equal to 300 rupees. 300 rupees. Now, next, here, what they are asking this question? Compute the economic order quantity. Economic order quantity. Sir, here method not mentioned, sir. Trial and error method or formula based method or graphical method. If there is no specific information, please follow the formula based method. Ganesh, formula. Square root of 2AO by C. EOQ equal to square root of 2AO by C. That is equal to 2 into A. 54,000. O. 9,000, madam. C. Answer. 1800 castings. At 1800 castings, what is the speciality? At which total ordering cost and total carrying cost is minimum. At which total ordering cost and total carrying cost is at 1800 castings. At 1800 castings, TOC per annum and TCC per annum is minimum. Other than 1800 casting size, definitely will rise. Additional cost is rise. Only at 1800 additional cost is minimum. Only at 1800 additional cost is minimum. So the main objective of EOQ, is to minimize the additional cost. For example, same question, a little bit change. Compute the economic order quantity by using trial and error method. Check the procedure. Now, here answer is 1800. I know. Okay. Take the trials. Suppose 100 multiples. 18th trial is 100, 200, 300, 400, 500, 600, 700, 1800. Definitely TOC per annum and TCC per annum summation is, but time taking. Suppose 200 multiples. 200, 400, 600, 800, 1000. Nothing but 9th trial is 1800. Time taking. Suppose you should take 600. Definitely, third trial is EOQ. Third trial is EOQ. Zero. So, logic, sir. EOQ calculation by using trial and error method. EOQ by using trial and error method. First, annual demand of raw material. Second one, order size. Number of orders. TOC per annum. TCC per annum. Total additional cost or total annual cost. Total additional cost or total annual cost means TOC per annum plus TCC per annum. So, annual demand, order size, number of orders, TOC per annum, TCC per annum, total annual cost or total additional cost. Total annual cost or total additional cost or variable cost of order size. Variable cost of, generally calling as total annual cost of order size or total additional cost of order size. Sometimes question is asking calculate the variable cost of order size. Next, associated costs of order size. These are alternative names. So, please focus on last column, where the total annual cost is minimum that order size, economic order size. The main objective is to minimize the additional cost. To minimize the additional cost. Same question. Calculate economic order quantity by using trial and error method. I know the answer, 1800 through formula based. Then take the trials. 100, 18th trial. Eliminate. 200, 9th trial. 600. Someone says, sir, 1800, sir. No. Definitely show the minimum 3 or 4. Now take the 54,000 castings. Order size 600. Number of orders, check the formula. A by order size. A by order size. 90 orders. Total ordering cost per annum formula. Asit. Number of orders into ordering cost per order. 90 orders into 9,000. 8 lakhs. 10,000. Yuktasai, total carrying cost formula. Half of the order size into C. Sit down. Half of the order size into C. 600 by 2 into 300. 90,000. So final 9 lakhs. Suppose if company follows 600 order size for buying of 54,000 castings, in that case additional cost incurred 9 lakhs. In that case additional cost incurred 9 lakhs. Next 54,000. Second trial 1200 size, sir. 45 orders. 4 lakhs 5,000. 1200 divided by 2 into 300. 1 lakh 80,000. 5 lakhs 85,000. Sir, if company follows 1200 order size for buying of 54,000 castings, in that case, total annual cost is 5 lakhs 85,000. But one thing is clear, in 600 at 600 order size, raw material purchase cost is same 432 lakhs, 54,000 into 800. At 1200 units order size, raw material cost is 432 lakhs. So raw material cost is same, but additional cost varies with order size. Additional cost varies with where the additional cost is minimum, that order size is nothing but economic order size. Is it clear? Next, 54,000 castings. 1800. 30 orders. 30 into 9,000. 2,70,000. 1800 divided by 2 into 300. 2,70,000. 5 lakhs 40,000. 5 lakhs 40. 5 lakhs 40,000. 5 lakhs 40,000. Sir, here one thing is clear. TOC per annum equal to TCC per annum. If TOC per annum is equal to TCC per annum, then clearly says that additional cost is minimum. That additional cost is, so this is minimum. Here condition satisfied. Where TOC per annum equal to TCC per annum, definitely you can say this is the minimum cost. This is the, suppose if the order size 1801, if you take 1801, definitely increase 1 paisa. Sure. Definitely. Suppose if you take 1801, definitely annual cost is rise by 1 or 2 paisa. 1 or 2 paisa. Suppose if you take 2000, sir, if you take 2000 order size for buying of 54,000 castings, 27 orders. 2 lakhs, 27 into 9,000, sir. Next, 2,000 by 2 into 300. 5 lakhs. 3,000. Jum. Hiram. 3,000. So here, if company follows 2,000 order size for buying of 54,000 castings, how much extra additional cost incurred? If company follows 1,200 units order size for buying of 54,000 castings, how much extra additional cost incurred? 45,000. So sometimes question is asking calculate EOQ by using, first calculate formula based secret, then you take the trials. Next model. Suppose here, okay, this is EOQ. This is EOQ. This is EOQ. Suppose if company follows EOQ, number of orders in a year, 30 orders, 30 times order should be placed. Am I right? But if company proposes, if company proposes to rationalize the placement of orders, if company proposes to rationalize the placement of orders to 6 orders, in that case, extra additional cost definitely incurred. Am I right? If company proposes to rationalize the placement of orders, if company proposes to rationalize the placement of orders to 6 orders, present at EOQ 30 orders, 6 orders. In that case, order size checker there 9,000. Yes, exactly. How? 54,000 annual requirement divided by 6 orders. Therefore, proposed order size equal to 9,000. Suppose if company not following EOQ, company follows 9,000 order size for buying of 54,000, definitely company incurs extra additional cost. Company incurs extra additional cost. Sure, extra additional cost. Now calculate the extra additional cost. Clear? If company proposes to rationalize the placement of orders, if company proposes to rationalize orders, if company proposes to rationalize the number of orders to 6 orders, in that case, definitely company incur extra additional cost. So suppose calculate extra additional cost. Wait. 54,000. If company proposes to rationalize the placement of orders to 6 orders, 54,000 divided by 6 orders, 9,000, 6 orders. 6 orders into 9,000. 6 orders into 9,000. Madam, total ordering cost per annum equal to number of orders into ordering cost per order. Here 6 orders into ordering cost per order 9,000. 6 into 9,000. 54,000. Next to 9,000 divided by 2 into 300. 13 lakhs. 50. 13 lakhs 50,000. 14 lakhs 4,000. How much extra additional cost incurred? 14 lakhs 4,000 minus 5 lakhs 40. 8 lakhs. Correct? Extra cost to 8 lakhs 64. Sit down. Extra cost. Total annual cost at proposed order size. Total annual cost at proposed order size minus total annual cost at TOQ. Total annual cost at proposed size 14 lakhs 4,000. Total annual cost at EOQ. Answer 8 lakh 64. Okay. Money, in this situation, what percentage of discount in the price of raw material should be negotiated with the supplier? What price of raw material? What price of 2% correct answer. What price of what percentage of discount? What percentage of discount? What percentage of discount in the purchase price of raw material? What percentage of discount in the purchase price of raw material should be negotiated with the supplier? So here present company proposal to rationalize the placement of orders to 6. Definitely extra cost incurred. That extra cost to be compensated by discount. That extra cost to be compensated by discount, sir. Clear, sir? That extra cost to be compensated by discount. What percentage of discount in the purchase price of raw material should be negotiated with the supplier? 2% is the right answer. How, sir? Simple logic, sir. Simple logic, sir. Reduction in the purchase price of raw material. Reduction in the purchase price of raw material. Reduction in the purchase price of raw material is equal to 8,64,000. Purchase quantity of raw material. Extra cost divided by purchase quantity of raw material. Extra cost 8,64,000. Purchase quantity 54. Purchase quantity, madam. Purchase quantity 54,000 units. Equal to 16 rupees. 16 rupees reduction in the purchase price. 16 rupees reduction in the present purchase price of raw material. Present purchase price of raw material 800 rupees. Unit price of raw material 800 rupees. Check there. Present purchase price of raw material 800. For suppose if company proposes to rationalize the placement of orders to 6 orders, definitely company incurs extra cost. In that case, what percentage of discount in the purchase of price of raw material should be negotiated with supplier? Hello, supplier, please allow 2% discount. 2% discount. How to calculate 2% discount, sir? Simple. 16 divided by 800 into 100 equal to 2%. Is it clear? This is another type of question. First EOQ formula based. Next EOQ trial and error. Next calculation of extra cost. Next percentage of discount. Percentage of discount. So what percentage of discount in the purchase price of raw material should be negotiated? Clear? This is third model. First formula based. Next trial and error. Next calculate extra cost at proposed order size. Here proposed order size is 9,000. Proposed order size is calculate extra cost at 9,000 units order size. How to calculate extra cost? Total annual cost at proposed order size minus total annual cost at EOQ. Total annual cost at EOQ. Clear? Next model. Suppose supplier offer a discount. Supplier offer a discount. Supplier offer a discount. Supplier offer a discount at 2%. Supplier offer a discount at 2% on purchase price of raw material. Supplier offer a discount at the rate of 2% on purchase price of raw material. Purchase price of now procedure. Rakesh, procedure. Calculate at given proposal total annual cost. Calculate total annual cost at given proposal. Next, compare with EOQ total annual cost. Is it acceptable or not? I will give. Sir, listen. Present order size. Present order size 1800 castings. Correct? Huh? Here unit price of raw material, sir. Unit price of raw material. 800. Proposal, sir. Proposed order size. Proposed order size. Proposed order size, Rakesh. 9,000 castings. 9,000 castings. Here unit price of raw material 800 into 98%. 784. This is the script. Previous model, company asking to supplier. Hello, supplier. Now supplier asking to company. Reverse. Here offer is, supplier offer is 2%. Supplier offered a quantity discount offer is 2% discount on purchase price of raw material. Is it worthful or not? Is it acceptable or not? Is it acceptable or not? In that case, follow this format. Particulars. Present order size 1800 castings. Unit price of raw material 800. Proposed order size 9,000 castings. Unit price of raw material 784. 784. How to take the decision? Check that. Here decision making based on 3 element summation. Decision making is based on not 2 element summation.
Sir, previously decision making is based on 2 elements, sir.
Yes. Here, no discount offers. At each order size, unit price is 800 rupees. At 600 units order size, unit price 800. 1200 units order size, unit price 800. At 1800 units order size, unit price 800. So, at all order size, unit price is same. But here, unit price dancing. Unit price is dancing. Unit price varies with order size. In that case, decision making is based on 3 element summation. Decision making is based on 3 element summation. What are they? Name? Aishwarya. First TOC per annum, TCC per annum, raw material purchase cost per annum. Raw material purchase cost per annum. So now calculate TOC per annum. TOC per annum. Formula TOC per annum equal to TOC per annum formula. Number of orders into ordering cost per order. Number of orders into ordering cost per order. So here number of orders, sir. So here number of orders, so A by order size. Here A equal to 54,000. 54,000 divided by 1800. 30 orders. Into 9,000. 2,70,000 rupees. 2 lakhs. Here total ordering cost. Here total ordering cost. Number of orders. 6 orders. Order size is 9,000. 54,000 divided by 9,000. 6 orders. 6 orders into 9,000. 54,000. Clear? So TOC per annum completed. Next TCC per annum. TCC per annum. Rakesh, formula. Half of the order size into carrying cost per unit per annum. Here half of the order size, sir. 1800 by 2. 900 into 300. 2,70,000. Next, 9,000 divided by 2. 9,000 divided by 2 into 300. 13 lakhs. 50. Last and final raw material purchase cost. Reason here, unit price varies with the order size. In that case, decision making is based on 3 elements summation, sir. Unit price varies with the order size. Decision making is based on 3 elements summation. So, third element, sir. Raw material purchase cost. Raw material purchase cost. So, raw material purchase cost equal to A into unit price of raw material. A into unit price of A. 54,000 into 800 for 432 lakhs. 54,000 into 784. 423 lakhs, 423 lakhs, 36,000. 423 lakhs, 36,000. Add them. 437 lakhs, 40,000. 40,000. Sir, there is no extra cost. There is no. Accept the quantity discount offer. Accept the. Suppose extra cost arises, quantity discount offer should be rejected. Extra cost arises, quantity discount offer should be. Here there is no extra cost. Here there is no extra cost. Therefore, quantity discount offer should be accepted. Quantity discount offer should be accepted. Sometimes there is a cost saving. Excellent. Immediately accept the offer. Immediately accept. So main rule is, if there is no extra cost, accept the quantity discount offer. Quantity discount offer. So finally 4 models completed. Single problem, 4 models completed. EOQ by using formula method. EOQ, trial and error method. Next, calculate extra additional cost at a given proposal. Next, what percentage of discount in the purchase price of raw material should be negotiated with the supplier? What percentage of discount in the purchase price of raw material should be negotiated with the supplier? Next model, supplier offer a discount 2% on raw material purchase price. Is it acceptable or not? These are very, very important. Clear? Next. Okay. Next. Sir. So, first 2 paragraphs completed, sir. First 2 paragraphs completed. Next paragraph. Delivery from the supplier. Delivery from the supplier generally takes 6 days, but it can take as much as 10 days. Sir, how to express this sentence? Simply based on past experience. Simply based on As per company past experience, delivery from supplier generally takes 6 days, but it can take as much as 10 days. For example, take samples from the company past experience, sample data. So here, for example, if you take 100 samples, so in the first sample, delivery time 6 days. Second time, delivery time 6 days. Third time, delivery time 7 days. Fourth time, delivery time 8 days. Next 6. Next 6. Next 9. 6. Okay, like that 100 samples collected. 100 samples. So one more. 6, 10. So now 1, 2, 3, 4. 4, 5, 20 samples. Now 80 samples. Total 100 samples. Observing the 100 samples. 6 repeated 75 times. 6 repeated. 7 repeated 15 times. 7 repeated 15 times. 8 repeated 10 times. 9 repeated 5 times. 10 repeated 5 times. Total summation. 6 repeated 75 times. 7 repeated 15 times. 8 repeated 10 times. Next 9 repeated 5 times. Okay. This is 5. Next 10 repeated 5 times. Wait. 10. 75, 10, 5, 5, 5. Total 100 samples. Total 100 samples. Sir, if you take 100 samples, out of that 75, 6 repeated 75 times, 7 repeated 10 times, 8 repeated, 9 repeated, 10 repeated, summation 100 times. 100 times. So, as per this information, how to tell? Here delivery from supplier generally takes 6 days, but it can take as much as 10 days. That means 6th day may not come, 7th day may not come, 8th day may not come, 9th day may not come, but 10th day compulsory delivery. Definitely come. So this is as per this information. Now prepare the probability distribution table. Delivery time, listen. Delivery time in days. Delivery time in days. 6 days, 7 days, 8 days, 9 days, 10 days. Delivery time in days, 6 days, 7 days, 8 days, 9 days, 10 days. Next, percentage of occurrence. 75%, 10%, 5%, 5%. Now, probability. So, P of X. Sir, raw material delivery within 6 days, probability, sir. Raw material delivery within 7 days. Within 7 days means P of 6 plus P of 7. Raw material delivery, probability of raw material delivery within 8 days. Within 9 days. Within 10 days. Correct, sir? Now risk. 25% here. Risk means that is the chance of non-occurrence. Geetanjali, next risk. Geetanjali. Third person. Last bench, third person. Lavanya. Next risk. Non-occurrence, 15%. Here non-occurrence. Non-occurrence. Here non-occurrence. Serum. So in this case, definitely maintain the safety stock. In this case, definitely maintain. Because here risk arises. In that case, how to overtake that risk? Maintain the safety stock. So here there is a chance of raw material stock out. There is a chance of material stock out problem. How to overcome the stock out problem? By maintaining the safety stock. By maintaining the safety stock. In previous example, there is no safety stock. But now coming to safety stock model. So there is a chance, stock out risk. Stock out risk. Suppose 6th day may not come, definitely production interruption arises. Production interruption arises. Production interruption arises due to material stock out. Production interruption arises due to material stock out. How to overcome that problem? Simple. To maintain the safety stock. To maintain the safety stock. This is the traditional way. This is the, here also two methods are there. With the safety stock, without safety stock. With the safety stock, without safety stock. First, traditional method. Traditional way. So to maintain the safety stock, easily overcome the stock out risk. Easily overcome the stock out risk. So generally production interruption arises due to stock out problem, material stock out. Due to material. How to overcome that? To maintain the safety stock. To maintain the safety stock. So here safety stock calculation completely depends on risk. Safety stock calculation completely depends on here safety stock. Listen. Safety stock. Sir, at 0% risk, safety stock units. Here daily usage is equal to 150 castings. Am I right? Normal usage 150, minimum usage 150, maximum usage. Here normal usage 150 or minimum usage 150 or maximum usage 150. Raw metals are used evenly throughout the year. Raw metals are used evenly. So usage 150. Suppose if company maintains 0% risk. At 0% risk level, delivery time should not exceed 10 days. Delivery time should not exceed. In this case, definitely company maintains 6th day consumption, 7th day consumption, 8th day consumption, 9th day consumption. So definitely for 150s, 600 units safety stock. 600 units safety stock. Correct? Huh? At 0% risk level, delivery time is 10 days. Delivery time is 10 days. 10th day, delivery time is 10 days. At what risk level? At that level, risk level is 0%. At the 0% risk level, delivery time is 10 days. So in this case, normal lead time equal to 6 days. Delivery from supplier general time is 6 days. 75 as per company past experience, 6 repeated 75 times. That is mode Z. More number of times it will be 6. So 10 minus 6 equal to 4 days. So 4 days safety stock maintained. Next, suppose if company maintains suppose at 5% risk level. So sometimes questioner is asking calculate safety stock at 5% risk level. Calculate safety stock at 5% risk level, delivery time should not exceed. At 5% risk level, delivery time should not exceed 9 days. 9 minus 6 equal to 3. 6, 7, 8. 3 days. 3 days safety stock equal to 450 castings. Without formula, sir. Just the concept. Without formula. Just mention the 5% risk level. Safety stock equal to 450. Next, suppose at 10% risk level, safety stock equal to just 300. Next, at 15% risk level, at 25% risk level. So this is the scenario based question, sir. MCQs. At 0% risk level, safety stock 600. Just see that question. Yes, at 0% risk level, delivery time should not exceed 10 days. Delivery time should not exceed 10 days. So 9th day, 8th day, 7th day, 6th day. Here general lead time, normal lead time equal to 6. 10 minus 6 equal to 4. Risk level important, madam. At 0% risk level, delivery time should not exceed 10 days. Take 10 fingers. Close normal lead time 6. Remaining 4. Suppose risk level 5%. Delivery time 9 days. Stick on 9 days. Close 6. 3 days. Suppose risk level 10%. 8 days. Close normal lead time 6. 2 days. Safety stock. Clear? So this is the safety stock. But formula based, sir. Formula based. Safety stock equal to, here not annual demand, annual usage of raw material, annual usage of raw material divided by number of days in a year, number of days in a year into maximum lead time minus normal lead time, minus normal lead time. This is the formula based. Concept based is very, very easy. Just the risk level, see the risk level, mention the stock. But this is formula. Formula is the annual usage of raw material divided by number of days in a year into maximum lead time minus normal lead time. Sriram, in this question, annual usage of raw material 54,000. That is annual demand, not annual usage. Here inventory levels 0. Opening inventory material nil. Closing inventory material nil. So inventory levels nil. Annual demand nothing but annual usage. Both are same. If there were no inventory levels, in that case usage becomes demand. Demand becomes usage. Correct? Huh? So 54,000 divided by 360 days. 150. Maximum lead time depends upon the risk level. At 0% risk level, normal lead time is always. So answer 600 cash. So safety stock can be calculated in two methods, concept method and formula method. Which one is very easy? Concept method is very easy. Formula worst. So formula, annual usage of raw material divided by number of days in a year into maximum lead time minus normal lead. That is 600 castings. Sir, suppose if company maintains safety stock, definitely extra carrying cost also incurred. Extra. So previously carrying cost only on order size. Carrying cost only on. But suppose company maintains safety stock, then carrying cost incur also safety stock. Carrying cost incur also safety stock. For example, this is the bin. Raw material storage place is nothing but bin. Here smaller portion contains safety stock. Larger portion contains order size. Order size, nothing but EOQ. Nothing but. Suppose if there is no information about the order size, then order size becomes EOQ. That is fundamental rule. If there is no information about the order size, nothing but reordering quantity. If there is no information, sir, order size, company order size is also called as reordering quantity. ROQ. ROQ means company order size. If there is no information about the order size, then order size equal to EOQ. Order size equal to EOQ. So present EOQ, sir, 1800. Safety stock, for example, at 0% risk level, company maintains 0% risk level, 600 castings. 600 castings. Now calculate total carrying cost. Total carrying cost. So average principle applied only for order size. Reason? In larger portion, there is a daily usage. In larger portion. But in smaller portion, in case emergency create, that in that case that will be used. Am I right? So there is no daily usage in smaller portion. In larger portion, there is a daily usage. Then here average content is applied. Here average not applied. So finally formula equal to average inventory of order size. That is the half of the order size. Half of the order size. Half of the order size. Half of the order size into C plus not half of the safety stock, only safety stock. Safety stock into C. Safety stock into C. Safety stock into C. Half of the order says 1800 by 2 into C 300 plus safety stock into 300. So this is 2,70,000 plus 1,80,000. 4 lakhs. Clear, sir? Is it clear? 4,50,000. So here additional carrying cost incurred when company maintains safety. That is the demerit of the traditional method. Is the demerit of the traditional method. Generally, production interruption arises due to material stock out. How to overcome to maintain the safety stock? But if company maintains safety stock, additional carrying cost incurred. Then what to do? Don't worry. Next method, modern method, one bin system. One bin. Simple logic. Suppose order placed too early. Order placed. No need to maintain safety stock. No need to maintain. But in second model, a danger stock level also exists. Danger stock level is also. But in this model, no danger stock level because safety stock maintained. If company maintains safety stock, no need to calculate danger stock level. Suppose if there is no safety stock, definitely maintain danger stock level. Clear? In first model, safety stock maintained. So no need to calculate the danger stock level. But if there is no safety stock, definitely calculate the danger stock level. At danger level, immediately stop the production. Immediately stop the only except emergency works. Except that is the modern method. That is the second method. That is the second method. Okay. Okay. Now complete the problem, sir. Remaining problem. First, assume the company is willing to assume 15% risk being out of stock. Checker there. At 15% risk, what would be the safety stock? 150. Correct? Huh? Yes, 15% to 150 castings. Now, what they are asking this question? Reorder point. Reorder point means, Dedipya, reorder point means it is that level of inventory. It is that level of a fresh order for purchase of raw material shall be made. At what level fresh order shall be made, sir? Simple logic. Here, consider normal consumption. Here, normal consumption per day, 150 casting. Normal lead time, 6 days. 6 days consumption equal to 6 into 150, madam. 900. This is called LTC, lead time consumption. Please consider lead time consumption. Simple, sir. Reorder point or reorder level means when to place the order. When to place the order means order size 1800 gradually decrease and touch the lead time consumption. Then immediately place the fresh order. Order size 1800, sir. Gradually day by day decrease. Daily usage 150, sir. After 2 days, this becomes 1500. Next 4 days, this becomes 1200. So day by day decrease and touch the 6 days consumption. Then immediately place the fresh order. So in traditional method, here considering the lead time consumption, so formula LTC plus safety stock. LTC plus 900 plus 600 equal to 1500 units. Bin stock level, bin level equal to 1500 units. 1500. It is the level of inventory. It is the level of inventory. A fresh order shall be made for purchase of raw material. That level is calling as reorder level. Formula reorder level equal to safety stock plus lead time consumption, or lead time consumption plus safety stock. Clear, sir? So here safety stock 150, sir. At 15% risk level, safety stock 150, sir. 150 plus lead time consumption 900. Answer 1050, sir. 10. Correct, sir. Next. Rakesh, third bit. Assume the company is willing to assume 5% risk level. At 5% risk level, safety stock, sir. 5% risk level, safety stock, sir. 450 castings. 450 castings. So 450 castings. Next reorder point. 450 plus lead time consumption 900. Answer 1350. Correct? Next. D-bit. Assume 5% stock out risk. 5% stock out risk means safety stock equal to 450. Now, what would be the total cost of ordering for 1 year? Total ordering cost for 1 year means number of orders into ordering cost per order. Present company order size, there is no information. Please follow EOQ. According to EOQ, number of orders equal to. According to EOQ, number of orders, madam. 30 orders, madam. 30 orders. 30 orders into 9,000, madam. 2 lakhs. 70,000. Next, total carrying cost. Total carrying cost, sir. Here dangerous, sir. Here company also maintains safety stock. So carrying cost equal to half of the order size into C plus safety stock into C. Answer 4 lakhs. %5 risk. Okay, 5% risk means here 450, sir. 450 into answer 1 lakh. 1,35,000 plus 2,70,000. 4 lakhs. 4,05,000. Correct? Sit down. Next. Money. E point. Refer to the original data. That means some modifications in the original data. Remaining all refer to original data. Remaining elements refer to original data. Here 2 modifications, sir. Assume that using process reengineering, the company reduces its cost of placing a purchase order only 600. That means revised ordering cost. Revised ordering charges or ordering cost per order. Revised ordering cost per order 600. Ordering cost per order changes, ultimately EOQ affected. Then immediately calculate new EOQ. Then immediately calculate new EOQ. Sir, here formula EOQ formula square root of 2AO by C. O changes, immediately calculate new EOQ. C changes, immediately calculate new EOQ. Next. Waste and inefficiency, nothing but cost of obsolescence also considered. In previously only two elements are considered, insurance cost and storage cost. But now third element is also added. Third element is cost of obsolescence. Therefore, true carrying cost equal to 720. True carrying cost equal to 720. So C changes, O changes, then immediately calculate new EOQ. So new EOQ square root of 2AO by C. So 2 into 54,000 into 600 divided by 720. 300 castings. 300 castings. Clear? This is the new purchasing policy. According to old purchasing policy, order size, madam, 1800 castings. Under new purchasing policy, order size, madam, 3. Right. One question. Under old purchasing policy, 1800 order size, therefore time gap between two orders equal to time gap between two orders according to old purchasing policy 12 days. So formula number of days in a year divided by number of orders in a year. According to old purchasing policy, number of orders equal to 30 orders. 12 days. Interpret Sriram. Every 12th day, a fresh order shall be made for purchase of raw material. Every 12th day, a fresh order shall be made for purchase of raw material. Next, new purchasing policy. New purchasing policy, I think new purchasing policy EOQ 300 castings. Am I right? So 54,000 divided by 300, 180. 360 divided by 180 orders. 2 days. That means every second day, company has to place the order. So, according to under new purchasing policy, company has to place every second day. Company has to place the order every second day. Whereas under old purchasing policy, it was every 12th day. Whereas under old purchasing policy, it was every 12th day. Every 12th day. Clear? Every 12th day. So, this is the problem, sir. Next. Completed, sir. Plus minimum by 2. Maximum stock level plus minimum stock level by 2. In another way, suppose some companies doesn't maintain maximum stock level. In that case, minimum stock level plus half of the reordering quantity. Minimum stock level plus half of the reordering quantity. This is second alternative. So, maximum stock level is not readily available, then go for second alternative, minimum stock level plus half of the reordering quantity. So, this is the one set, one bin system. Oh, sorry, not one bin system, sir. This is two bin system, sir. This is two bin system. This is two bin system. ROL equal to LTC plus safety stock. Maximum stock level EOQ plus safety stock. Minimum stock level safety stock. Average stock level maximum plus minimum by 2. So this is the two bin system. Here there is a demerit, sir. Additional carrying cost incurred. Additional carrying cost incurred. So now going to one bin system. Now going to one bin system. This is only one portion. Order size equal to 1800. Yes. There is no safety stock, only order size. So when to place the order? Too early. Previously, larger portion inventory level gradually decrease and touch the lead time consumption. Am I right? Now, here consider maximum lead time into maximum consumption considered. Maximum lead time into maximum. Here maximum lead time 10. Maximum consumption 150. Therefore, 1500, sir. 15. So 1800 gradually decrease and touch the 1500. Then place the fresh order. Place the fresh order. So here considering maximum lead time and maximum consumption. Previously considering normal lead time and normal consumption. Now considering maximum lead time and maximum consumption. Suppose if you consider maximum lead time and maximum consumption, in that case no need to maintain the safety stock. In that case no need to maintain the. Suppose if you consider normal consumption and normal lead time, definitely maintain the safety. That is the difference. That is the difference. Placement of order too early, sir. Previously considering normal consumption, normal lead time. Now considering maximum consumption, maximum lead time. So here 1500. So formula, now ROL formula, sir. ROL formula, maximum consumption into maximum lead time. Maximum lead time. So this is ROL. This is 15. So one bin system considering the maximum consumption and maximum lead time. Two bin system considering the normal consumption and normal lead time. If you consider normal consumption, normal lead time, that is two bin system. If you consider maximum consumption, maximum lead time, that is one bin system. So in one bin system, reorder level equal to 1500. Reorder level formula, maximum consumption into maximum consumption into maximum lead time. That is 1500. 1500. Now, so at this level of inventory, a fresh order shall be made for purchase of raw material. At this level of inventory, a fresh order shall be made for purchase of raw material. Now, less LTC 600. LTC means lead time, not 600. LTC, I think 900. Am I right? Lead time consumption, sir. Delivery from supplier generally takes 6 days, 6 150s. So this is 900, sir. This is 900. LTC, lead time consumption 900. Deduct, we get 600. This is called minimum stock level. This is called minimum stock level. So ROL 1500 minus LTC. LTC means lead time consumption. Normal delivery from supplier generally takes 6 days. That 6 days uses 6 150s, 900, 6 150s. So out of 1500, 900 consumed, then level equal to 600. That 600 level is nothing but minimum stock level. Minimum. So minimum stock level is that level of inventory beyond which inventory will not be allowed to fall. Inventory will not be allowed to fall. So definitely company maintains 600 level. Will not be allowed to fall. In case, suppose 6th day may not come, that level becomes 450. 7th day may not come, that level becomes 300. So next day will not come, 150. So suppose here Draw this line. This is danger level. This is danger level. Danger level means here 150. Danger level means. So how to fix the danger level? Please consider delivery time in emergency case. Delivery time in emergency cases. That means lead time for emergency purchase. Lead time for here lead time for emergency purchase. In case emergency created, nearest point, delivery from nearest point take 1 day time. 1 day. So 1 day consumption equal to 1 day into average consumption per day 150. 1 into 150, 150. So that is the danger level. Suppose delivery from nearest place 2 days. In that case, danger level becomes 2 150s, 300. Delivery from nearest place in case emergency created. In that case, delivery from nearest place. Raw material delivery from nearest place. Here raw material delivery from nearest place. In this example, only 1 day. So 1 into 150 equal to 150. So ROL minus LTC equal to minimum stock level. Next to danger stock level. Danger stock level equal to lead time for emergency purchase into average consumption per day. Lead time for emergency purchase into. So 3 formulas completed. ROL. This is one bin system. Maximum lead time into maximum consumption. Maximum consumption. Next, ROL minus LTC equal to minimum stock level. Next, danger level equal to average consumption into lead time for emergency purchase. Lead time for emergency purchase. So these 3 formulas very, very important, sir. Now next one, maximum stock level. Next one, maximum stock level. Maximum stock level means ROL plus ROQ minus minimum consumption into minimum lead time. So here maximum stock level. Here maximum stock level. Here maximum stock level. Suppose order placed, sir. Suppose here fresh order received. Therefore, maximum stock level equal to here 2400. Next, again order placed, sir. Here 7 days. Not 7 days, 5 days. Like this. This is the graph for levels for one bin system. Maximum level, minimum level, ROL, danger level. ROL formula, sir. ROL formula. Maximum consumption to maximum lead time. Maximum consumption. Maximum consumption into maximum lead time. Next, ROL ready. Next, ROL minus LTC equal to minimum stock level. Next, danger level. Average consumption per day into lead time for emergency purchase. These 3 interconnected. ROL minus LTC equal to minimum stock level. Next, danger level equal to average consumption per day into lead time for emergency purchase. Last one, maximum stock level. Last one, no. Maximum stock level. ROL plus ROQ minus minimum consumption into minimum lead time. Minimum consumption to minimum lead time. So 4 formulas: ROL, minimum stock level, danger level, maximum level. Sir, average level, sir, average stock level is same in both cases. Previously, maximum level plus minimum level by 2. Here also same formula to be applied. Maximum level plus minimum level by 2. Or another alternative, minimum stock level plus half of the reordering quantity. Reordering quantity. Right. Next problem. This is the problem number 2. Right. Sir, Messrs. S.J. Private Limited company manufactures 20,000 units of a product per month. This information related to raw material or product, sir? This information related to the product. Annual demand of company product, sir. Annual demand of company product. Annual demand of company product to 20,000 units into 12 months. 20,000 into 12 months. That is equal to 2,40,000 units. Checker there. Is it denoted by A? Asit, is it denoted by A? Wrong answer. It is not denoted by A. A means annual demand of raw material. But this is the annual demand of product. Annual demand of product. This is product demand. For EOQ calculation, required element is material demand. This is not material demand, sir. This is raw material demand. Sorry, product demand. This is product demand. A means annual demand of raw material, but this information annual demand of product. Sit down. Next. Second sentence. The cost of placing an order is 1500. So ordering cost per order equal to 1500. 1500. Next. The purchase price of the raw material equal to 100 rupees per kg. That is the unit price of raw material. Unit price of raw material. How much? 100 rupees per kg. So here raw material cost unit per kg. Raw material cost unit per kg. Finished product unit to units. Raw material unit to kg. So unit price of raw material 100 rupees. This is very useful for calculating carrying cost. Carrying cost completely depends on unit price of raw material. Unit price increase, carrying cost also. Unit price decrease, carrying cost also. So this is very, very important. Unit price of raw material. Sometimes carrying cost expressed in percentage. In that case, that percentage should be applied on unit price. Percentage should be applied on unit price. So unit price equal to 100 Ks. Next. Reorder period is 5 to 7 weeks. Reorder period is 5 to 7 weeks. So maximum, minimum, normal. Suppose normal not available, take the average. That means normal and average figures always nearest. So suppose if there is no information about the normal lead time, then take the average lead time. So here reorder period nothing but lead time. Reorder period another name is lead time. Reorder period or lead time. Reorder period or lead time. Here lead time days or weeks or months? In weeks. In weeks. Suppose lead time in weeks, consumption per week consider. Consider the consumption per week. Suppose lead time is in days, then take the consumption per day. Suppose if lead time in months, take the consumption per month. Lead time very, very important, sir. Lead time here weeks, take consumption per week. Suppose lead time in days, take consumption per day. Suppose lead time in months, take consumption per month. Sir, lead time in weeks, maximum lead time 5 to 7 weeks. 5 to 7 weeks, maximum lead time 7, minimum lead time 5. Normal lead time here there is no information. Take the average 5 plus 7 by 2. So maximum 7 weeks, minimum 5 weeks. Here there is no information about normal, then take the average 7 plus 5 by 2. 6 weeks. Next, consumption of raw materials, sir. Here clearly given raw material consumption or raw material usage. Sir, here raw material usage per week, sir. Raw material usage per week. Raw material usage per week. Sir, here raw material usage also varies from 200 to 300. In previous problem, raw materials are used evenly throughout the year. That means daily usage is uniform. In that case, minimum usage is 150, maximum usage is normal usage also. But here not uniform, sir. Here raw material consumption varies. That means here production pattern also varies. Here demand pattern is also varies. Okay, so if the demand is non-uniform, production is non-uniform. Metal usage is also. So here metal usage is non-uniform, sir. Minimum usage, sir. Maximum usage, sir. There is no information about the normal, then take the average. Here average is 200 plus 300 divided by 2. 250. So 300 kgs. 200 kgs. 250 kgs. 250 kgs. Now, next. So, next, carrying cost of inventory 9.75% per annum. In previous problem, carrying cost expressed in amount. Now, carrying cost expressed in percentage. Carrying cost always depends on unit price of raw material. Correct? That means unit price increases, carrying cost also. So, here 9.75% applied on unit price. 9.75% of 100. So, carrying cost per unit per annum, sir. Carrying cost per unit per annum. 9.75% of 100 rupees equal to 9.75 rupees. 9.75 rupees. Now, lead time for emergency purchase. In case emergency created, in that case, delivery from nearest place equal to 2 weeks. This is useful information for calculating the danger level. This is very useful for calculating the danger level. Now, check further. In this problem, one thing is missing. That is annual demand of raw material. Sir, here questionnaire provides annual demand of product. But for EOQ calculation, required element is annual demand of. First calculate annual usage of raw material. Next adjust the inventory levels. Then we'll get the annual demand of raw material. So how to calculate annual demand of raw material? First calculate the annual usage of raw material. Next adjust the inventory levels of raw materials. We'll get the annual demand of raw material. Aishwarya, annual usage of raw material in this problem. Next, annual usage of raw material. 100. Dedipya, annual usage of raw material. 13,000 case. How? So here normal usage or average usage per week equal to 250 kgs. I am asking annual usage. Annual usage means 250 kgs per week into 52 weeks. That is the annual usage. That is the annual usage of raw material. Annual usage of raw material. Annual usage of raw material. Annual usage of raw material per week usage equal to 250 kgs into 52 weeks. 52 weeks amount. 13,000 kgs. Next to inventory levels. Is there any information about the inventory levels, madam? There is no opening inventory, there is no closing inventory. Therefore, annual usage becomes annual demand. Suppose inventory levels, therefore, sometimes opening inventory certain quantity, closing inventory certain quantity. In that case, how to calculate annual demand? Usage adjust the inventories in reverse mode direction. Closing should be added, opening should be, that case annual demand. Sit down. Annual demand of raw material. Annual demand of raw material. Denoted by 13,000 KS. 13,000 KS. Correct? Huh? A ready, O ready, C ready. Next. What they are asking this question? Reordering quantity. So reordering quantity means company order size, sir. Reordering quantity means company. Reordering quantity, nothing but company order size. Company order size. Formula Anusha. Square root of 2AO by C. Square root of 2AO by C. That is equal to 2 into A. 13,000. O. C. 9 point. Answer. 2000. Ordering cost to 1500. Okay. 1500. C. Carrying cost to answer. 2000 case. This is the reordering quantity. So reordering quantity means company order size. If there is no specific information about the company order size, therefore EOQ, company order size becomes EOQ. EOQ formula square root of 2AO by C. 2000 KS. Right. Checker there. Is it one bin system or two bin system? One bin system. One bin system or two bin system? One bin. Here there is no discussion about the safety stock. If there is no discussion about the safety stock, that indicates one bin system. First to read the problem. Sir, in this problem, no discussion about the safety stock. Thank you. No discussion about the safety stock. No print about the safety stock. Then this indicates here company presently follows modern method. Modern method means one bin system. Traditional method is two bin system. So here there is no discussion about the safety stock. This is one bin system. One bin system means only one portion. Only one portion. That portion contains order size. That portion contains order size. Next, reorder level. In one bin system, reorder level, here considering maximum lead time and maximum. So maximum consumption into maximum lead time. Maximum consumption into maximum lead time. Maximum consumption. Here table, sir. Maximum consumption 300, sir. Maximum lead time. So 300 into 7. 2100 KS. 2100 KS. Next. Next bit, sir. Maximum level. Maximum level. Maximum level equal to ROL plus ROQ minus minimum consumption to minimum lead time. Minimum consumption into minimum lead time. So ROL 2100, 2000, 5 into minimum consumption 200, minimum lead time 5 into 200, 3000 KS, very, very important. Please mention the unit, sir. Next, minimum level, sir. So here minimum level in one bin system, ROL minus lead time. So ROL minus lead time consumption equal to minimum stock level. Minimum ROL 2000. Lead time consumption means normal lead time into normal consumption. If there is no information about the normal values, then take the average. So 6 into 250. 6 into 250. Now 600 KS. 600 KS. Average stock level. Maximum plus minimum by 2 or minimum plus half of the reordering quantity. So you can select one option, sir. Here maximum ready, minimum also ready. C plus D divided by 2. So here is 3100 plus 600 divided by 2, sir. 1850 case. 1850. Ashrit, danger level. Here considering the emergency lead time. Emergency. So lead time for emergency, sir, 2 weeks into average consumption per week. 500 case. Okay, so this is the levels, stock levels. Next important thing is ITR. Inventory turnover ratio. Listen, ITR measures the speed at which the raw materials are getting consumed. ITR measures the speed at which the raw materials are getting consumed. Suppose X Limited company produces a single product, namely P. P requires two raw materials, namely raw material A, raw material B. Raw material A, raw material B, sir. Now, in this case, which one is fast moving raw material item? How to find which one is fast moving raw material item? By using the inventory turnover ratio. By using the, for example, inventory turnover ratio 40 times. Here inventory turnover ratio 60 times. 1 year equal to 360 days. 1 year equal to, sir, raw material A inventory turnover ratio 40 times. Raw material B inventory turnover ratio. So, which one is fast moving item? So, raw material B is a fast moving item. Reason, ITR in times 60 times. More the times, faster is the movement of raw material. More the times, faster is the movement of raw material. So, here material B more times, 60 times. Generally, at the time of raw material purchase, company approached the banker, please provide the short-term finance. Please provide the for raw material purchase. Then banker check the status and sanction the cash credit facility or short-term finance. Suppose 10 lakhs. So 10 lakhs amount, huge amount allocated to fast moving item, less amount allocated to slow moving item, that affects interest cost is saving. So the main objective of ITR to minimize the carrying cost. To minimize the carrying cost. So EOQ to minimize the TOC and TC's additional cost. Stock levels to avoid the stock out risk. Now ITR to minimize the carrying cost, especially interest cost. Suppose here banker sanctioned a cash credit facility for raw material buying 10 lakhs. Out of 10 lakhs, huge amount allocated to fast moving item, less amount allocated to slow moving item. So here fast moving item, more the number of times, faster is the movement of raw material, less the number of times slow moving item. So here ratio 4:6, 10 lakhs divided by 100 into 40, 4 lakhs. Here 6 lakhs. Sometimes questioner is asking calculate ITR in days. Calculate ITR in days. Calculate ITR in days, sir. So ITR in days, how to calculate? Number of days in a year, 360 days, divided by ITR in times. ITR in times 40, that is equal to 9 days. 9 days, sir. That means from date of purchasing to date of consumption, time period equal to 9 days. That is storage period only 9 days. Storage period only 9 days. Here 360 divided by 60. Here only 6 days, sir. Purchasing date to consumption date period only 6 days. So ITR measures the speed at which the raw materials are getting consumed. ITR measures the speed at which the raw materials are getting. So here time period 9 days. In case of raw material, time period is 6 days. So which one is the fast moving item, sir? Raw material B. Lesser the number of days, faster is the movement of raw material. Lesser the number of days, faster is the. So as per days, how to take the decision? Lesser the number of days, faster is the movement of raw material. As per times, more the number of times, faster is the movement of raw material. So ITR question, very, very important theory question. ITR means it measures the speed at which the raw materials are getting consumed. It can be expressed either in times or in days. ITR in times. How to calculate, sir, ITR in times? ITR in times. How to calculate ITR in times? Sriram, any idea? ITR in times calculation? Cost of raw material consumed divided by cost of average inventory of raw material. Cost of average inventory of cost of raw material consumed divided by cost of average inventory of raw material. Right. How to calculate cost of raw material consumed? Raw material purchased cost. Next, adjust the inventory levels. We'll get the raw material consumed. How to calculate cost of average inventory? Opening stock, cost of opening inventory of raw material, cost of closing inventory of raw material, summation divided by 2. For suppose this is the first year, there is no opening stock. In that case, closing stock of raw material shall be treated as average. Don't take the average. Sir, in case this is the first year, for example, this is the first year, there is no opening stock. In that case, closing stock of raw material shall be treated as average stock. Okay. So, both are available, take the average. Only closing stock is available, directly take the closing stock is the average stock. Clear? So, ITR in times equal to cost of raw material consumed divided by cost of average inventory. Next, ITR in days. ITR in days, that is the stock velocity. ITR in days, that is the stock velocity. Number of days in a year. ITR in times. ITR in times. This is the inventory turnover ratio. Decision making, sir, simple. More the number of times, faster is the movement of raw material. Lesser the number of days, faster is the movement of raw material. Suppose as per days, lesser the number of days, faster is the movement of raw material. Raw material B. According to times, more the number of times, faster is the movement of raw material. Here, more the number of times is also B. Decision is same. Okay. So this is the third element of inventory turnover ratio. Next, pricing issue methods of FIFO, LIFO, that is general thing. Next, the ABC, that is also general thing, sir. So this is the material cost, right? Next. Next one, employee cost. This is the third chapter, employee cost. Right, listen. Right. Now, question. Shriram, what is the objective of employee cost? Wait. Objective of employee cost. Here, the main object of this chapter to minimize the employee cost per piece. If workers' output levels increase, employee cost per piece decreases. Workers' output levels increase, employee cost per piece. How to improve the workers' output levels? To give attractive wage payment. To give attractive wage payment. Basically, wage payments are two types. What are they? One is time rate wage system. Second one is, sit down. Listen. Time rate wage system. Second one is piece rate wage system. First one is time rate wage system. Second one is piece rate wage system. A worker is paid at a fixed rate per hour, that is called time rate wage system. So payment on hourly basis is called as time rate wage system. Formula just T into R. T into R. T means actual working hours. R means hourly wage rate. Suppose if workers' output levels increase, employee cost per piece decrease. That is common thing. So that here introduce incentive plans. Suppose incentive plans introduced, automatically output levels increase, employee cost per piece decrease. Incentive schemes introduced, automatically that affects employee cost per piece decrease. Incentive schemes introduced, automatically output levels increase, employee cost per piece. Under time rate system, two incentive schemes is, one is Halsey premium plan. Second one is Rowan premium plan. Rowan premium plan. And Halsey premium plan, not only T into R plus additional amount also given. That is 50% of into R. Sometimes questioner asking, calculate bonus hours according to Halsey scheme. Calculate bonus hours according to, in that case formula 50% of time saved. Only 50% of time saved. Bonus hours according to Halsey formula 50% of bonus amount according to Halsey means 50% of time saved into R. That is the difference. Bonus hours according to Halsey 50% of time saved. Bonus amount according to Halsey 50% of time saved into R. Earnings according to Halsey means T into R plus 50% of time saved into R. So 3 bits: earnings, bonus hours, bonus amount. Next, time saved formula. Ganesh, formula time saved. SH minus AH. Standard hours allowed for actual output minus actual hours worked for actual output. This is very useful for calculating the efficiency ratio. Efficiency ratio on hours basis. Efficiency ratio on hours basis equal to SH by AH into 100. SH by AH into 100. So there is a second alternative, sir. There is a second alternative, that is output basis, sir. AO by SO into 100. You can select any mode, either hours mode or output mode. Hours mode is best. SH by AH into 100. So here in under Halsey's scheme, there is a demerit, sir. There is a demerit. What is the demerit of Halsey's scheme, sir? If worker speed increases, bonus also increases, next earnings also increases, product quality decreases. So under Halsey's scheme, bonus and earnings link with the worker speed. If worker speed increases, bonus also increases, earnings also increase, that affects product quality decrease. That is the main effect, main demerit of the Halsey scheme. So how to overcome this demerit, sir? Please use the Rowan scheme. Please use the Rowan scheme. Under Rowan scheme, what is the specialty? Worker earnings increase up to a certain speed, under Rowan scheme, bonus increase up to a certain speed. Beyond that, bonus will decrease. So definitely here worker stick on a certain level of speed. Definitely here product quality to maintain. Product quality to be maintained. So Rowan is the Rowan formula. T into R plus bonus TS by ST into T into. So under Rowan scheme, T into R plus TS by ST into T into R. T into R. Bonus under Halsey's scheme, bonus under Rowan scheme. When these two are equal, actual time taken equal to 50% of time allowed. For example, standard time allowed for a given work 8 hours. Standard time allowed for a given work equal to, but actual working hours 4 hours. Actual working hours equal to. So you clearly observed actual working time 4 hours. That is 50% of the time allowed. In this situation, bonus under Halsey plan, bonus under Rowan plan, same. Sir, standard time for a given job equal to 8 hours. Working time for a job equal to 4 hours. Exactly 50%. Exactly. Here actual time taken is exactly 50% of the time allowed. In this case, bonus under Halsey scheme is equal to bonus under Rowan scheme. So that's why this is the permissible speed. This is the permissible speed. So limited speed, that is actual time taken equal to 50% of the time allowed. So up to that speed under Rowan scheme, bonus gradually increases. Beyond that level, bonus gradually decreases. Bonus gradually decreases. Clear? Okay. So standard time 8 hours, but actual time 4 hours. So observing one thing, actual time taken is 50% of the time allowed. At this point, bonus under Halsey scheme is equal to bonus under Rowan scheme. So up to this point, under Rowan scheme, bonus gradually increases. Beyond that level, bonus gradually decreases. So definitely worker maintains that speed, that is 50% of time. Actual time taken is 50% of the time allowed. In that case, product quality to be maintained. Clear? So this is the Halsey scheme under Rowan scheme. Halsey scheme under Rowan scheme. Right. Next, piece rate system. Sir, piece rate system is very expensive than other systems. Piece rate system is expensive than. So under piece rate system, for example, piece rate system, wage cost per piece or employee cost per piece, for example, 80 rupees. Definitely under Halsey below 80. Definitely under Rowan below 80. So compared to other schemes, employee cost per piece is very expensive. Employee cost per piece very expensive. So in this scheme, what is the speciality? Here, total benefit pass on to customer. Total benefit pass on to worker. Under Rowan, under Halsey scheme, 50% worker, 50% management. Am I right? Certain portion worker, certain portion management. Under Rowan scheme also certain portion worker, certain portion management. But under piece rate system, total skills given to employee. So that's why piece rate system, under piece rate system, employee cost per piece is always expensive than other systems. But in some industries, workers demanding, we want piece rate system. In that case, definitely pay the payments under piece rate system. Definitely pay the payments under piece rate system. Under piece rate system formula, sir. Under piece rate system formula. Under piece rate system, wages equal to number of pieces produced into piece rate per piece. Piece rate per piece. Number of pieces produced into piece rate per piece. Number of pieces produced into piece rate per piece. So here one thing is observed. There is a link between performance and reward. There is a link between. So performance increases, automatically reward also. But in time rate based system, no link between performance and reward. Are completely based on the time basis. Here payment on according to time. So on time rate based system, a worker is paid at a fixed rate per hour. But here a worker is paid at a fixed rate per piece produced. Per piece. Production volume increases, wages also increase. So formula, number of pieces produced into piece rate per piece. Sir, how to calculate piece rate per piece? Piece rate per piece would be based on standard hourly output. Piece rate would be based on piece rate per piece would be based on standard hourly output. Standard hourly output means that is the past experience. As per company experience, 1 hour standard output. 1 hour. For example, 1 hour standard output 10 units. 1 hour rate equal to 10 rupees. Therefore, piece rate per piece equal to 1 rupee. 1 hour standard output to 10 units. 1 hour rate equal to 10 rupees. 10 units, 10 rupees. 1 rupee. This is conceptual method. Formulas are simple. Piece rate per piece equal to piece rate per piece. Piece rate per piece equal to standard time for 1 unit into R. In this example, in our example, standard time for 10 units equal to 1 hour. 10 units standard time 1 hour. 1 unit standard time 0.1 hour. Standard time for 10 units equal to 1 hour. 10 units time equal to 1 hour. 1 unit time equal to 0.1 hour into hourly payment. 10. Answer. This is formula based method. So piece rate per piece equal to standard time for 1 unit into R. Logic. Standard hourly output 10 units. 1 hour 10 units. As per company experience, 1 hour 10 units. 1 hour rate 10 rupees. 10 units 10 rupees. 1 unit equal to. That is simple logic. No sir, formula sir. Standard time for 1 unit sir 0.1 hour. 0.1 hour into hourly rate 10. 0.1 hour into 10 equal to 1. So final thing, piece rate would be based on standard hourly output. That means would be based on past experience. Would be based on. So as per past experience, 1 hour standard output 10 units. 1 hour rate equal to 10 rupees. Therefore, piece rate per piece equal to 1 rupee. Piece rate per piece equal to 1 rupee. Okay. So this is the history of wage schemes. Two types: wage schemes, time rate system and piece rate system. Now, in this segment, first calculate the earnings. First calculate the next effective rate of earnings per hour. For example, calculate the earnings 100 rupees for 8 hours. Now calculate the effective rate of earnings. Total earnings of a worker divided by time. Okay, let's take the problem. So problem number 1. CRD 1 sir. CRD 1. Listen. CRD 1. So worker name sir X. So here data extracted from company books, worker name X, ticket number 002. This is the identification number. So for earnings calculation, no need sir. Next, work started. Work started April 1st, 2011. 2011 morning 8 o'clock. Next, work finished April 5th, 12 noon, afternoon 12 o'clock. So finally, here clearly mentioned worker X worked 9 hours a day. 9 hours a day. So that means April 1st, 9 hours. April 2nd, April 3rd, April 4th, April 5th, 8 to 9, 9 to 10, 10 to 11, 11 to 12. So 4 hours. Total 40 hours. This is AHRT. AHRT, actual working hours or actual time taken, denoted by AHRT. Okay, next. Sir, given job 2160 units. Given job 2160 units just completed in 40 hours. After completion, units transferred to quality checking department. That is the quality inspection. So here 2160 done and approved equal to. So rejected units equal to. Rejected units means rejected units. Rejected units, any one of you can answer this question. It loses sales ability. It loses. These units loses the sales ability in the market. Therefore, these are the rejected units. These are the rejected units. Here rejected units equal to 160. Approved units equal to 2000. Now, here actual output means 2000 or 2160. Actual output equal to 2000. Actual output equal to 0. So here completed units 2160. Total production 2160. Sent to laboratory for testing its quality. Out of that 160 units rejected. Rejected units means it loses the sales ability in the market. It loses sales ability in the market. So rejected. So final actual output equal to 2000. Your actual output equal to 2000. Now calculate standard time for 2000 units. So here company experience provided, sir. Company experience provided G point. As per company experience, 1 hour output equal to. Hello. As per company experience, 1 hour output equal to. 1 hour output equal to 40 units. That means 40 units 1 hour. 2000 units hours equal to. Sir, for 40 units allowed time equal to 1 hour. For 50 units, 2000 units allowed time equal to 50 hours. That is standard hours. That is standard hours. So here actual output equal to 2000 units. Units involved in production 2160. Units involved in production. Units introduced into the production 2160. After completion sent to laboratory for testing its quality 160 rejected. Rejected units means it loses sales ability in the market. It loses. That is rejected units. So approved units equal to only 2000 units. Approved units equal to 2000 units. Now company experience. Standard time for 40 units. 1 hour. Standard time for actual output. Standard time for actual output for 2000 units. Denoted by 50 hours. 50 hours. Okay. Actual working time for actual output. Actual working time for actual output. Actual working time for actual output. AH or T. 40 hours. Time saved equal to SH minus SH 40. Correct? Huh? Next, efficiency ratio. Efficiency ratio SH by efficiency ratio on hours basis. Efficiency ratio on hours basis. SH by AH into 100. So SH 50 by 40 into 100. 1. Correct? Huh? Next, suppose same ratio on output basis, sir. Efficiency ratio on output basis. On output basis. Formula AO by SO into 100. AO by SO into 100. Rakesh, AO means, sir, AO means actual output for actual working time. Actual output for actual. So AO means actual working time. Actual output for actual working time. Actual output for actual working hours. Actual working hours. Actual output for actual working hours. Here actual output 2000 units. Actual working time 40 hours. So therefore 2000 units. 2000 units per 40 hours. 40 hours. Next, SO. SO means standard output Standard output for actual working hours. Sir, here actual working hours, sir, 40 hours. Clearly mentioned past experience. Here past experience, sir. 1 hour, 40 units. Here 40 hours standard output, sir. 1 hour standard output, 40 units. 40 hours standard output, sir. 1600 units, sir. 1600 units for 40 hours. How, sir? Simple. For 40 units, 1 hour. For 40 hours, number of units, 1600 units. Clear? So SO means standard output for actual working hours. Now calculate the AO by SO. AO 2000 units divided by SO 1600 units into 100. 1. Clear? 125%. 125%. So this is the efficiency ratio AO by SO into 100. Right. Next. Hourly wage rate, sir. Hourly wage rate. Hourly wage rate R. Hourly wage rate R. Hourly wage rate 25 rupees. 25 rupees. So details ready, sir. Now, what they are asking this question? You are required to calculate. Remuneration means earnings. Earnings of the worker under the following methods. Wholesale plan, proven plan. So remuneration of the worker on wholesale plan, sir. Remuneration of the worker under wholesale plan. Remuneration of the worker under wholesale plan. Remuneration of the worker under wholesale plan, sir. T into R plus 50% of time saved into R. Sir, here working time, hourly payment, 50% of 10 hours into 25. So 40 into 25. 120 is equal to 120. Ashritu, in wholesale premium, how much percentage of premium is added? How much percentage of premium is added, sir? 125 premium, that is divided by 1000 into 100. 12.5% added, sir. 12.5%. So calculate percentage of premium according to wholesale. According to wholesale. Formula: bonus divided by basic wage into 100. Bonus divided by basic wage into 100. Here percentage of premium equal to 125 divided by 1000 into 100. That is equal to 12.5%. 12.5%. Next. Sir, suppose here earnings under wholesale plan 1125. Question is asking calculate earnings per hour. Total earnings 1125. But question is asking effective rate per hour. So effective hourly rate under wholesale. Effective hourly rate. Effective hourly rate under Halsey. Effective hourly rate under Halsey, sir. 1125 total earnings divided by 40 hours. 28.12. Correct? Effective hourly rate under Halsey 1125 divided by 40 hours, that is equal to 28.125. Sometimes labor cost per piece under Halsey. Total earnings numerator same 1125 divided by, here question is asking per piece. So divided with the number of pieces produced. Here please consider actual output 2000 units. 0.56. So effective hourly rate to 28.125. Next, labor cost per piece under Halsey 0.5625. Sir, here one thing is observed. Normal hourly rate how much? Normal hourly rate how much, sir? Normal hourly rate to 25 rupees. But effective hourly rate is 28.125. So normal hourly rate 25. It is more than normal hourly rate, sir. Effective hourly rate is about 25, sir. That means here worker efficiency ratio beyond 100%. Worker efficiency ratio beyond. If worker efficiency ratio beyond 100%, in that case, effective hourly rate is always greater than normal hourly rate. Suppose if workers efficiency ratio below 100%, effective hourly rate is less than normal hourly rate. Effective hourly rate is less than normal hourly rate. Clear? So, completely depends on efficiency ratio. If workers efficiency ratio is beyond 100%, effective hourly rate is more than normal hourly rate. If workers efficiency ratio below 100%, effective hourly rate is less than normal hourly rate. Normal hourly rate. Sir, here labor cost per piece under Halsey 0.5625. Now, sometimes question is asking calculate original piece rate or ordinary piece rate. Calculate original piece rate or original piece rate or ordinary piece rate. Original piece rate or ordinary piece rate. Original piece rate or ordinary piece rate. Or ordinary piece rate. Original piece rate or ordinary piece rate. How to calculate original piece rate or ordinary piece rate? Simple. It is completely depends on past experience. That means piece rate per piece. That means piece rate per piece. Piece rate per piece. Standard time for 1 unit. Standard time for 1 unit. Standard time for 1 unit into R. So therefore original piece rate equal to standard time for 1 unit. As per company experience, standard time for 1 unit 40 units 1 hour. 1 unit time 40 units time, standard time 1 hour. 1 unit time equal to 1 divided by 40. 0.025 hours. Hourly payment. Answer. 0.62. 0.625. This is the original piece rate. But under Halsey, only 0.5. So there is a saving. Suppose if company follows Halsey premium plan, savings per piece equal to Saving per piece under wholesale. 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 Original piece rate 0. Minus 0.5625. 0.06. That is the savings per piece under wholesale. Savings per piece under wholesale. Number of models. This is the savings per. Sometimes question is asking calculate savings per piece under wholesale. Calculate savings per piece under row 1. Sir, one thing is clear, sir. Original piece rate or actual piece rate is always expensive than other schemes, sir. Actual piece rate is expensive than other schemes. Here original piece rate is 0.625 and wholesale piece rate is 0.5625. Therefore, savings per piece equal to saving per piece and wholesale equal to 0.0. Clear? Next. Remuneration of the work under row 1 plan, sir. Remuneration of the worker. Remuneration of the worker. Remuneration of the worker under row 1 plan. Remuneration of the worker under row 1 plan, sir. Formula T into R plus TS by ST into T into R. Sir, working time, hourly payment 20 plus 10 divided by standard time 50 into 40 into 25. 40 into 25 is equal. Here one thing, sir. Calculate premium. How much premium added? How much percentage of premium added in loan scheme? This thumb rules. In wholesale 12.5. In Roman, in wholesale percentage of premium added, sir, 12.5%. In Roman, percentage of premium added, sir, 20. 200 divided by 1000 into 100, 20%. 20%. Next, effective hourly rate, sir. Effective hourly rate. Effective hourly rate. Effective hourly rate, sir. Effective hourly rates under row 1 premium plan. So 1200 divided by 40 hours. 30 rupees. Here one thing is observed. Effective hourly rate is more than normal hourly rate. Here normal hourly rate only just 25. But effective hourly rate is, one thing is clear, workers efficiency ratio beyond 100%. Workers efficiency ratio beyond. Suppose workers efficiency ratio below 100%, in that case below 25 rupees. Effective hourly rate is below 25 rupees. Okay. Next, effective hourly rate under row 1. Okay. Next, labor cost. Labor cost per piece under row 1. Under row 1. Sir, labor cost per piece under row 1, sir. 1200 divided by number of pieces produced. 2. Answer. 0.6 per piece. 0.6 per piece. Original piece rate, sir. Original piece rate 0.6. Therefore, savings per piece under savings per piece under row 1 scheme. original piece rate 0.2. Rowan scheme. Answer. So all statements proved, sir. So piece rate system is very expensive than other schemes. If company follows Rowan scheme, in that case savings per piece equal to 0.025. In case company follows Halsey scheme, savings per piece equal to 0.0625. Next, how much percentage of premium added in Halsey scheme? How much percentage of premium added in Rowan scheme? 20. They are standard rules. What is the demerit of Halsey scheme? Chakradhar. If worker speed increases, bonus also increases, earnings per also increases, but product quality diminishes. What is the benefit of Rowan scheme? Under Rowan scheme, up to a certain level, bonus levels increase. Beyond that level, bonus decreases. So that is the permissible limit. That is actual time taken equal to 50% of the time allowed. Actual time taken is 50% of the best example. Standard time 8 hours, actual time 4 hours. Standard time 8 hours, actual time 4 hours. So actual time taken is 50% of time allowed. In this situation, bonus is same in both schemes. Clear? Next, effective hourly rate or effective rate of earnings per hour. Total earnings divided by T. Effective rate of earnings per piece. Total earnings divided by number of pieces produced. Okay. Next, original piece rate or piece rate per piece. Standard time for 1 unit into R. Savings per piece under Halsey. Original piece rate minus piece rate per under Halsey. Savings per piece under Rowan. Original piece rate minus piece rate under Rowan. Total 5 problems completed, sir. Efficiency ratio on hours basis, SH by AH. Efficiency ratio on output basis, AO by SY into 100. Second bit, the third bit. Find the labor cost per 100 units. Presently, per piece cost under Halsey scheme, sir. 0.5625 into 100. Correct answer. Under Rowan, 0.2 into 100. Completed, sir. Sit down. Okay, now. Right. Next. So, this is the main topic, sir. Next, employee turnover rate. Employee turnover rate or labor turnover rate or LTR. Sir, in simple words, changes in composition of labor force is calling as employee turnover. Changes in composition of labor force is called as employee turnover. Sir, here employee turnover rate, sir. Yes, multiply with 100, then we'll get the rate. LTR is the rate of change in the composition of labor force during a certain period of time in an organization. Simple words, changes in composition labor force, nothing but employee turnover. Rate of change in the composition of labor force during a certain period of time is calling as labor turnover rate. Suppose changes increases. LTR also. Is it positive sign or negative sign? Negative sign. Changes in composition of labor force increases, labor turnover rate also increases, output levels decreases, output levels decreases. Clear? Sir, changes increases, sir. Labor turnover rate also increases, sir. That affects output levels. If output levels decrease, employee cost per piece increases. Employee cost per piece increases. Zero. Madam, what are the reasons due to changes in employee force? Due to replacements. First one, due to separations. Due to. So, suppose during a certain period, 2 workers left and 2 workers discharged. Then, therefore, separation is equal to 4 workers. Separation is equal to 4 workers. For example, workers at the beginning of the period, 10 members. Workers at the beginning of the period, 10 members. 2 members left, 2 members discharged. 2 members left and 2 members. Therefore, in this period, only the transaction, 2 members left and 2 members discharged. So, therefore, at the end of the period, workers at the end of the period equal 6. Workers at the end of the period equal to. Then calculate the labor turnover rate. Then calculate the labor turnover rate. So, here total separations 4 divided by average number of workers. Workers at the beginning of the period 10. Workers at the end of the period 6. 10 plus 6 divided by 2. 8. 4 by 8 into 100. 50%. Sometimes during a certain period, 2 workers left, 2 workers discharged, and 4 workers replaced, and 2 workers additionally recruited. That is the new joinings. New. So, in this case, definitely LTR increases. Definitely LTR increases. Here, separations, replacements, new recruits. Separations, replacements, new recruits. Definitely LTR increases. If LTR increases, output levels, automatically employee cost per piece increases. Clear? So, basically, 3 things, sir. One is separations. Second one is replacements. Third one is new recruits. So, due to separations, certain changes. Due to replacements, certain changes arise. Due to new recruits, certain changes arise. So, in a certain period, all these 3 transactions arise. Then definitely LTR increases. Separations, replacements, new recruits. Separations, replacements, new recruits. So, in this case, LTR equal to separations plus replacements plus new recruits divided by average number of workers. Average number of workers into, this is equal to LTR. This is equal to. But out of that, so for example, separations, replacements, new recruits divided by average number of workers into 100. That is equal to, for example, 80%. 80%. Out of 80%, certain percentage due to separations, certain percentage due to replacements, certain percentage due to, question is asking, so calculate percentage of separations, calculate percentage of replacements, calculate percentage of new recruits. All these 3, nothing but flux 2 method, nothing but. So, here in the present situation, 3 transactions arised. Separations arised, replacements arised, new recruits. So, then calculate separations plus replacements plus new recruits divided by total average number of workers into 100. So that is the total LTR. Total LTR. This is calling as flux to method. LTR under flux to method. So out here answer, for example, 80%. Out of 80%, certain percentage due to separations, certain percentage due to replacement, certain percentage due to new recruits. Then calculate separately. How? Separations by average number of workers into 100. Replacements by average number of workers into 100. New recruits by average number of workers into 100. Sometimes only these two percentage. There is flux one. Flux one. Separations plus replacements divided by average number of workers. For example, sometimes these two. Total joinings. Total joinings means replacements and new recruits. That is the total joinings. So finally, separations, replacements, new recruits, flux 1, flux 2, total joinings or accessions method. Accessions method. Accessions method. Sometimes 1 month information provided, 1 month LTRs calculated, then immediately calculate annualized. Immediately calculate that is the equivalent employee turnover rate. Equivalent employee turn. Simple. For example, 1 month rate 10%. Therefore, 12 months rate 12 months into 10, 120%. That is the equivalent employee turnover rate. Simple in terms of per annum basis. In terms of per annum basis. Now take the problem. CRD number 2. CRD 2 sir. CRD 2. The information regarding number of employees enrolled in a shopping mall for the month of December. Sir, given information related to month of December month. Okay, December month beginning workers at the beginning of the period 900 sir. Workers at the end of the period 1100. Therefore, average number of workers. Average number of workers 900 plus 1100 divided by 2 is equal to 1000. During December 2017, so during this month, 40 employees resigned, 60 employees discharged. So total separations. Total separations. Total separations 40 plus 60. 40 plus 60. 100 workers. 100 workers. Total separations. Next, 300 employees were recruited means total joinings. 300 employees were recruited means total joinings. Another name, sir. Accessions, total joinings or number of accessions. Number of ACCESSIONS. Number of accessions. 300 workers. 300 workers. 300 workers. Next, out of these 300 employees, 220 employees, sir, were recruited for an expansion program means new joinings. Rest were recruited on existing employees. That is the replacements. So, number of new joinings 225 workers. Number of new joinings 225 workers. Next, number of replacements 300 minus 225, 75 workers. So details ready. Here 3 transactions arised. Separations arised, replacements arised, new recruits also arised. So now what they are asking. Sir, here 1 year equal to 1 year equal to 1 year equal to 365 days, sir. 1 year equal to 365 days. Okay, 1 year equal to 365 days. Next, calculate employee turnover rate replacement method. Employee turnover rate replacement method. Under replacement method, employee turnover LTR formula, number of replacements. Here number of replacements 75. Average number of workers equal into 100, 7.5. Under replacement method, LTR equal to 7.5%, sir. This is this rate applied to December month, sir. This rate is applicable for December month. But here question is asking equivalent annual employee turnover rate. Generally 1 month rate 7.5%. Hello, listen. 1 month rate 7.5%. Simply multiply with 12. 7.5 into 12. 90. But here 1 year equal to, suppose if there is no specific information about the days, in that case 7.5 into 12 is the right answer. Hello. Suppose if there is no specific information about the days, there is no information about the days. In that case 7.5 into 12, that is equal to 90% is the correct answer. But here clearly mentioned 1 year equal to 365 days. Then December month, please count the December month days. 31 days 7.5, then 365 days. Equivalent annual employee turnover rate. 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 For 31 days rate equal to 7.5. For 365 days rate equal to 31%. Suppose there is no information about the days of the year, then simple 7.5 into 12, 90%. 90%. Right. So next method, sir. Separation method. Separation method means number of workers left and discharged divided by average number of workers. 40 plus 60, 100. 100 by 1000 into 100, 10%. Equivalent annual turnover rate. 31 days, 10%. 365 days, question mark. 10 by 31 into 365. 117.74%, sir. 117 point. Next, sir. Flux methods. Flux methods means flux 1 and flux 2. Flux 1 and flux 2. Here, this is flux 1, sir. This is flux 1. Separations plus accessions. Separations plus. Sorry, this is flux 2, sir. This is flux 2. Accessions means it includes two elements. Replacements, new recruits. Replacements and this is not flux 1, sir. This is flux 2, sir. Flux 2. Flux 2 means three compositions. One is separations, replacements, new recruits. Replacements and new recruits, accessions. So answer 40%, sir. Right. Equivalent annual employee turnover rate to 40 by 31 into 360. So that is 470.9. 7%. Next, flux 1 method. Flux 1 method. So, labor turnover rate. Number of separations plus number of replacements divided by average number of workers. 100 plus 75 divided by 1000 into 100. 17.5, correct? Huh? So, 17.5 means separations 7.5. Replacements 7.5. Separations 10. 10 plus 7.5. 17.5, right. Now, equivalent annual employee turnover rate. 31 days, 17.5. 365 days, 206.05. Correct. So, employee turnover rate, second concept. Next, overtime concept. Next, employee cost recovery concept. So, that is very, very simple topics. Employee cost recovery means first calculate the annual employee cost rate. Annual employee cost rate. Then working hours into rate. Then charge the amount. Listen. Listen. Model 1. Model 1. Employee cost calculation. Model 1. Employee cost calculation. Already completed, sir, covered in CRD 1. All models. Percentage of premium in wholesale, percentage of premium in row 1. Next, the employee cost per piece under wholesale, employee cost per piece under row 1. Next, savings per piece under wholesale, savings per piece under row 1. Next, efficiency ratio on hours basis, efficiency ratio on, right? Next model. Second model, employee cost. Employee cost recovery from customer. Employee cost recovery from employee cost recovery. Next model, LTR, labor turnover rate. So, employee cost recovery. How to recovery the employee cost from customers, sir? Simple logic. Step 1, employee cost calculation. Suppose employee cost, for example, 300 rupees. For example, 1 day information. 1 day information. 1 day information, sir. 1 day information. Paid hours 8 hours. Hourly payment 7 rupees. 8 hours into 7. 56. Paid hours equal to 8 hours. Hourly payment equal to 7 rupees. So, employee cost equal to 56 rupees. Now, so timekeeping department reveals what information? Which information reveals? So, time spent in factory premises is 8 hours. That is paid hours, 8 hours. Hourly payment equal to 7. That is 56. Time booking department reveals time spent on each job. Time spent on each job. Suppose job A, job 4 hours, but job B 3 hours. 1 hour normal idle time. Give some examples for normal idle time, madam. Refreshments, lunch break. Next, traveling time from factory gate to factory premises. Traveling time, sir, from factory gate to factory premises. Next to time, refreshments, lunch break, usual lunch breaks. That is the examples for normal idle time. Normal idle time. So, normal idle time 1 hour. Therefore, effective hourly cost of an employee. Effective hourly rate of an employee. Effective hourly rate of an employee. Effective hourly rate of an employee equal to employee cost 56 divided by effective working hours. Effective working hours equal to paid hours minus normal idle time. Paid hours minus here paid hours equal to 8 hours. Normal idle time equal to 1 hour. Therefore 7 hours. 0. Correct, huh? Sir, employee cost recovery, sir. First calculate the employee cost. First calculate the employee cost. How to calculate employee cost? Paid hours into hourly rate. For example, company follows time rate system. Paid hours into hourly rate. Next, calculate effective hourly rate of an employee. Effective formula employee cost divided by effective working hours. Sometimes basic plus bonus plus DA plus other allowances, whatever it may be given by employer to the employee, simply add them, will get employee cost. Will get divided by effective working hours. Effective working hours means paid hours minus that for effective working hours will get effective hourly rate of an employee. Effective here effective hourly rate of an employee equal to 8. This rate is used to charge the wage cost to each job. This rate is used to charge the wage cost to. So here job A, how much wage cost to be charged, sir? 4 hours into 8, that is equal 3 hours into 8, 24, 32 plus 24, recover. Payment 56, recovery 56, complete. Sometimes job B 2 hours, 1 hour were lost due to sudden machine breakdown. Sudden. In that case, rate is same, 8 rupees. No impact on effective hourly rate. Reason, effective hourly rate formula same, employee cost divided by effective working. Paid hours minus now. Don't pass abnormal idle time, don't pass on to customer. So due to abnormal idle time, rate is not affected, sir. Same rate, 8 rupees. So first calculate the employee cost. Next calculate the effective hourly rate. Effective. While calculating the effective hourly rate, don't discuss the abnormal idle time. Don't discuss the only normal idle time eliminated. Only normal idle time pass on to customer. Only normal idle time pass on to customer. Don't discuss the abnormal idle time. First calculate the rate. First calculate the rate ready, 8 rupees. Now charge job A 4 into 8. 4 into 8, 32. 2 hours into 8. Abnormal cost of abnormal idle time. 1 hour into 8. 8 rupees. 1 hour into 8, 8. That time, these 3 models are very, very important for examination. Okay, so 3 chapters completed. Next to overheads. Listen. Overheads absorption costing method. Listen. Absorption costing method, another name traditional costing method. Another name conventional costing method. Conventional costing method. Anusha, absorption costing method means under this method, how to proceed. Under absorption costing method, we have to write the assumption. This is assumption based method. This is What is the assumption, sir? Total factory overheads moves with a single driver. Correct? Huh? In activity-based costing, total factory overheads can be identified different activities, then different drivers, then calculate different driver rates. But under absorption costing method, not like that. Total factory overheads moves with one driver. One driver. That is the basic difference between ABC and overheads. Zero. Under absorption costing method, total production overheads or total factory overheads varies with single driver. Varies with single driver. For example, company follows hours basis. In that case, driver name equal to hours. Suppose machine hours dominated, dominant factor machine hours, then take the machine hours. Machine hours. Machine hours has the driver name. Then write the assumption. Here machine hour rate is used to charge the overheads to the products. Reason, here we assume that total factory overheads varies with machine hours. Total factory overheads varies with so that machine hour rate is used to charge the overheads to the products. Only one rate. Clear? First, select the driver name. Select the driver name on hours basis, on cost basis, on output basis. Three models. Hours basis, cost basis, output basis. Here main thing in cost accounting, estimated overheads are charged, not actual overheads are charged. Only estimated overheads are charged. Why? Estimation means for controlling purpose. For controlling purpose, first we have to estimate the expenses. Then compare with actuals. Then arise under or over. Next investigation start. Next reasons. So therefore controlling purpose, for controlling purpose in cost accounting, overheads are estimated. Overheads are. So here estimation program on single driver basis. On in ABC multiple drivers. In absorption costing single driver. Clear? Huh? Okay. So here single driver either hours basis or cost basis or output basis. Suppose hours basis, machine hours assumption. We assume that total factory overheads varies with the machine hours, so that the machine hour rate is used to charge the overheads to the products. Suppose labor hours, we assume that total factory overheads varies with the direct labor hours, so that direct labor hour rate is used to charge the overheads to the products. Final destiny to charge the overheads to the products. So indirect cost, how to charge? By using the rate. Indirect cost, how to charge? By using the rate. By using the rate. So that rate is very, very important. So first driver name, first select the driver name, first select the driver name. That is already mentioned in the problem. Suppose calculate overhead rate on direct labor hours basis. In that case, driver name is direct labor hours. Suppose labor hour rate, suppose overhead rate on machine hours. Here driver name equal to machine hours. Sometimes calculate overhead rate on wage cost basis. Wage cost, that is cost basis. Sir, here important point. On cost basis, rate can be expressed in percentage. Rate can be expressed in percentage. Rate can be expressed in percentage. Is it clear? Now, okay, first rate calculation. First rate calculation. Calculation of overhead rate on given basis. On given basis. Second point, this rate is used to calculate absorbed overhead cost. Second, calculation of absorbed. So, absorbed factory overhead cost. Absorbed factory overhead cost. Absorbed factory overhead cost. Formulas are absorbed factory overhead cost rate into, suppose hours basis, actual hours worked. Output basis, actual output. Cost basis, actual wage cost incurred. Actual wage cost, suppose rate into actual hours worked. Actual hours. Akash, next. Next, ascertain the actual overhead cost incurred. Next, comparison. Under or over absorbed overhead cost. Under or. If actual overhead cost is more than estimated overhead cost, that is extra overhead cost. In costing language, under absorbed overhead cost. Under absorbed. If actual overhead cost is less than estimated overhead cost, that is over absorbed. Over absorbed. Suppose if it is under absorbed overhead cost. Under absorbed overhead cost. Under absorbed overhead cost. Next point, investigate the reasons. Investigate the, for example, under absorbed overhead cost, for example, 60,000, madam. 60,000. That is extra overhead cost incurred equal to 60,000. Extra overhead cost incurred equal to 60,000. Out of 60,000, 50% or 60%, 36,000 due to factory inefficiency. Due to factory inefficiency. Remaining 40% due to, 40% means 20, due to increase in overhead rates. Increase in overhead rates. 60,000 total. Extra amount incurred 60,000. Start the investigation. Reasons for under absorption revealed. One reason, 60% due to factory inefficiency. 40% due to increase in overhead rates. So 60% means 36,000. Treatment. Sir, script important, sir. Under absorbed overhead amount of 36,000 rupees on account of factory inefficiency shall be treated as abnormal. Shall be treated as factory inefficiency. Inefficiency means it is arising only in our company. So that is abnormal and thus be charged to costing profit and loss account. Entry costing profit and loss account debit to excess debit balance cancelled to credit. So excess debit balance here is 36,000. So cancel to credit. So to factory overhead control. So final entry costing profit and loss account debit to factory overhead control account. Factory overhead control account. Factory overhead control account. So factory overhead control account. Automatically cost records profits will be decreased by 36,000. Entry costing profit and loss account debit to factory overhead control account. So the above entry affects cost records profits will be declined by 36,000. Next, sir, 40% due to increase in overheads. Is it common to all companies? Yes, it is common to all companies. It is a normal thing. Then again charge it to production units. Again charge it to. How to charge? Again calculate rate. That rate is called supplementary rate. That rate is called supplementary rate. Supplementary rate. So supplementary overhead rate equal to, on the balance under absorbed overhead amount 24,000 divided by equivalent to production units. Equivalent to productions. So in our production details, some units are semi-finished, some units are fully completed. So semi-finished is converted into equivalent units. Then calculate the rate per equivalent unit. Rate per equivalent unit. Then journal entry. Cost of sale account debit certain amount. Finished stock account certain amount. Work in progress account certain amount. To factory overhead control account. So this is the very, very important model. Already discussed, sir. Next here, first point, this is calculation of overhead rate. So rate important, sir. Rate calculation. Overhead rate calculation very, very important. Sometimes factory having 2 production departments and 2 service departments. In that case, first prepare the primary distribution table. Next, prepare the secondary distribution table. After making the secondary distribution table, we'll get the total overhead cost of each production department. Total overhead cost of primary problems, only one production department, no service departments, only one production department, rate directly given, rate directly. Then rate directly given the problem, then calculate the absorbed overhead cost, then calculate the actual overhead cost, calculate under or over absorbed. Under or next reasons of treatment, very simple. In case factory premises having 2 production departments and 2 service departments, definitely first prepare the primary distribution table. Next prepare the secondary distribution table. After making the secondary distribution, then we'll get the total overhead cost of each production department. Then each production department overhead amount divided by each production department base. Then we'll get the rates. Then we'll get the rates. Production house contains two production departments, 2 service departments. Production house contains 2 production departments and 2 service departments. This is the manufacturing unit, sir. So manufacturing unit contains 2 production departments and 2 service departments. In this case, how to calculate overhead rates? First, step 1, we need to prepare primary distribution summary. After making the primary distribution, we'll get total overhead cost of P1, total overhead cost of P2, total overhead cost of S1, total overhead cost of S2. It includes 2 steps. One is apportionment of overheads. Second one is allocation of overheads. After completion of these 2 steps, we'll get total overhead cost of each department. Total overhead cost of. So the distribution of overheads to various departments is called as primary distribution. The distribution of overheads to various departments, that is called as primary distribution. It includes 2 steps. One is allocation of overhead cost. Second one is apportionment of overhead cost. Allocation means individual overhead cost elements directly charged to respective department, that is called allocation of overheads. common overhead cost elements distributed on a suitable base and then charge it to respective departments, that is called apportionment of overheads. Here one important note, in P1 department, direct cost and indirect cost, both elements are involved. In P2 department, direct cost elements and indirect cost elements both are involved. But in S1 department, here there is no production activity, so that whatever it may be incurred, simply indirect cost to the production department. Indirect cost to the... So in S1 department, material cost incurred, that is overhead cost. Labor cost incurred, that is overhead cost. Whatever it may be incurred in S1 department, simply treated as a overhead cost. Because here there is no production activity. S1 department rendering services to production departments. That's why here whatever it may be incurred, simply treated as overhead cost. Same like that S2. In S2 department, there is no production activity. So whatever it may be incurred, simply treated as overhead cost. So after making the primary distribution summary, we'll get the total overhead cost of each department. Our objective is to find out the rates of each production department. P1 department rate equal to P1 department total overhead cost divided by P1 department base. That is the driver name. Either hours basis or cost basis. In P2 department total overhead cost divided by base. Either hours basis or cost basis. So how to find out the P1 department total overhead cost? How to find out the P2 department total overhead cost? So that is the second distribution. So second distribution means redistribution of service department expenses to production departments. That is called second distribution. Redistribution of service department totals to production department. For example, after making primary distribution, P1 department total, for example, 10,000, P2 department total 12,000, S1 department total 5,000, S2 department total 6,000. After making the primary distribution, P1 department total 10,000, P2 department total 12,000, S1 department total 5,000, S2 department total 6,000. What next? Service department total overheads redistributed to production departments. That is called secondary distribution. This secondary distribution can be done by way of three methods. Secondary distribution can be done by way of three methods. Number 1, direct method. Number 2, stepladder method. Number 3, reciprocal method. First one, direct method. There is no services between the service departments. That means service departments are rendering services only to. So like this, here P1, P2, S1, S2. S1 department rendering services to P1, P2. S2 department rendering services only P1, P2. So please observe this diagram. S1 not providing services to S2, S2 not providing services to S1. So there is no services between the service departments. No services between the service departments. Is it clear? Next, here P1, P2, S1, S2. Here first observing the which service department providing services to more departments. For example, S1 department providing services 3 departments. S2 department providing services 2 departments. In this case, S1 is a portion first. Reason, here S1 department providing services to more departments, that is 3 departments. So S1 providing P1, P2, S2. S2 providing only P1, P2. So here observing the information, this diagram, only one side service between the service department. Only. So S1 providing services to S2, but S2 not providing services S1. This indicates stepladder method. This indicates no services between the service departments, direct method. Only one side service between the service departments, stepladder method. Next, both sides. P1, P2, S1, S2. S1 providing services to P1, P2 and S2. S2 providing services P1, P2 and S1. So here there is a cross service between the service department. There is a cross service between the, that indicates reciprocal method. That indicates reciprocal method. So here in direct method, directly distributed the overheads to production department. Reason, no services between the service department. So here S1 department total overhead cost. S1 department total overhead cost. S1 department total overhead cost is equal to, see this, only down arrow, only down arrow, down arrow, hyphen. So that means cost of providing service, cost of. So in direct method, service department total overhead cost indicates only down arrow. Down arrow means that is the cost of providing service. It is available in primary distribution table. So that amount is, for example, as per above example, S1 is 5,000. This amount shall be apportioned to P1 and P2 in a given ratio. In a given ratio. Next, S2 department total overhead cost. S2 department total overhead cost, sir. S2 department total overhead cost. That is down arrow. 6,000. 6,000 shall be apportioned to P1 and P2 in the given ratio. So finally we'll get P1 department total overhead cost, P2 department total overhead cost. Then divided with the driver, divided with the driver name. For example, hours basis, either mission hours or labor hours. Sometimes mission hours dominant, take the mission hours. Sometimes direct labor hours dominant, take the direct labor hours. So calculate the overhead rate. Calculate the step 1 completed, sir. Step 1 completed. Next, step 2, calculate absorbed overhead cost. Step 3, calculate actual overhead cost. Step 4, under or over absorbed overhead cost. Next, reasons for under or over absorbed overheads. Treatment. This is the direct method, sir. In stepladder method, first we can observe which service department providing services to more departments. That department shall be apportioned first. That department shall be apportioned first. Once down arrow, then that department close. The department close. Next, S2. So this is also very, very easy. Finally, we'll get total overhead cost of P1 and total overhead cost of P2. Then calculate the overhead recovery rates. Calculate the overhead recovery rates. P1 department total overhead cost divided by base. P2 department total overhead cost divided by base. This is the very, very important, sir. Reciprocal method. Reciprocal method means there is a cross service between the service departments. That means S1 providing services to S2, S2 providing services to S1. There is a cross service between the service departments. Here, one thing is observed. Total overhead cost of S1 department. Total overhead cost of S1 department. Down arrow plus up arrow. Down arrow plus up arrow. So here down arrow means cost of providing service. Here cost of providing service equal to 5,000. That is available. Next, up arrow indicates cost of receiving service from other service department. Cost of receiving service from other service department. For example, 5% of 5% of total overhead cost of S2 department. 5,000 plus 5% of total overhead cost of S2 department. 5% of total overhead cost of S2 department. So this is available in terms of percentage. This is available in. So now calculate total overhead cost. Total overhead cost of each service department. This can be calculated in two ways. One is equation approach, second one is trial and error approach. Here, first calculate total overhead cost of S1 department, total overhead cost of S2 department. S1 department, down arrow amount is available, but up arrow indicates in terms of percentage, that is 5% of total overhead cost of S2. Next, total overhead cost of S2 department, 6,000 plus, for example, certain percentage, 6% of total overhead cost of S1. So these two equations solved, then we'll get the overhead cost of S1 and overhead cost of S2. This is equation approach. This is the mathematical approach. Second alternative also exists. One is, second alternative is trial and error approach. Next one, suppose I am not interested to calculate the totals of each service department. In that case, directly distribute the service department rendering services. That means 5,000, next to 6,000. Continuously distributed up to 0. That is called repeated distribution method. Repeated distribution method. Under repeated distribution method, no need to calculate total overhead cost of each service department. No need to calculate total overhead cost of each service department. Directly distribute the cost of providing service. Directly distribute the cost of providing services. Cost of providing services to each department. Up to 0. Up to 0. So that is repeated distribution method. In the examination, suppose there is no specific information. In that case, please prefer the equation method that is developed by simultaneous. So simultaneous equation method. Simultaneous, most of the cases, that means 99.99%, simultaneous equation method is the best method. Rare cases, repeated distribution method or trial and error method. But most of the cases, for example, past 10 years, please observe the papers, only simultaneous equation method. So frame the equations, solve the equations, find the total overhead cost of S1, total overhead cost of S2, and distribute, and then distribute that. Then we'll get total overhead cost of P1 and total overhead cost of P2. So here main objective to find out the rates of each production department. To find out the rates of each production department. Okay. Now, so in this scenario, allocation is very easy, but apportionment base selection important. Apportionment basis selection important. For example, canteen expenses. All 4 departments canteen expenses 10,000. This is the common overhead cost elements. Definitely select the base. Canteen expenses, on what basis it is apportioned to all departments? Number of employees. Number of canteen services received for all employees in all departments. So here base is equal to number of employees. Number of employees. For example, miscellaneous expenses in all departments. In that case, direct wages. Direct wages. Next, perquisites. Perquisites. Sometimes employer provide to employees some perquisites. That is based on direct wages. That is based on perquisites, miscellaneous expenditure. Miscellaneous expenditure, direct wages. Perquisites, direct wages. General expenses also direct wages. These 3 very, very important. Other mission expenses, simply known as other expenses. Other expenses is a portion on what basis? That is mission hours basis. That is mission hour. So these 4 are very, very important. Other expenses, miscellaneous expenses, perquisites, general expenses. Perquisites, general expenses miscellaneous expenses based on direct wages. Next, other expenses means other mission expenses. This amount is apportioned on what basis? Mission hours basis. Mission hours basis. Next important thing, power expenses. Generally, power expenses is apportioned on kilowatt hours basis. Kilowatt hours basis. Sometimes kilowatt hours not directly given. In that case, calculate the kilowatt hours. Horsepower of the machine into machine working hours. Horsepower of the machine into machine working hours. Sometimes horsepower given, machine working hours not given. In that case, select the horsepower. Select the horsepower. If there is no specific information about the machine working hours, in that case, select the horsepower of the machine. Select the horsepower of the machine. So these are the very, very important. Right. Now, select the problem. CRD1 overhead chapter. Listen. CRD1. Sir, Sanji Limited is a manufacturing company. Here manufacturing unit consists of 3 production departments, namely A, B and C, and 2 service departments, namely X and Y. The following is the budget for December 2011. That definitely company provides either past experience or budgeting information. This information can be used for calculating the overhead rates. Rates can be calculated either from past experience or budgeting information. Here budgeting information provided. Sir, here direct material cost of A, it is a part of prime cost. Direct material cost of B, it is a part of prime cost, because these 3 production departments. In production department, direct elements, nothing but it is a part of prime cost. These 2 service departments. In service departments, there is no production activity, so that whatever it may be incurred, simply treated as. So this is overhead cost. This is also overhead cost. So direct material cost of service department X treated as a overhead cost. Direct material cost of service department Y treated as overhead cost. Next, direct wage cost. So these 3 part of prime cost. These 2 treated as overhead cost. Next, factory rent. Factory rent 4 lakhs. This is the common overhead cost elements. For all 5 departments, rent paid equal to 4 lakhs. Rent amount equal to 4 lakhs. So on what basis it shall be apportioned? Area. So area information provided, sir. 251s, 252s, 252s, 251s. So final 2 is to 1 is to 2 is to 2. Next, power. Sir, here machine hours provided, horsepower provided, sir. So multiply, then we'll get kilowatt hours. Take the ratio. Next, depreciation. Depreciation on the calculate on value of asset. Here value of asset provided. Value of asset provided. So 20, 10 ones, 10 ones, 10 twos, 10 fours. So 2 is to 4 is to 2 is to 1 is to. Sorry. 2 is to 4 is to 2 is to. So next to other overheads. Mission hours. This is the very, very important. Other expenses. That means other mission overheads or other mission expenses. Other mission expenses based on mission hours. Mission hours. So 1 is to 2 is to 4 is to 1 is to 1. Now, see the primary distribution table. Sir, direct material direct material of X 2 lakhs, Y 1 lakh. So this is total 3 lakhs. Direct wages 3 lakhs. After making the primary distribution summary, Department A overhead cost 2 lakhs 70, Department B overhead cost 3 lakhs 70, Department C 6 lakhs, 4 lakhs 75, 5 lakhs. This is primary distribution. So primary distribution means the distribution of overheads to all departments, to various departments. That is called primary distribution. It includes 2 steps: allocation and apportionment. After making the primary distribution summary, A department overhead cost 2 lakhs 70, B department overhead cost 3 lakhs 70, C department 6 lakhs, X department 4 lakhs 75,000, Y department 5 lakhs 35,000. Okay, next, a statement showing distribution of overheads to various departments completed, primary distribution. Next, B bit, sir. A statement showing redistribution of service department expenses to production departments using simultaneous equation method. Simultaneous equation method. Simultaneous equation method. That means here relation between service departments, cross service, definitely. See this information. A technical assessment of the apportionment of expenses of service department expenses is as under. Here X down arrow, A receiving 45, B receiving, C receiving, Y receiving. Next, Y down arrow, A receiving, B receiving, C 0. Next, X 5. So observing these two, relation between service departments, there is a cross service between the service department. X providing services to Y 10%, Y providing services to X. That is main important. The relation is cross service. No service indicates direct method. One side service indicates stepladder method. Both sides reciprocal method. Under reciprocal method, definitely calculate the total overhead cost of each service department, either equation method or trial and error method. Sometimes question is asking repeated distribution method. Repeated? So repeated distribution method advantage, no need to calculate totals of each service department. Directly distribute the cost of providing service up to 0. But here clearly mentioned, this is simultaneous equation method. So frame the equations. Frame the equations. X equal to service department, X equal to down arrow amount, sir, down arrow. Here down means down arrow means cost of providing service 4 lakhs 75,000 plus receiving service, sir, 5% of total overhead cost of. So simply 5% of Y. Next, Y equal to down arrow cost of providing service 5,35,000. 5,35,000. Next, receiving service. 10% of total overhead cost of. These are the equations. Equation very, very important, sir. So here first round of this one, down arrow amount available in primary distribution 4,75,000, up arrow 5% of Y, 5% of Y. Next, Y round of Y down arrow amount taken from primary distribution 5,35,000. Next, receiving service equal 10% of X. Now solve 1 and 2 equations. 1 and 2 equation. This is the first equation. This is second equation. Solve 1 and 2 equations. 1 and 2 equations. X equal to 4,75,000 plus 0.05. 5% means 0.05. Y equation 5,35,000 plus 0.1x. 0.1x. 1x 4,75,000. 0.05 into 5,35,000. 2 lakhs. Only 26,000. 26,750 plus 0.005x. 1x minus 0.005x. 0.995x is equal 4,75,000 plus 26,750. 5,01,007. So X equal to 5,01,750 divided by 0.995. 5 lakhs. This is the total overhead cost of X department. Total overhead cost of. Next, substitute X value in equation 2. So in equation 2, Y equal to 5,35,000. 5,35,000 plus 10% of 5,04,271. So final conclusion 85,420. Completed, sir. X value ready, Y value ready. So first we have to find the totals, either equation approach or trial and error approach. If there is no specific information in the problem, please follow the simultaneous equation approach. Completed. Now prepare the secondary distribution summary table. This is the secondary distribution summary table. So first, as per primary distribution values, start with the primary distribution values. After making the primary distribution, A department total overhead cost 2,70,000, B department total overhead cost 3,70,000, C department 6 lakhs, X department 4,75,000, Y department 5 lakhs. Now here X value, sir, total overhead cost of X 5,04,271. This is a portion on what basis, sir? Here clearly mentioned. X providing services A, B, C and Y. 45 is to 15 is to 30 is to 10. These are the values. So 2,26,922, 75,641, 1,51,281, 50,427. Next, Y value. Here Y value, sir, 5,85,427. So it is a portion in the given ratio. Here given ratio, sir, 60 is to 35 is to 0 is to 5 is to 0. Right. So 60% charge to A, 35% charge to B. 0%. Next to 5% charge to X. So here please observe 4,75,000, 29,271 summation nothing but 5,04,271. So that is the plus value minus value cancel. That is called nil. Here also plus value minus value cancel nil. So after making the second distribution summary, service department totals becomes 0. Finally, we'll get to only total overhead cost of each production department. A, total overhead cost 8,48,178. B, 6,50,541. C, 7,51,281. Ready. Totals ready. Now calculate the rates. Overhead rates for A, overhead rates for B, overhead rates for C. So these rates are used to charge the overhead cost to respect to jobs. These rates are used to charge the overheads to respect to products. Respect to products. So this is the second bit. Next, third one. Mission hour rate, sir. Mission hour rate formula, sir. Overhead cost divided by budgeted mission. Here mission hours available, sir. Mission hours 1,000 hours, 2,000 hours, 4,000 hours. Here second distribution totals ready. Divided with 1,000 hours. Divided with B, mission hours 2,000 hours. C, 4,000 hours. So answers, so that is the mission hour rates. Answer 848.2 178. Next 325 point. Next 7,51,281 divided by 4,000. That is the 187.8. So this is the primary and secondary. Clear? Next, mission hour rate, sir. Sometimes first segment in overhead chapter 2 parts. First part primary, secondary. Second part mission hour rate. Definitely one question has given in this segment. So this is the mission hour rate. Mission hour rate for mission shop. Mission hour rate for mission shop. Mission hour rate for mission shop. Next, going to mission shop. So what is the specialty, sir? Total production activity shall be completed in mission shop. Here there is no departments. Previously, product manufacturing unit consists of production departments and service departments. But mission shop, total production activity shall be completed in mission shop. Only one department. That is the mission shop. Mission shop contains missions. Mission shop contains missions. For example, mission shop contains one mission. Mission shop contains one mission. Here, calculate comprehensive mission hour rate. Comprehensive mission hour rate means not only mission expenses but also consider mission shop expenses. That is called comprehensive mission hour rate. While calculating the mission hour rate, both expenses are considered. Mission expenses and mission shop expenses. That rate is called as comprehensive mission hour rate. Only mission expenses considered. That is called direct mission hour rate. But for the examination purpose, no use of direct mission hour rate. Always prefer comprehensive mission hour rate. For example, in the examination, question is asking calculate mission hour rate. Please do the comprehensive mission hour rate. Please do the comprehensive mission hour rate. Comprehensive mission hour rate means here two elements are considered. Mission expenses and mission shop expenses are considered. One important point here, Apparatus wages. Without operator, machine cannot be worked. Without operator. So student generally says, sir, without operator, machine cannot be worked. Operators are direct workers. Yes, exactly, direct workers. Payments to direct workers is nothing but direct wages. Okay, exactly, direct wages. But here, calculating the comprehensive machine overhead, that element also considered, that element also included. Once this element included in comprehensive machine overhead, no need to show in the prime cost area. No need to show in the. So presently, I am doing the comprehensive machine overhead model, sir. So total surrounding expenses are considered. Total surrounding expenses are considered. Once operators wages included in machine overhead, no need to show in the prime cost. No need to show in the prime cost. So while calculating the machine overhead, expenses can be classified into two types. One is fixed expenses. Second one is variable expenses. First one is fixed expenses. Second one is variable expenses. Here variable expenses, so number one, depreciation on a machine on running basis, not periodic basis, on running basis. Running basis means machine lifetime expressed in hours. In that case, depreciation calculated on hours basis. Depreciation calculated hours basis. That is variable. So depreciation on machine on running basis. Number two, power consumption on machine running purpose. Next, stores and spares or consumable stores. Next, special chemical solution. Next, special chemical solution. Last one is repairs and maintenance. Repairs and maintenance. So, repairs and maintenance, special chemical solution, consumable stores or stores and spares, power, depreciation on machine on running basis. Except these five, remaining all included in fixed expenses. Including fixed expenses. So, for example, fixed expenses examples: insurance charges on machinery, rent paid on machine occupied area, rent paid on machine occupied area. Next, operators wages. Next, lighting charges, machine shop lighting charges, machine shop lighting charges, machine shop maintenance charges, cleaning and maintenance. Next, depreciation on machine on periodic basis. On periodic basis, all these expenses are added. Then we'll get fixed and variable. We'll get total expenses. Total expenses. For example, expenses collected for 1 month, denominator also take for 1 month. So total expenses per month divided by machine working hours per month. Then we'll get the comprehensive machine overhead. Comprehensive. So generally machine overheads two types: direct machine overhead, comprehensive machine overhead. But always prefer comprehensive machine overhead. Okay. Comprehensive means not only machine expenses and also machine shop expense. Two elements are considered. Two elements are considered. Take the CRD2. CRD2, sir. Right. Listen. Sir, a machine costing 10 lakhs. Machine costing 10 lakhs. A machine costing 10 lakhs. Purchased on April 1st, 2021. Sir, expected life in hours or in years, sir? Here, expected life expressed in years. At the end of this period, scrap value is likely to be 10,000. 10,000. So, finally, depreciation on periodic basis. Next, the total cost of all the machines, including new one, was 90 lakhs. Sir, here there is a doubt, sir. Here, machine shop contains already some machines. So, existing machines value, sir, 80 lakhs. If new machine is added, value of all machines equal to 90 lakhs. The total cost of all machines, including new one, 90 lakhs value. That means existing missions value 80 lakhs, new one value 10 lakhs, total 90 lakhs. Then question arises, sir, mission hour rate for new mission or mission hour rate for all missions? So here clearly mentioned, compute mission hour rate for the new mission. In case there is no specific information, simply calculate mission hour rate. In that case, prefer the new mission. If there is no specific information, in that case, please prefer the mission hour rate for new mission. But here clearly mentioned mission hour rate for new mission. So please collect the expenses for new mission. Please collect the hours for new mission. So A by B, nothing but mission hour rate. So this mission hour rate is nothing but comprehensive mission hour rate. It includes two elements, mission expenses and also mission shop expenses. Okay. Next. Working hours of the mission for the year was 4,200, including 200 non-productive hours. So that is the normal idle time, or that is mission setup time, or mission. So that is the 200 hours. So effective running equal to, effective working equal to 4,000 hours. Working hours of the mission for the year 4,200, including 200 non-productive hours. For example, non-productive hours here, there is no specific information. Non-productive means that is the normal idle time. Normal idle time examples, usual tea breaks, next to traveling time from factory get to work premises. These are the examples. So finally here effective working hours equal to only 4,000 hours. Generally non-productive time means normal idle time. Non-productive time means normal. So effective working hours per year, sir. Denominator per year, sir. So denominator 4,000 hours per year. So please take the numerator also per annum. So depreciation on mission calculate on periodic basis. So new mission cost 10 lakhs. So scrap at the end of its life 10,000. 10 lakhs minus 10,000 divided by lifetime 10 years. 99,000. Next, repairs and maintenance for the new machine directly given 6,000 per year, sir. Next, insurance premium was paid for all the missions. All the missions value, sir. All the missions value 90 lakhs. All the missions value premium 9,000. But presently mission hour rate for new mission. So please consider new mission insurance premium. New mission value 10 lakhs. 90 lakhs premium 9,000. 10 lakhs premium equal to 1,000. Next one, sir. New mission consumes 8 units electricity per hour. 8 units electricity. So power consumption only in running time. Power consumption only in. So here running time equal to 4,000 hours. Running time equal to. So electricity consumption in units equal to 4,000 hours into 8 units. 32,000 units. Tariff rate per unit equal to 3.75. Multiply 1,20,000. 1,20,000. Next, the new mission occupied area 1/10 of the area of department. Rent of the department, sir, 2,400. Please take 1/10. 240 into 12. 2,880. Now add them. Total 2,28,000 divided by 4,000 hours. This is on 57 point. That means 1 hour machine running in the factory estimated overhead amount equal to 57.22. 1 hour machine running in the factory estimated overhead amount equal to 57.22. So this is the mission hour rate. Okay. So Next chapter, sir. Standard costing. Right. Standard costing. Right. So, in previous two papers, standard costing question definitely given, sir. 10 marks question. Last time, part 2. Before last time, part 1. For example, this question will given in part 1. Happy. Reason, MCQs. In case of part 2, definitely do the script work. So that is very, very important, sir. Now, procedure. What is the objective of standard costing? Check that. Cost controlling through variance analysis. The main objective of this technique is cost controlling through variance analysis. Variance analysis. Right. Variance analysis means difference between standards and actuals. So variance analysis means difference between standards and actuals. Standards and actuals. Difference between standard cost and actual cost is nothing but variance. What is the meaning of standard cost? Standard cost means it is a predetermined cost. 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 It is used for to ascertaining the standard cost for actual output. It is used for to ascertaining the standard cost for. So standard cost is very useful for calculating the variance analysis, and also is used for to fix the selling price per unit. So standard cost nothing but it is a predetermined cost. It is used for cost controlling through variance analysis, and also fix the selling price. Now, so find out the ascertainment of standard cost and ascertain the actual cost. Will get total cost variance. So first actual output revealed, then start the variance analysis. That means variance analysis completely depends on actual output. Actual output revealed, then start the program. There is no output, there is no variance analysis. Output release, then start the variance analysis. Suppose today output 0, no work. Suppose today output is 100 units, then start the work. Ascertain the standard cost for 100 units. Next, actual cost incurred for 100 units. Take the difference, that is called variance. Today output value 0, there is no variance analysis. Output value 100 units, then start the work. ascertain the standard cost for 100 units, ascertain the actual cost for 100 units, then take the difference. That is called variance. That variance includes 3. Certain amount due to material cost variance, certain amount due to labor cost variance, certain amount due to overhead cost variance, certain amount due to overhead cost. So total cost variance includes 3 variances. Certain amount due to material cost variance, certain amount due to labor cost variance, certain amount due to overhead cost variance. So now total cost variance, total cost variance, total cost variance 3. Certain amount due to material cost variance, certain amount due to labor cost variance, certain amount due to overhead cost variance. Out of these 3, overhead cost variance is very, very important. Material cost variance, labor cost variance also important, but comparatively overhead cost variance is very, very important. Now, material cost variance. It is the deviation between standard material cost for actual output and actual material cost for example, here actual output equal to actual output equal to 100 units. Actual output equal to, today actual output is 100 units. Then start the variance. For this output, material work should be completed in this amount. For this output, material work should be completed in this amount. That is called as standard material cost. That is called as, suppose here standard material cost, standard material cost, that is SQ into SP, SQ into SP. For example, standard material cost SQ into SP. Here SQ into SP, SQ means standard quantity required for actual output. Standard quantity required for SP means standard price multiplied, then we'll get 10,000 rupees. Then we'll get 10,000. Next, compare with the actual material cost. Actual AQ into AP, that is equal, for example, 12,000. Take the difference, 2,000 advance. So as per company experience, material work should be completed in 10,000, but actually incurred in 12,000. So the difference is equal to 2,000. That is the material cost variance. Here symbolically material cost variance equal to SQ into SP minus AQ into AP. AQ into AP. So 2,000 adverse. So it includes 2. Certain amount due to rate changes, certain amount due to usage changes. Usage. So in material cost variance, main important thing in material cost variance, certain amount due to changes in prices. Changes in prices. Certain amount due to changes in quantity. Changes in quantity. Usage quantity. Changes in usage quantity. Usage quantity. Usage quantity. So cost variance, material cost variance, 2,000 adverse. Certain amount due to changes in prices, that is called material price variance. That is called changes in usage quantity, that is called material usage variance, or also called as material quantity variance. Material quantity variance. Suppose if company uses more than one raw material item, in that case mix variance and also yield variance exist. Suppose if company uses single raw material item, in that case only 3 variances: material cost variance, material price variance, material usage variance. Suppose if company uses more than one raw material item, definitely material mix and material yield variance. Material mix and material yield variance. Material mix and material yield variance. So finally, material variances 5. Material cost, certain portion due to changes in prices, certain portion due to changes in usage quantity. This is price variance. This is usage variance. Price variance, usage variance equal to cost variance. Next, check. Here, two materials concept or single material concept? Here, more than one material concept. So, here more than one material is used. Then, calculate mix variance and material yield variance. So, in usage variance, certain part mix variance, certain part mix variance plus yield variance equal to material usage variance. So, finally, 5 variances. Cost, price, usage, mix, yield. So, formulas are through graph. So, material work should be completed in this cost SQ SP. Material work should be completed in this cost SQ SP. But actually incurred in this cost AQ AP. AQ AP. So sit on x-axis in the frame. Take the formula. Material cost variance, sir. Sit on x-axis in the frame. This is the frame. This is the frame. Sit on x-axis in the frame. Left movement, sir. SQ SP minus AQ AP. AQ AP. So this is the total material cost variance. Total material. In that part, some part due to changes in prices, some part due to changes in usage. Now separate that. Now separate that. Separate that. So price changes. This is the price changes. This is the price part. So this is the flag. This is the flag. This is the material price variance. So material price variance sit on x-axis at EQ. So this is the flag. Formula AQ into SP, AQ into AP, AQ into SP minus AQ into AP, AQ into AP, AQ into AP. Next, remaining box. This is usage. This is usage. Material usage variance. Sit on x-axis in the box. Box corner, sir. SQ minus AQ of SP. So 3. One is frame. Second one is flag. Third one is box. In the frame, SQ SP minus AQ AP. That is material cost variance. Next, price changes separated. That is flag. Sit on x-axis at AQ. Single pole. AQ into SP minus AQ into AP. Next, box. Box. That is usage changes. That is indicates box. So box corners. Left corner SQ. Right corner AQ. SQ minus AQ of SP. So final SQ into SP minus AQ into SP. AQ into SP. Now next box divided into two parts. Certain part RSQ. RSQ means actual quantity rewritten in standard proportion. RSQ means actual quantity rewritten in RSQ means actual quantity rewritten in standard proportion. Rewritten in standard proportion. Standard proportion. So this is material mix variance. This is material yield variance. So material mix variance formula, sir. This is the another box, small box, corners, RSQ minus AQ of SP. RSQ minus AQ of SP. RSQ into SP minus AQ into SP. Next, yield variance box. SQ minus RSQ into SP. SQ into SP minus RSQ into SP. This is the formula segment, sir. So here procedure important, sir. First point, setting up of standard cost for 1 unit output. This information always available in the question. So read the question, check the experience. Sometimes experience provided for 1 unit, sometimes experience provided for 10 units, sometimes experience provided for 100 units. Okay, so that information very important. Reason, next step, second step, ascertain the standard cost. Ascertain the standard cost for actual output using that information, using that experience. So from that experience, calculate the standard cost for actual output. Next point, ascertain the actual cost for actual output. Next point, variance. Next point, variance. So first one, setting up of standard cost for 1 unit output. That information always available in the problem. Read the problem, take the experience. That experience is very useful for calculating the second step. Second step is ascertain the standard cost for actual output. Next step, ascertain the actual cost for actual output. Take the deviation. That deviation is calling as variance. The deviation is calling as variance. So this is the problem number 1, sir. CRD 1, listen. CRD 1. So first, standard mix to produce 1 unit of product is as follows. That means here experience provided for 1 unit or 100 units or 10 units. Here experience provided for 1 unit, sir. 1 unit. Suppose actual output is also 1 unit. In that case, this is SQ, this is SP, this is SQ into SP. Clear? Sir, here experience provided for 1 unit. In case actual output is also 1 unit, immediately these values denoted by SQ, price denoted by SP, multiplication denoted by SQ into SP. But bad luck here, actual output not 1 unit, sir. Actual output, sir, 10 units. Actual output, sir, 10 units. This is main important. Sometimes experience 10 units, actual output is also 10 units. In that case, dead easy. But here experience provided for 1 unit, actual output is 10 units. Then here definitely calculate SQ values. Definitely calculate SQ values. So here 1 unit standard, sir. X 60 units, Y 80 units, Z 100 units. That means 1 unit output required 60 units of material X plus 80 units of material Y plus 100 units of. That means here 1 unit output requires more than 1 raw material item. More than. In that case, definitely calculate mix variance and yield variance. Mix variance and. So this information very important. Read the problem thoroughly. So here experience provided 1 unit or 10 units or 100 units, 1 unit. In case actual output is also 1 unit, immediately that value is denoted by SQ, SP, SQ into SP. But here not 1 unit actual output. Here actual output is 10 units. Use that information, calculate SQ values for 10 units output. Calculate SQ values for. Here SQ values available only 1 unit. Now convert it into SQ values for. That is the main work. That is the main work. That is main work. Here SQ values available for 1 unit, but actual output is 10 units. Then immediately SQ values convert into 10 units. Right. Now Sir, 60, 1 unit 60. For 10 units, 6. 1 unit 80 units. For 10 units, 1 unit 100 units. For 10 units, that is SQ value. In case actual output is also 1 unit, no need to conversion. Directly denoted by SQ. Next point. SP values. Happy, directly available, always available. SP values. SQ into SP. Multiply. Then standard material cost for actual output. Standard material cost for actual. Next, here one more important thing. Standard proportion is very, very important. Standard proportion of metal mix. Here standard proportion of metal mix, sir. 60, 80, 100. Summation 240. Summation 240. 60 divided by 240 into 100. 25%. 80 divided by 240. 33.33%. Next. 41 point. This is called standard proportion of metal mix. Standard proportion of. Next, here actual proportion of metal mix. Please calculate summation. Summation 640, 950, 870. 2000. So 640 divided by 2460 into 100. 20. Next one. 38.61. 61 62. 62%. Next. 6. This is 61, 37%. 35.37. So 26.1%, 38.62, 35.37. So please observe, this is the actual proportion of metal mix. This is the standard proportion of metal mix. Standard proportion of metal mix is not equal to actual proportion of metal mix. Therefore, mix variance exists. In this problem, mix variance exists. In some cases, both are same. In that case, mix variance 0 answer. Mix variance 0. Standard proportion of metal mix is equal to actual proportion of metal mix. Both are same. In that case, metal mix variance answer 0. Clear, sir? Right. So, standard proportion of metal mix is not equal to actual proportion of metal mix. Therefore, mix variance exists. Mix variance exists. Next. Here, now calculate the all variances. Calculate all variances. Next, yield variance interpretation, sir. Percentage of standard loss is not equal to percentage of actual loss. Therefore, yield variance exists. Yield variance exists. So, now here calculate all material variances. 3 or 5? 5. Reason? Here more than one raw material is used. More than one. Now, calculate. Listen. Now, calculate one by one, sir. Particulars. Standards. Ascertainment of standard material cost for actual output. Here, actual output, sir. 10 units. 10 units. Subcolumns SQ, SP, SQ into SP, SQ into SP. Sir, material names. Raw material names XYZ, XYZ. Listen. Z. Right. Standard proportion of metal mix 25%. 33.33%. 41.67%. 41.67%. Now, sir, here experience provided for 1 unit, but actual output not 1 unit, sir. Here actual output is then converted. So 1 unit 60, 10 units 600. Next 800. Next 1000. Total input, sir. 2400. Now 15, 20, 25. So 600 into 15. 9. Next 16,000. Next summation Y0. Check the interpretation. Check the. Sir, for this output, material work should be completed in 50,000. For 10 units output, material work should be completed in 50,000 rupees. Next, actual. Sit down. Actuals for 10 units. Actuals for 10 units. AQ, AP, AQ into AP. Listen. AQ into AP. Sir, actual usage quantity directly given, sir, is always directly given. 640 units. Next. 950 units. 870 units. 870, correct? 2000. Sir, previously for 10 units output, just 2400 input is used. Currently, extra input is used. So, if in case extra input is used, that is yield variance is adverse. Yield variance is. So, yield variance shortcut method, sir. Here extra input is used 60 units. Am I right? Extra input is used 60 units. 60 units into input cost per unit. 50,000 divided by 2,400. 50,000 divided by 2,400. 20 into 60. 1,000. 1,250 adverse. 1,250. Simple. Here extra input is used. How much extra input is used, sir? 60. Input cost per unit, sir? 20 point. So, extra input value is nothing but yield variance. So, here 20.83 into 60. Answer 1,250 is the yield variance. 1,250 is the yield variance. Right. Next. AP, sir. Actual price 17.518. 27. 640 into 17.5. Next. 920. 52,000. Sir, previously for 10 units output, material cost amount is 50,000. Presently, cost incurred equal to 52,225. Extra cost amount incurred 2,225. This is called material cost variance. This is called material. Check the answer. 2,225 adverse. Already 2 variances completed, sir. Suppose this question is given in part 1 as MCQ. In that case, very easy. Yield variance, cost variance completed. Next one. Price variance, sir. I will check the price variance. Price variance means deviation between actual usage quantity as per previous rates, actual usage quantity as per current rates. Actual usage quantity as per current rates value 52,225. Next, compare with actual usage quantity with previous rates. Actual usage quantity as per actual usage quantity as per previous rates. Actual usage quantity as per previous rates. AQ into SP. 640 into 15. 9,600. 950 into as per previous is 20. 19. 19. Next. 750. Summation. 50,000. Sir, as per previous rates value 50,350 sir, but current rates value 52,225. Here prices increased sir. Prices. Therefore price variance adverse. Price variance as per old rates value is 50,350. As per new rates value is 52,225. So here prices increased. So amount, extra amount 1,000. 1,875 adverse. 1,875 adverse. Usage quantity as per old rates, usage quantity as per current rates. Clear? Next. Next one, sir. RSQ. RSQ means actual usage quantity in standard proportion. Actual usage quantity in 2460. Actual usage quantity. How to use standard proportion? 25%, 33.33%, 41.67%. So how to use this 2460? Write down. So RSQ means actual usage quantity re-rated in standard proportion. Re-rated in. So as per company experience, how to use 2460? 25% of 2460. 61. 33.33% of 2460. 8. Next. 10. Sir, as per company experience, as per company past experience, how to use 2460? 615 units, 820 units of Y, 1025 units of Z. But in reality, not like that. In reality, X 640, Y 950, Z 870. Therefore, mixed variance confirm. Therefore, mixed variance confirm, sir. Mixed variance confirm. So mixed variance means deviation between actual quantity in standard proportion and actual quantity in actual proportion at standard price. Actual quantity in standard proportion. Here actual usage quantity 2460. How to use as per company experience 615, 820, 1025. But in reality not like that. 640, 950, 870. There is a difference. That difference multiply with the standard price. Then we'll get mixed variance. Then we'll get suppose in case percentage are both are same. That means standard proportion percentage, actual proportion percentage both are same. In that case, no need to calculate mixed variance. Directly mixed variance 0. Clear out. So RSQ into SP. 9,220. Next. 16,000. Okay. 25,000 amount. 25. So here in this diagram, this is the diagram. Mixed variance. Mixed variance. RSQ. That is actual usage quantity. How to use. Actual usage quantity. How to use as per company experience. In reality, not like that. So that is the AQ. So RSQ AQ difference multiply with the SP. RSQ minus AQ of SP. Box. Take the corners. RSQ minus AQ of SP. RSQ into SP minus AQ into SP. Here RSQ into SP sir 51,250. 51,250. 51,250. Next, AQ into SP 50,350. Answer 900. Check the answer. Correct? 900 favor. Next, yield variance. Yield variance shortcut method. Here extra input used. 60 into input cost per unit. Multiply 1250 adverse. Sir, extra input means adverse, sir. Sometimes input saving into input rate, input cost rate, that is favorable. That is, but here a formula, yield variance box, take the yield variance box corners, SQ and RSQ difference into SP, SQ minus RSQ of SP. Box formula dead easy, left corner minus right corner of SP, SQ minus RSQ of SP, SQ into SP minus RSQ into SP, SQ into SP value 50,000 minus 51,000, answer 1,250, 1,250. In case if it is given in MCQ, don't take the formula, directly mention. Next, last one. Price variance completed, cost variance completed. Usage variance, sir. Usage variance SQ into SP, sir. 50,000 minus AQ into SP. 50,000, answer 350 completed. 350 adverse completed. Main important to experience. Please check the experience. Your experience provided for 1 unit. Sometimes experience provided for 5 units. Experience provided for. Ashrit, for suppose in the examination, standard mix to produce not 1 unit. This is 5 units. In that case, SQ values. Suppose this information, this standard mix information, this is the experience. Experience provided for 5 units. 5 units output required 60 units of X, 80 units of Y, 100 units of Z. In that case, calculate SQ values. But 120, wrong answer. Checker there, for suppose this experience related to 5 units, not 1 unit, 5 units. In that case, how to calculate SQ values? Next. Madam, this standard mix to produce 5 units of product is as follows: 60 units of X, 80 units of Y, 100 units of Z. Now calculate the SQ values for 10 units. 120, 160, 120, 160, 200. Ask it correct, huh? Now I am calculating, sir. Sir, here 5 units output required 60 units. Am I right? 10 units required question mark. 60 by 5, 60 by 5 into 10. 1. Next, 80 by 5 into 10. 160. 100 by 5 into 10. Correct answers. That is SQ values. Sit down. Lucky fellow. So 120, 160, 200. 120, 160, 200. For example, right? Ashrit. For example, given experience related to 2 units output. 60 by 2 into 10. 300. Next 80 by 2 into 10. Thank you. So this is CRD 1, right? Listen. Next to labor variances, sir. Listen. In labor variances, 2 segments are there. Actual paid hours equal to actual paid hours equal to actual working hours model. That means no idle time. No idle time. Actual paid hours equal to actual working hours. There is no idle time. Next, actual paid hours not equal to actual working hours. That is, there is an idle time. There is an idle time. There is an idle time. This is simplest method. This is the no. There is no idle time. Listen. Actual paid hours equal to actual working hours. Here, actual paid hours, actual working hours, both are denoted by AH. Actual paid hours equal to actual working hours. In that case, both elements are denoted by AH. But actual paid hours not equal to actual working hours. In that case, paid hours denoted by AH, working hours denoted by AWH. First, we have to discuss first model, sir. No idle time model. So that means idle time nil. In that case, chart, sir. In that case, chart. Listen. Chart. Labor work should be completed in this cost. Labor work should be completed in this cost means SH, SR. But actually incurred AH, AR. Right. Sir, sit on x-axis in the frame. Take the left movement and next the right movement. SH into SR minus AH into AR. AH into AR. Right. Next, total changes can be divided separately. Certain part rate changes, certain part efficiency levels. So, rate changes, sir. Rate changes. Rate changes. Again from the flag. So, rate changes, nothing but labor rate variance. Labor rate variance. Sir, sit on x-axis, set flag, sir. AH into SR minus AH into AR. Same logic, sir. Previously, AQ, AP, SQ, SP, AQ, AP. In place of Q, H. In place of P, R. That is the difference. Same logic. So, due to changes in labor rates, labor rate variance arises. Next, due to changes in workers' efficiency levels, due to changes in workers' efficiency levels, arises labor efficiency variance. So, labor efficiency variance, South Africa. So, that is the box corner. So, SH, left corner, right corner, AH of SR. SH minus AH of SR. SH into SR minus AH into SR. This is the labor efficiency variance. Now again, if company is employing more than one category of workers, if company is employing more than one category of workers, in that case mix variance exists and also yield variance. Mix variance and yield. Divided two parts. This is RSH. This is mix variance, this is yield variance. So, labor mix variance RSH minus AH of SR. Box, sir, mix variance box. Sit on x-axis in the box. Left corner, sir, left corner RSH, right corner AH of SR. That means RSH into SR minus AH into SR. AH into SR. Next, labor yield variance. So yield variance box, sir, box corners SH minus RSH of SR. SH into SR minus RSH into SR. This is the labor yield variance. So plain model, sir, idle time 0, dead easy, no adjustments. Here paid hours, working hours, both are same. Both are same. Now, here one important point, sir. Standard hours allowed for actual output. Standard hours allowed for, this is SH. This is common format, sir. Standard hours allowed for actual output denoted by SH. Second alternative, same meaning. Second alternative, actual output in standard hours. Actual output in standard hours. This is also denoted by SH. This is also denoted by SH. This is very, very important. Sometimes in the question, actual output in standard hours, immediately this is denoted by SH. Next, another last one is gang produced labor gang produced standard hours of work. Standard hours of work. This is also SH. So, in any manner that is denoted by SH. Sometimes standard hours allowed for actual output. Sometimes actual output in standard hours. Sometimes gang produced in standard hours. In any manner it is denoted by SH. Main standard costing terminology important, sir. Terminology main important. So here SH, standard hours for allowed for actual output in standard hours, gang produced standard hours of work. So in any manner that is denoted by SH. Now take the problem. CRD 2. CRD 2, sir. The standard labor component and actual labor engaged. Sir, standard labor component means experience. Hello. Standard labor component means experience. And actual labor engaged, that is actual engaged in a week for a job. Good news, sir. Here experience provided for a job, actuals also provided for a job. Previously experience provided for 1 unit, actuals provided for 10 units. Here experience provided for a job, actuals also provided for a job. Here actual output equal to job. Generally actual output expressed in units, but here units not mentioned in the problem. Here actual output a job. Actual output a job. Right. Next, standard number of workers in the gang. Standard means past experience. Past experience. As per company experience, total gang, sir, 32 plus 12 plus 6. I think 50, huh? Total 50, yes, sir. Total 50. 50 workers. 50 workers. Rupa. Here percentage of standard labor mix. Calculate percentage of standard labor mix. 32 divided by 50 into 100. 64%. Right. Very good. Next. 24. 12. 0. This is the standard proportion of labor mix. Standard proportion of labor mix. Actual proportion of labor mix, sir. 28 plus 18 plus 4. 50. 50 workers. 28 by 50. Huh? Next. 8%. Sir, one thing is clear. Standard proportion of labor mix is not equal to actual proportion of labor mix. Therefore, mix variance exists. Definitely should calculate mix variance. Sometimes, in some cases, both are same. In that case, mix variance answer 0. In some cases, both are same, sir. In that case, no need to calculate labor mix variance. Simply labor mix variance equal to nil. Labor mix variance equal to nil answer. Okay. Next, standard wage rate per hour, that is SR values. For skilled category, hourly rate 3 rupees. For semi-skilled category, hourly rate 2 rupees. For semi-unskilled category, 1 rupee. Next, actual wage rate per hour, AR, denoted by AR. Skilled workers payment per hour, 4 rupees. Semi-skilled payment per hour, 3 rupees. Unskilled workers payment per hour. One thing is observed here, rates increases. Rates increases. Definitely labor rate variance adverse. Labor rate variance is adverse. So here one thing is clear. Experience provided for a job. Actuals also provided for a job. Previously experience provided for 1 unit. Actuals provided for 10 units. Clear? Now both are same. Actuals and experience given for only a job. Next. Sir, during the 40 hours week, during the 40 hours working week, during the 40 hours working week, that means available working hours per worker in a week equal to 40 hours. Available working hours per worker in a week equal to 40 hours. So then easily calculate actual paid hours. Here 28 members skilled workers engaged in this job. So available working hours per worker in a week equal to 40 hours. So 28 into 40, 1,120. Next, 18 into 40, 7, 4 into 40, 160. Summation think 2000. Reason 40 into 50, nothing but 2000. So your actual paid hours completed, sir. During the 40 hours working week, that means available working hours per worker in a week equal to 40 hours. So therefore paid hours equal to, in case of skilled category, 1120 hours. In case of semi-skilled category, 720 hours. In case of unskilled category, 160 hours. Sir, working hours, sir, paid hours, working hours, both are same in this problem. Reason, sir, there is no discussion about the idle time. Your idle time completely 0. There is no discussion about the idle time. That means paid hours equal to working hours. Paid hours equal to working hours. Clear? Next, sir, next sentence very, very important. The gang produced 1800. That is denoted by standard input hours directly given. Standard input hours directly given. Astrid, here extra input hours is used for this job. Chakradhar, 200 right answer. Sir, listen. Here standard input hours for this job equal to directly given 1800 hours. But actual hours 2000 hours. Extra input hours 200 hours. 200 hours into input cost per hour. Input cost per hour. Not ready, madam. I will calculate. So then multiply with hours. Then we'll get the labor yield variance. Here labor yield variance also adverse. Labor yield variance also adverse. Next, here standard hours, standard input hours for 50 workers equal to 1800 hours. Out of 1800, skilled category 64%, semi-skilled category 24%, unskilled category 12%. So here directly mentioned, as per company experience, this job should be completed in 1800 hours. As per past experience, this job should be completed in 1800 hours. So SH directly given in the problem. AH calculated. Now take the table, sir. So here idle time 0, sir. No discussion about the idle time. So particulars, listen. Particulars, standards for a job, sub columns, SH, SR, SH into SR. Next, actuals for a job, AH, AR, AH into AR. So this is the main 6 columns, sir. Now calculate one by one. Skilled, semi-skilled, unskilled. Next, write down the standard proportional labor mix. Here standard proportional labor mix equal to 64%, 24%, 12%. So this is the standard proportional labor mix. Listen. Standard input hours for this job directly given 1800 hours. 1800 hours into 64%. 1. Next 24%. Next 216. Standard wage rate per hour as per company experience 3 to 1. 3 to 1. Next 1152 into 3. 456. 530. Interpret Himabindu. For this job should be completed in 4000. For this job, labor work should be completed in 4536. 4536. So input cost per hour how much? 4536 divided by 1800. Input cost per hour. Into extra input hours. Multiply. 504. Add. Yield variance completed, sir. Yield variance completed. Sit down. Next. Sir, actual paid hours. Here, actual paid hours, actual working hours, both are same. Here, idle time 0. 1120 hours, 720, 160, that is 2000. 432 amount. 480. 960. Money, extra labor cost how much? Previously same work completed in 4536, but currently incurred 6960. 2000, 420, 2424 adverse. Next, calculate paid hours as per previous rates. Paid hours as per. So paid hours as per previous rates denoted by AH into SR. So as per previous rates, skilled category labor cost 1120 into 3. 3360. Next. 1000. Next. 96. Sir, as per old rates value 4960, sir, but new rates value 6960. 960. So definitely here rates increased. So clearly mentioned. Answer 2000. 2000 adverse. Next one. Last one, sir. RSH. RSH means actual working hours. Hello, actual working hours, not actual paid hours. But luckily in this problem, working hours, paid hours both are same. Hello, here RSH means actual working hours rewritten in. Luckily in this problem, idle time 0. Idle time, paid hours, working hours both are same. Clear? Now actual working hours, here actual working hours also 2000 hours. Actual working hours also. How to work as per past experience, sir? How to work these hours as per past experience? 64% of 2000 hours. 1280. Next. 2. So as per company experience, 2000 hours like that. 1280 hours, 480 hours, 240. But in reality, not like that. 1120, 720, 160. There is a difference. So that difference is calling as mixed variance. Mixed variance. So actual working hours as per standard proportion, actual working hours as per actual proportion, multiply with the standard price, then we'll get the mixed variance. Then we'll get the. So now find out the last column, RSH into SR. RSH into SR. 3840, 960, 240, 5000, 5040, 5040. Okay, now ready. Now here labor mix variance. So as per here RSH means actual working hours as per standard proportion. Actual working hours rewritten in standard proportion and multiply with the old rates value is 5040. But in reality, how much amount? 4000 amount, sir. 80. Sir, some mixes are favorable to the organization, some mixes are adverse to the organization. But this mix favorable to the organization. This mix favorable to the organization. For example, standard proportion, actual proportion both are same. No need to calculate mixed variance. Directly nil. Next, yield variance, sir. SH into SR. SH into 4000, 4536 minus RSH into SR. 5040. 504. In another way, here extra input hours equal to 200 hours into input cost per hour equal to multiply. Next, labor efficiency variance, South Africa, efficiency SH minus AH of SR. SH into SR value 4000, 4536 minus AH into SR 4960. Answer 424. 424 adverse. So completed, sir. 424 adverse, correct? So this is the labor variances first model. Model 1, paid hours and working hours both are same. Now second model. Second model, sir. Listen. Actual paid hours not equal to actual working hours. That means there is an idle time. There is an idle time. There is an idle time. This idle time is nothing but abnormal idle time. This idle time is nothing but sir, generally idle time two types. Normal idle time. Abnormal idle time is always appearing in actual data information. In actual information. Next, normal idle time. That is expected idle time. Expected idle time is always appearing in standards. Hello. Some people say, sir, doubt, sir, is it normal or abnormal, sir? Simple logic. Normal idle time is always appearing in standards. That is expected. Abnormal idle time element is always appearing in actuals. Abnormal idle time. Suppose hours were lost due to sudden mission breakdown. That is abnormal idle time. Sometimes 5% expected hours loss. That is normal idle time. 5% hours expected hours lost. That is a usual tea breaks. Usual tea breaks. Sir, abnormal idle time, normal idle time. In case normal idle time, no treatment. No treatment. There is no treatment. No need to calculate idle time variance. No need to calculate. In case of normal idle time, no need to calculate idle time variance. In case of abnormal idle time, definitely we need to calculate idle time variance. So, idle time two types. Normal idle time, abnormal idle time. Normal idle time is always appearing in standards. Suppose in given experience, see the information, is there expected idle hours? That is abnormal, that is normal idle time. Suppose abnormal idle is always appearing in actuals, Hours were lost due to sudden mission breakdown. That is abnormal idle time. In case abnormal idle time, we need to find the idle time variance. In case normal idle time, no need to find the idle time variance. Simply adjusted. In case of normal idle time, rate per hour is inflated. Rate per hour is so that no need to calculate the idle time variance. Already pass on to customer through rate. Now, take the example. Listen. Chart, sir. Labor cost should be completed in this cost SH SR. But actually incurred in this cost AR. Labor cost variance formula, sit on x-axis in the frame. Take left movement, sir, SHSR minus AH into AR. So now separate the changes. Flag changes, sir. That is the rate changes, sir. Rate changes, labor rate variance. Labor rate variance formula, sir. Flag, sit on x-axis in single pole. At single pole on formula AH into SR minus AH into AR. Listen. Now, suppose in case abnormal idle time, that means hours were lost due to sudden mission breakdown. Abnormal idle time is appearing in actuals, that is abnormal idle time. So, abnormal idle time here, this is abnormal idle time. So, cut the abnormal idle time, this is AWH. 2 hours were lost due to abnormal idle time, sir. So, this is paid hours. This is working hours. Working hours and paid hours difference is calling as abnormal idle time. Abnormal working hours, paid hours difference is always known as expected idle time, always directly given in the problem. That is as per industry norms, expected idle time, that is already mentioned. But paid hours, working hours difference is nothing but always abnormal idle time. Okay. So Next gap is labor efficiency. Now labor idle time variance, sir. Box. Box corners. AWH minus AH of SR. AWH into SR minus AH into SR. Minus AH into SR. Next, the remaining part, efficiency. Efficiency definition important. It is the deviation between allowed time and working time. Allowed time and now working time ready. Allowed time ready. In previous session, working time, paid hours both are same. But in this session, working time difference, paid hours difference. So take the labor efficiency variance. Labor efficiency variance SH minus AWH of SR. SH minus AWH of SR. Previous labor efficiency variance formula, sir. Previous labor efficiency. SH minus AH. Now SH minus AWH. SH minus AWH of SR. SH minus AWH of SR. Next, labor. Now, RSH. Here very, very important. RSH means actual working hours rewritten in standard proportion. Actual working hours rewritten in. Here actual working hours means AWH. AWH rewritten in standard proportion. AWH rewritten in standard proportion. So this is called as labor mix variance. This is called as labor yield variance. Yield variance, another formula also there. Extra input hours or saved input hours into input cost per hour. Then easily calculate the labor yield variance. Another shortcut way. So labor mix variance. Labor mix variance RSH minus AWH of SR. Labor yield variance SH minus RSH of SR. First read the problem. Model 1 or model 2? Model 1, paid hours, working hours both are same. Simple. Model 2, paid hours not equal to working hours. Paid hours not equal to working hours. Always abnormal idle time. Always. In case expected idle time also mentioned in the problem. Don't worry. That is normal idle time. That is normal. No need to calculate the idle time variance. Simply adjusted, sir. Okay. Right. Example, sir. Standard time allowed for 10 units equal to 50 hours. 10 units equal to 50 hours. Here actual output equal to 100 units. Actual output equal to 100 units. Actual working hours. First actual paid hours, sir. Actual paid hours 550 hours. Actual paid hours 550 hours. Actual paid hours 550 hours. 10 hours were lost. 10 hours were lost due to sudden machine breakdown or abnormal reason. Due to abnormal reason. Abnormal reason. So immediately this is abnormal idle time. 10 hours were lost due to abnormal reason. In this case, actual working hours equal to actual working hours 540, paid hours equal to 550. Actual paid hours equal to 550. 10 hours were lost due to abnormal reason. Therefore, actual working hours equal to 540 hours. Zero. Actual working hours. Actual working hours 540 hours. 540 hours. Actual working hours 540 hours. How to calculate actual working hours? That is paid hours minus abnormal idle time. Abnormal idle time. Next, actual wage rate paid per hour. Actual wage rate paid per hour 12 rupees. Standard wage rate per hour. Standard wage rate per hour 10 rupees. Now calculate the labor variances. 5 marks question. Now calculate the labor variances. Calculate labor variances. In this problem, one thing is observed, only single category of workers is employed. So no need to calculate mix variance and yield variance. No need to calculate mix variance and yield variance. So simply only 4 variance, that is, suppose here labor cost variance. Certain portion due to labor rate variance. That means certain amount due to changes in rates, labor rates. Certain portion due to labor idle time variance. Certain portion due to labor efficiency variance. In case more than one category of workers employed, in that case labor efficiency, certain portion, mix variance, certain portion. But in this example, no category, only one category. Hello, only one category of workers. Single category of workers are employed in this organization. Okay, so calculate only 4 variances. Labor cost, certain portion due to rate changes, certain portion due to abnormal idle time, certain portion due to workers efficiency levels. Workers efficiency levels. Now calculate variances, sir. First prepare the table. Particulars, labor, standard, ascertain the standard labor cost for actual output. Here actual output in this example 100 units, standard for 100 units. SH, SR, SH into SR. Check there. Here experience available or not available? So here there is an experience, sir. That experience given for 1 unit output or 10 units output or 100 units output. So here experience provided for 10 units output. But actual output not 10 units. Actual 100 units. Suppose actual output is also 10 units. Immediately that is SH. That is, but bad luck. Experience provided 10 units. But actual output is 100 units. Asrit, standard hours required for actual output how much? 500 hours, correct answer. Here standard time allowed for 10 units equal to 50 hours. Immediately convert into 1 unit. 1 unit equal to 5 hours. Correct? Immediately convert into 1 unit. 1 unit equal to 5 hours. 50 by 10. 1 unit time 5 hours. Then 100 units time So as per company experience, 100 units labor work should be completed in 500 hours. 100 units labor work should be completed in 500 hours. Sit down. So, hundred units into 5 hours. Simple. Given experience, here experience provided for 10 units. 10 units required time 50 hours. Standard time for 1 unit. Standard time for 1 unit. For 1 unit. Now you can easily answer that. 100 into 5. Correct. Next, standard wage rate per hour, sir. 10 rupees. 5,000. This is the standard labor cost. Chakradhar, interpret. Here not job, per 100 units output. Labor work should be completed in 5,000 rupees. Now calculate actual labor cost for actual output. Sit down. Actual for 100 units. AH, AR, AH into AR. So here actual working hours, here actual paid hours. First put up the paid hours. Here total paid hours, sir. So here payment made 550 hours, sir. Here payment made 550 hours. 550 hours into 12 rupees. 6,600 hours. 600 rupees. 6,600. Sir, actually incurred 6,600 rupees, sir. Indu, labor cost variance how much? Yeah, Indu, Aishwarya, sir. 1,600. As per company experience, this work should be completed in 5,000, but actually incurred. So extra labor cost incurred 1,600. Right. Certain portion rate changes. Certain portion abnormal idle time. Certain portion efficiency. Now calculate 3 parts: labor rate, labor idle time, labor efficiency. Summation equal to labor cost variance. So labor cost variance equal to labor cost variance. Here formulas ready, sir. SH into SR minus AH into AR. So SH, sir, SH into SR, sir, 5,000. 5,000 minus answer. Adverse. Correct? Huh? Now, next, rate variance. So as per new rates, value is 6,600. But as per old rates, paid hours as per old rates, sir, AH into SR. Paid hours as per old rates, 550 into 10, 5,000. As per old rates, paid hours value 5500. As per new rates, paid hours value 6,600. So rate variance equal to 1100 adverse, 1100. So AH into SR 5,500, 5,500 minus AH into AR 1100, 1100 adverse. Clear? Next, idle time variance. Sir, idle time variance, definitely calculate AWH and AWH into SR. Here AWH, sir. How to calculate working hours, paid hours minus abnormal idle time? Here paid hours equal to 550, abnormal idle time equal to 10 hours. So finally 540 hours. 540 hours into 10. 5,000. So AWH into SR 5,400 minus AH into SR 5,000. Answer 100. Sir, here there is a shortcut. Abnormal idle time 10 hours. Once rate variance completed, remaining all variances multiply with the standard rate. Correct? Huh? Once rate variance completed, remaining all variances multiply with the standard rate. Now, abnormal idle time 10 hours into standard rate to 10 rupees. 10 hours into 10, 100 rupees. This trick is applicable only in case of one category of employees, not multi-categories of employees. This trick is applicable only in one category. In case multi-category, definitely we can use the formula. Only in case of single category, no need to apply the formula. Take the abnormal idle time into SR. Take the abnormal idle time into SR. Here abnormal idle time equal to 10 hours into SR equal to 10 rupees. 10 hours into 10 rupees, that is equal to 100 rupees. Clear? Abnormal idle time, always adverse variance. Name is abnormal idle time. Always loss, that is adverse. Next, now efficiency variance. Efficiency variance. In this problem, efficiency ratio how much? In this problem, efficiency ratio how much? Efficiency ratio. Efficiency ratio. Workers' efficiency ratio. Lavanya, workers' efficiency ratio. 90%. So here standard time allowed for 100 units as per company experience 500 hours. That means this work should be completed in 500 hours. But actual working time, not paid hours, working time 540. As per company experience, this work should be completed in 500 hours. But actual working time equal 540 hours. SH by AH into 100. 500 divided by 540 into 100. 92.59. Approximately 93%. Clear? SH by, not AH, SH by, that is important. AWH. AWH. Most of the people 500 divided by 1500. Answer? Lavanya answer. Smell. So, your answer is SH by 8WH into 100. 8WH into 100. Same pinch. So, answer 500 divided by 540 into 100. Answer 90.59%. Right. Now, calculate the labor efficiency variance. Labor efficiency variance formula SH minus AWH of SR. So, that is SH into SR minus AWH into SR. SH into SR 5000 minus 5000. Answer 400 adverse. Sir, rate variance plus idle time variance plus efficiency variance summation equal to labor cost variance. Correct? Huh? So 400 adverse, 100 adverse, 1100 adverse, summation 1600 adverse. 1600 adverse. Plus here only one category of workers. So no need to calculate mix and yield. No need to calculate mix and yield. So here table columns SH, SR, SH into SR, AH, AR, AH into AR, AH into SR, AWH, AWH into SR. Additional two columns AWH, AWH into SR. Suppose in case multi-category of workers RSH, RSH into SR. RSH, RSH into SR. Check there, RSH means revised standard hours. Asrit. Actual working hours. Very, very important. Actual working hours. Actual working hours rewritten in. That is important. RSH revised standard hours. How to calculate revised standard hours? working hours re-rated in standard proportion. But here only one category, only. So no variance, no mixed variance, no yield variance. So this is the format of abnormal idle time. Abnormal idle time. Same procedure, suppose in case two categories, immediately provide the second next column RSH and RSH into SR. Draw the chart, design the formulas, apply the values, find out the variance. So this is the labor variances. Next, coming to overheads. Overhead variances. Listen. Overhead variances. Overhead variances. First, total overhead cost variance. Listen, total overhead cost variance. Total overhead cost variance. Anusha, total overhead cost variance certain portion. Variable overhead cost variance. Variable overhead cost variance. Fixed overhead cost variance. Very good. Fixed overhead cost variance. Sir, VOH cost variance, certain portion due to rate changes, certain portion due to worker efficiency. Very good. Worker efficiency. Certain portion due to rate changes, certain portion due to worker efficiency levels. So, due to rate changes, that variance is called as expenditure. In material segment, price, labor segment, rate, overhead segment, terminology change. Concept is same. Concept is same. In material, price changes, in rate changes. Here also rate changes, but namely expenditure variance. Expenditure variance. So, VOH expenditure variance. VOH expenditure variance. Next, VOH efficiency variance. Efficiency variance. 0. Efficiency variance. Next, fixed overheads. Immediately, fixed overheads means fixed overheads are those overheads which do not vary with the volume of up to a range, up to budgeting output, up to budget. That means fixed expenses completely depends on budgeting output. Fixed expenses completely depends on budgeting output. Correct? Huh? Fixed expenses completely depends on budgeted output. Budget output. Now, clear. Budget output. Suppose if actuals not met with budgets, then volume variance arises. Then volume variance. Fixed overheads. Fixed overhead costs are those costs which do not vary with the volume of output. Up to certain range means up to budgeted output. Up to budgeted. Okay, up to budget output. I think if actuals not met with budgeted, then volume variance arises. Then volume variance. Next, due to rates, that is called expenditure variance. Expenditure plus volume equal to cost variance. Cost variance. Cost variance. Sir, in variable overheads, volume variance, sir, there is no volume variance. Reason, sir, variable overheads varies with the output, actual output. If there is no production, there is no variable overhead. Am I right? But fixed overheads completely depends on budget output, not actual output. Fixed overheads completely depends on budgeted output. If budget output is selected, then reveal the fixed overhead amount. If actual output revealed, then reveal the variable overhead. So variable overhead link with actual output, budget output, budgeted fixed overhead link with budget output. Fixed overhead link with budget output. Clear? So fixed overhead costs are those costs which do not vary with the volume of output up to a budgeted output. Oh, actuals not met with budget output, volume variance may arise. Okay, rates increase, expenditure arise. add them, cost variance. So finally, overhead variance. This is expenditure variance. Fixed overhead, expenditure variance. Here fixed overhead, volume. Next, sir, what are the factors? Focus on volume. Workers' efficiency levels, workers' utilization, workers' capacity utilization, calendar days, increase or decrease. So changes in calendar days, changes in efficiency levels, changes in utilization time. These three factors impact on volume. These three factors impact on. So here volume variance, certain portion due to efficiency, certain portion due to capacity level, certain portion due to calendar. Volume variance, certain portion efficiency, workers' efficiency levels. Due to workers' efficiency levels, sometimes volume increase, sometimes volume decrease. Simple logic. Workers' efficiency ratio below 100%, volumes down. Workers' efficiency ratio beyond 100%, volumes increase. Sir, equal to 100%, volumes, no impact. Next, capacity utilization ratio. Capacity, that means workload of the worker. So capacity utilization below 100%, volume decrease. Beyond 100%, volume increase. Next, calendar. Calendar days increase, volume increase. Calendar days decrease. So in all cases, negative. Below efficiency, below capacity utilization, below days, below calendars. In all three cases, minus, minus, minus. Definitely volume down. Volume. At least two cases positive, then volume rise. At least two. Any two are favorable, then result is volume increase. Result is volume. Two cases negative, one case positive, volume decrease. Volume. All cases adverse, volume decrease. Efficiency below 100, capacity utilization below 100, calendar days down. That means volume down, volume variance adverse. Volume variance adverse. So basically, fixed overhead variance is very, 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 very easy. Conceptual basis. Pure conceptual basis. Fixed overhead variances. That easy. Read the problem. Find out two ratios. One is efficiency ratio and second one is capacity ratio. These two are very, very important. Please practice these two variances. Immediately, fixed overhead variance immediately calculate. That easy. Just two variances. One is efficiency variance. Second one is capacity variance. Capacity utilization ratio. Capacity. For example, listen. CRD 3. The following information obtained from the records of manufacturing unit using standard costing system. So here presently manufacturing unit using standard costing system, that means cost controlling through variance analysis. Cost controlling through. Sir, manufacturing unit using standard costing system means here cost controlling through variance analysis. Variance analysis. So here two columns provided by the company. One is budgeting information, second one is actual information. Sometimes question mentioned script mode, then immediately convert into tabular mode. Here tabular mode ready. Very, very easy. Budgeted production 4,000 units. Budget production. Budget fixed overhead cost 4 lakhs. Comment. Dedipya. Fixed overhead costs are those costs which do not vary with the volume of output up to 4,000 units. Up to 4,000 units, fixed overhead amount is 4 lakhs. Sir, production volume 2,000, sir, 4 lakhs. Sir, production volume 1,000, sir, 4 lakhs. Due to increase or decrease in rates, this 4 lakhs affected. Otherwise, 4 lakhs. 4 lakhs. Due to increase or decrease in fixed overhead rates, changes. Suppose rates no change. Actual 4 lakhs. Clear? First, fixed overhead costs are those costs which do not vary with the volume of output up to 4,000 units. Sir, actual production volume 2,000 units, sir, 4 lakhs. Sir, actual production volume 1,000 units, sir, 4 lakhs. But due to increase or decrease in overhead rates, then 4 lakhs affected. 4 lakhs may be affected. Due to change in rates, 4 lakhs affected. Otherwise, 4 lakhs. Here, actual fixed overhead cost, 3 lakhs 90. Actual fixed overhead cost. Sir, here rates changes, sir. Here rates. Increase in rates or decrease in rates? Sure. Decrease in rates. Decrease in fixed overhead rates. Hello, decrease in. Due to decrease in fixed overhead rates, expenditure variance is favorable. Expenditure variance favorable. Amounts are favorable amount of 10,000. So see the table. Immediately says fixed overhead expenditure variance. Immediately says fixed overhead expenditure variance. Fixed overhead expenditure variance. Next, table ready. Okay. See the table. First, calculate worker efficiency ratio. Worker. Rakesh, your efficiency ratio formula. Sir, hours basis or output basis? Sir, please prefer always hours basis. Recent examination question is asking, do the variances on hours mode. So please prefer the hours mode. In regular classes, 2 models also discussed. Am I right? So see this table. Calculate efficiency ratio. Simple logic. Efficiency ratio on hours basis SH by, correct, SH by AH, correct. SH means, sir, actual output in standard hours. Yeah. SH, 3 varieties. Standard hours allowed for actual output. Actual output in standard hours. Gang produces standard hours. Am I right? Actual output in standard hours. Actual output in. How to calculate actual output in standard hours, sir? Here standard time for 1 unit. Please calculate. Sir, how to calculate standard time for 1 unit, sir? See the budgeting information. Then derive the standards. Sir, standards derived from budgets. Standards derived from. So here budgets 4,000 units, 8,000 hours, 4,000 units. Required time 8,000 hours, 4,000 units. Required time 8,000 hours. Therefore, 1 unit required time equal to. Sir, values, estimated values for 1 unit is nothing but standards. Estimated values for 1 unit is nothing but. Estimated values for total activity is nothing but budgets. Estimations for total activity, that is called budgets. Estimation for 1 unit, nothing but standards. So finally, standards derived from budgets. Standards derived from budgets. Clear? Huh? Standards derived from. So standard time for 1 unit equal to 2 hours. First table ready. Sir, directly table given, sir. Oh, immediately calculate standard time for 1 unit. Standard time for 1 unit equal to 2 hours. Keep in mind. Now easily calculate standard hours for actual. Nothing but actual output in standard hours. 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 Actual output in standard hours, sir. That is actual output, sir. 3,800 into 2 hours. 7,000. Ready? SH ready, sir. Next, actual hours. Actual working hours. AH. AH. 7,000. Then efficiency ratio. Efficiency ratio. SH by AH into 100. SH, sir. Divided by into 4. 4-3 or 4-4? 4-4. Sir, please practice this one. Yes, sir. Tabular form data provided, sir. Immediately calculate efficiency ratio. Sir, budgeting information available, sir. Then immediately says standard time for 1 unit. Sir, 2 hours, sir. Then actual output in standard hours. Actual output in standard hours equal to 7,600 hours. Then compare with actual working hours. Then we'll get a efficiency ratio. We'll get efficiency ratio. Next, capacity ratio. Capacity ratio. Here, please consider actual calendar days. Please consider. So, capacity ratio based on actual calendar days. Here, actual calendar days, sir. Actual calendar days, sir. Please calculate 21 days workload. Compare with actual workload. Compare with actual. Okay. So, here, please calculate 21 days workload. So, that means 21 days budgeted hours. 21 days budgeted hours. 21 days budgeted hours. So, that is the 21 days workload. That is 21 days workload. 21 days workload. Sir, how to calculate 21 days budget hours, sir? Here 20 days budget hours available, sir. 20 days budget hours. 20 days budget hours, so 8,000 hours. Now calculate 21 days budget hours. 8,400 hours. Clear, sir? 8,000. So this is the target. Company has decided to take the workload from workers 8,000. So in actual, only 7,800 hours taken from the workers. Am I right? But as per target, 8,400 hours. But real utilization, in actual utilization only 7,000. So 21 days actual working hours. 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 7,800 hours. Underutilized or overutilized? Beyond utilized? Underutilized. Sir, target workload, sir, 8,400 hours. Okay, 8,000. But real working, sir, workers real working, sir, actual working, 7,000. So, unutilized. So, capacity utilization ratio equal to AH, Andhra Bank, AH by BH into 100. AH sir, BH sir, 8,400 into 100 sir. 8 sir, first one below 100, second one also below. Definitely volume down sir, volume decrease. Volume decrease sir. Sir, three things main. One thing is workers efficiency levels. Second one is workers utilization. Workers here target utilization 8,400 hours, but actual utilization 7,800. Target utilization 8,400, but actual utilization only 7,800. So this is also below 100%. So two things below 100%. Definitely volume decrease. Here budgeting volume sir 4,000, but actual volume sir, reason sir, 2 negative. Efficiency adverse. Capacity also. So please practice these two. Please practice these two. Then fixed overhead where is dead easy. Please practice these two. Please. Now calculate one by one. Efficiency. How to calculate efficiency, sir? Efficiency ratio SH by AH into 100. Now, variance SH minus AH of SR per hour. SR per hour. Fixed overhead rate as per past experience. Fixed overhead rate as per past experience. Sir, SH 7,600 minus 7,800 into SR per hour. SR per hour. SR per hour, how to calculate, sir? Budgeted fixed overhead cost. Budgeted fixed overhead cost divided by budgeted hours. Here budgeted fixed overhead cost, sir, 4 lakhs. Budget hours, sir, 8,000 hours. Per hour, sir, 50 rupees per hour. 50 rupees per hour. So 1 hour labor force working in the factory, recovery amount equal to 50 rupees. Recovery amount equal to 50 rupees. So here answer 7,600 allowed time, but 7,800 hours. Extra working time. Extra working time. So 200 hours into 50 rupees. 10,000. 10,000 adverse. 10,000 adverse. Simple logic, sir. Here actual output. Here actual output. Sir, a tabular form, very easy, sir. Suppose data presented in tabulation, budget information available, then immediately says standard time for 1 unit. Standard time for 1 unit equal to 2 hours. Standards derived from budgets. Standards derived from here 2 hours. 1 unit 2 hours. Therefore, into 2 is equal to 7,600 hours. This is SH. SH AH difference into SR per hour is nothing but efficiency. Clear? Sir, once table ready, then immediately calculate. So here actual output in standard hours, actual output 3,800 units. So 1 unit time equal to 2 hours. So therefore, this work should be completed in 7,600 hours. But actual working time equal to 7,800 hours. So extra working hours equal to 200 hours. So extra working hours 200 hours into 50 rupees. 10,000 adverse. 10,000. In practice, very simple, sir. Next, sir, capacity. Target utilization, sir. 21 days target workload, sir. 8,400. 21 days target workload. Here mentioned 21 days workload. 20 days 4,000, 20 days 8,000, 20 days for 21 days 8,400 hours. 21 days 8,400. 8,400 hours targeted workload, but real workload is real achieved is 7,000. So AH by BH into 100, that is the capacity utilization ratio. Answer efficient variance answer AH minus BH into SR per hour. SR per hour. AH 7,000 minus 8,400 into 50. Answer 30,000 adverse. So please this is a question paper, tabular form directly given. Simple. First see the budgeting information. Standard time for 1 unit equal to immediately 2 hours equal to 7,000. This is SH. This is AH. SH minus AH into rate per hour equal to efficiency. Completed, sir. Next, capacity. 21 days budgeting hours. 20 days budgeting hours 8,000 hours. 21 days budgeting hours 8,400 hours. Correct? Budgeting hours for 21 days 8,400 hours. So capacity ratio AH minus BH 7,800 minus 8,400 into 50. Completed, sir. Next, calendar variance. See this difference. Days increase or increase or decrease? Increase. Madam, 3 things already, 2 negative, 1 positive, but volume down. 3 things: efficiency, capacity, calendar. Out of these things, 2 positive, volume increase. 2 negative, volume decrease. Here only 1 thing is positive, that is calendar variance. So calendar days increase or decrease? Increase. 1 day increase. 1 day increase. So 1 day increase means favorable. 1 day increase means favorable. Answer per day rate. So fixed overhead per day rate. Fixed overhead 4 lakhs divided by 20. 20. Answer 20,000. So 20,000 favorable. 20,000. So 3 variances completed. So now listen. First, see the budgeting information. Standard time for 1 unit 2 hours. Immediately into 2 is equal to, this is SH. This is extra working time. 200 hours into 50 is equal to 10,000. Efficiency completed. Next, capacity. 20 days hours 8,000 hours. 21 days hours 8,400 hours. This is BH for 21 days. BH for, so capacity variance AH minus BH. So 7,800 minus 8,400. 600. 600 into 50. 30,000. Next, calendar variance. Days increase or decrease? Increase. 1 day increase. So favorable. Answer rate per day. 4 lakhs divided by 20. 20,000. Next, volume. Add these 3. 10,000 adverse, 30,000 adverse, 40,000 adverse, minus 20. 20,000. Okay. Next, expenditure. Expenditure variance 4 lakhs, 3 lakhs 90, 10,000 favorable. Next, cost variance. These two summation. Completed. Completed, sir. 5 minutes. Maximum 5 minutes. Efficiency, capacity, calendar. These three added. You'll get volume. Next, expenditure. See the table. 10,000 favorable. Next, volume plus expenditure equal to cost. Clear? Clear, sir? Okay. So this is the fixed overhead variances. Fixed overhead variances. Suppose in the question paper, script mode is given. In that case, immediately convert into tabular form. Tabular form. Then do the solution. Next. Last. Variable, sir. Variable overhead cost variance. Certain portion due to expenditure variance. Certain portion due to efficiency variance. Sir, efficiency variance, sir, simple logic. SH minus AH of SR per hour. Sir, please, this SR per hour is nothing but VOH per hour, sir. Not FOH per hour, sir. This is VOH per hour. VOH per hour, sir. No. VOH per hour equal to 0. VOH per hour. Sir, VOH per hour, budget VOH cost 1,20,000 divided by budget hours, 8,000 hours. 15 rupees. Keep in mind. Now, VOH efficiency variance. VOH efficiency variance. VOH efficiency variance. VOH efficiency variance. SH minus AH into SR per hour. SR per hour. Sir, standard hours into 2 7,600 minus actual working into SR per hour. Answer 3,000 completed. Next, VOH expenditure variance. Expenditure variance. This is standard VOH cost minus actual VOH cost. Standard VOH cost minus. Sir, what is the standard VOH cost? Simple, sir. Actual hours as per old rates. Actual working hours as actual paid hours as per old rates. Here, paid hours, working hours, both are same, madam. Here, idle time nil. So, actual paid hours as per old rates. Actual paid hours as per old rates. Actual paid hours as per old rates. Actual paid hours for actual rates. Actual paid hours as per actual rate. This is always available in the problem. This is always available in the problem. So, actual paid hours, sir, 7,800 hours. 7,800. As per old rate 15 rupees. Old rate 15 rupees. How much? 1 lakh 1 lakh 17. So, as per old rates 1,17,000. But as per new rates 1,20,000. New rates 1,20,000. Answer 3,000. Now, these two added, expenditure plus equal to VOH cost variance. So, 3,000 adverse, 3,000 adverse, final answer 6,000 adverse. 6,000 adverse. VOH cost variance plus FOH cost variance equal total overhead cost variance. Total overhead cost variance. Within 15 minutes, answers ready. Answers ready. Logics. Main logic, standard time for 1 unit. See the budgeting information. Take the 1 unit time. 1 unit time equal to 2 hours. 1 unit time equal to listen. Sir, start. See the budgeting information. 1 unit time equal to 2 hours equal to 7,600. This is SH. This is difference. 200 hours into fixed overhead rate per hour. Answer 10,000. This is next 21 days budgeting hours. 8,000. This is targeted workload, but real achieved shortage 600 into 50, 30,000. This is capacity. Calendar favorable. 1 day benefit. 1 day benefit equal to 20,000. Add these three. 20,000. Add. This is volume. This is volume. Expenditure 10,000 favorable. Volume plus cost. Main practice. But table important. Sometimes 3 paragraphs mentioned in the problem. Then first we have to ready the tabular form. Then do the problem. So this is the standard costing, sir. Next one, marginal costing. Marginal costing. Saket, objective. Okay, I will tell. Hello. The main objective is. Thank you. Right. This technique is very useful for managerial decision making. This technique is very useful for managerial decision making. Sit down. This technique is useful for managerial decision making. Managerial decision making. Managerial decision making. This is modern method. This is modern method. Traditional method, absorption costing method. Traditional method, absorption costing method. Modern method, marginal costing method. Here, decision making is very fast. Decisions are based on contribution. Decision making is based on contribution. Decision making is based on contribution, not profit. But in conventional method or in traditional method, decision making is based on profit. Here, decision making is based on contribution. Decision making is based on contribution. Here, specialty, only variable cost elements charged to the product. In conventional method, total elements charged to the product. But here, only variable elements. Only variable elements are charged to the product. For example, company produces a bottle, plastic bottle. So decide the cost. Only variable elements are charged to the product. Only variable elements are charged to the product. For example, variable elements charged. Variable cost to 8 rupees. Product sold 10 rupees. 2 rupees is calling as profit. Contribution. Contribution. So that is the main importance. So decision making is based on contribution. Here, marginal costing technique, classification of expenses on variability basis. Classification of expenses on variability basis. Variability basis. Classification of expenses on variability basis. Variability basis means variable expenses, fixed expenses. Sir, semi-variable expense, sir. Semi-variable expenses, certain portion fixed. Fixed added to fixed portion. Variable added to variable portion. Finally, two things. Variable expenses, fixed expenses. Variable expenses, fixed expenses. Here, variable expenses charged to the product. Variable elements charged to the product. All fixed elements are treated as a period cost. Total fixed cost elements borne by the company. All fixed cost elements are treated as period cost borne by the company. So in this technique, EBIT is treated as profit. Very, very important. In this technique, EBIT is treated as profit for decision making purpose. EBIT is main important. So here EBIT is treated as profit. In marginal costing chapter, profit means EBIT. In marginal costing chapter, profit means EBIT. Only variable elements are charged to the product. Sir, in our industry, only variable elements are charged, sir. Oh, I think this is marginal costing. Yes, marginal costing. Only variable elements are charged to the product. That is marginal costing. Then compare with revenue. We'll get the contribution. We'll get the all fixed elements borne by the company. So deduct fixed cost. Then we'll get the profit. So final profit ready. Income statement ready. Income statement. First, only variable elements charged to the product. Variable cost ready. Then revenue. Revenue minus variable cost equal to contribution. Minus fixed cost equal to profit. Important note. Under marginal costing technique, EBIT is treated as profit. EBIT is considered as profit. Here decision making is based on contribution. Decision making is based on contribution. So how to calculate contribution? Simple. Only variable elements charged to the product. Compare with revenue. We'll get contribution. S minus V equal to contribution. Or F plus P equal to also contribution. So finally marginal costing equation S minus V equal to F plus P. S minus V equal to F plus P. Right. Now here only variable cost elements charged to the product. I will explain. Variable cost calculation. Variable cost of sale. Variable cost of sale. How to calculate variable cost of sale? Now, under this technique, only variable elements charged to the product. Direct material cost charged to the product. Direct labor cost charged to the product. Direct expenses cost charged to the product. Variable factory overhead cost or variable manufacturing overhead cost or variable production overhead cost. Manufacturing or production or factory. So variable production overhead cost or variable manufacturing overhead cost or variable factory. So variable production overhead cost. Variable production overhead cost. These four collectively known as variable manufacturing cost, not manufacturing overhead cost, manufacturing cost. This is also a variable production cost. Variable manufacturing cost, another name is variable production cost. Variable production cost. Variable production cost. Variable production cost. Ready? So, under marginal costing technique, closing stock is valued at variable manufacturing cost. Under traditional method, current period production, total production cost. Here only variable production cost. Except marginal costing, remaining all chapters, stock is valued at current period total production cost. Here only variable production. That is the difference. Sir, remaining chapters, total production cost is considered for inventory valuation. But in this chapter, only variable production cost. Variable production cost. Rakesh, what is the difference between variable production cost and total production cost? In variable production cost, fixed manufacturing overheads not considered. In total production cost, fixed manufacturing overheads are considered. That is the difference. Repeat. In variable production cost, fixed production overheads not considered. In total production overhead cost, in total production cost, fixed manufacturing overheads also included. Also, only in marginal costing technique, variable production cost considered for inventory valuation. Other chapter, in remaining chapters, total production cost. Total production cost. Next, here adjust the inventory levels. Here adjust the inventory levels. Opening stock should be added. Closing stock should be deducted. We get, this is a variable COGS. Stop saying variable COGS. Variable COGS. COGS. Marginal costing cost statement. Variable COGS. Now, start two elements. Variable admin overhead cost, variable selling and distribution overhead cost. Add variable admin overhead cost, variable selling and distribution overhead cost, variable selling and distribution overhead cost, variable cost of sale, variable cost. So finally, only variable elements charged to the product. Only variable elements charged to the product. This variable cost of sale compare with sales will get the contribution. Contribution minus fixed cost equal to profit. Sir, in case, for example, production volume equal to sales volume. Production volume equal to, in that case, variable cost of sale dead easy. Directly add 6 element. Direct material cost, direct wage cost, direct expense cost, variable manufacturing overheads, variable admin overhead cost, variable selling and distribution overhead cost. No need to express variable manufacturing cost, variable COGS. Simply ignore. Reason, inventory levels nil. Inventory levels nil. So, if there were no inventory levels, in that case, variable cost of sale, add 6 elements. Add 6 elements. Direct material cost, direct wage cost, direct expense cost, variable factory overhead cost, variable admin overhead cost, variable selling and distribution overhead cost. So, first to decide the product cost. Decide the, under marginal costing technique, product cost is nothing but variable cost. Product cost nothing but period cost nothing but fixed cost. How to calculate the profit? Sales less variable cost of sale will get contribution. Contribution minus fixed cost will get profit. Decision making is based on contribution. So this technique is very useful for managerial decision. managerial decisions about break-even point, managerial decisions about margin of safety, managerial decisions about desired profit or desired sales in quantity. Okay, this is the marginal costing basic rules. Next, conventional method or traditional method. Absorption costing method or conventional method or traditional method. Decision making is based on profit. Decision making is based on profit, sir. Net profit. Oh, net profit. How to calculate net profit? Sales less COGS. Same accounting pattern. Sales less COGS. Gross profit less indirect expenses will get the net profit. Sir, here cost classification, sir. Here classification of expenses on functional basis. Here classification of expenses on functional basis. 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 Sir, functional basis classification like total production cost. Total production cost means not only variable manufacturing cost but also include fixed manufacturing overheads. Fixed manufacturing overheads. Fixed manufacturing overheads also included. Then that is called as total production cost. Previously variable production cost, now total production cost. Total production cost includes fixed manufacturing overheads, includes total production cost. Total. Fifth element added. Sir, how to charge fixed production overhead element, sir? By using the rate. Sir, fixed production overheads nothing but depends on budgeting volume. Yes, fixed depends on budgeting volume. Fixed depends on budgeting volume. That means fixed expenses are those expenses which do not vary with the volume of output up to budgeting volume. Yes, up to budgeting volume. Suppose actual volume not met with the budgeting volume, then volume variance may arise. May arise. Suppose sometimes budgeting volume, actual volume both are same. In that case, volume variance 0. But actual output not met with the budgeting output, in that case, definitely volume variance may arise. Volume variance also adjusted. In the income statement. In that case, sales less COGS will get gross profit. Adjust the volume variance. That is sometimes under recovery of fixed production overheads, sometimes over recovery of fixed. If the suppose budgeting actual volume is less than budgeting volume, in that case under recovery of fixed overheads. Sometimes actual volume is more than budgeting volume, in that case over recovery of fixed overheads. That is rare cases. Then we get the actual gross margin. Next, less indirect expenses will get the net profit. So under absorption costing method or conventional method or traditional method, classification of expenses on functional basis like total production cost. Here total production cost includes fixed production overheads, not only variable production cost but also fixed production overheads. Fixed production, that is the total production cost. Total production. Next, total admin overhead cost. Total admin overhead cost. admin overhead cost. Next, total selling and distribution overhead cost. Total selling and distribution. These two nothing but indirect expense. These two nothing but this is the product cost. This is the product cost. So, how to prepare the income statement under conventional method? Simple. Sales less COGS. Sales less COGS. Gross margin. Adjust the volume variance. If actual output is less than budget output, under recovery of fixed production overheads. If actual output is more than budget output, over recovery of fixed production, then we get actual gross margin. Less indirect expenses, we get the net profit. Here decision making is based on clear. Sir, inventory valuation, sir. Here inventory valuation, here closing stock is valued at total production cost. Marginal costing, variable production, that is main difference. Marginal costing, closing stock is valued, variable production cost. Under absorption costing, closing stock is valued at 2. That is difference. Total production cost. What is the difference between variable production cost and total production cost? Just the fixed production overheads. Fixed. So total production cost minus variable production cost equal to fixed production overheads, sir. Total production cost minus variable production cost. Result is fixed production overheads. Fixed production. That is the difference. Clear? So income statement clear. Marginal costing income statement to absorption costing income statement. Marginal costing income statement to Aishwarya. Marginal costing income statement. Sales less variable cost of sale, contribution minus fixed cost, profit. Absorption costing income statement Ashrita. Sales less COGS, gross profit. If actual output is less than budget output, under recovery of fixed production overheads. If actual output is more than budget output, over recovery of fixed production overheads, we get actual gross margin. Less indirect expenses, fixed production, total admin overhead cost, total selling and distribution overhead cost. We'll get the net profit. We'll get the, take the problem. So CRD 1, sir, marginal costing, CRD 1. CRD 1. Listen. Right. 0. In our material, I think last CRD 22. Right. Sir, CRD 1. XYZ Limited has a production capacity. Has a production capacity 2 lakhs units per year. This is installed capacity or rated capacity. Installed capacity or rated capacity. Capacity of the plant indicated by its manufacturer. So company has a production capacity 2 lakhs units. Normal capacity. Normal capacity means capacity based on sales expectancy. Capacity based on sales expectancy is calling as normal capacity. Another name budgeted capacity. Another name selective capacity. Capacity based on sales expectancy. Capacity based on sales expectancy. Here product sales expectancy only 90%. Therefore budgeting output equal to 90% of 2 lakhs equal to 1,80,000. 1 lakh. Normal capacity or budgeted capacity or capacity based on sales expectancy. Capacity based on, so that is 90% of 2 lakhs. 1,80,000 units. So sales expectancy. Normal capacity means capacity based on sales expectancy. Sales expectancy equal to 1 lakh. So target ready. Budget output ready. Budget output 1,80,000 units. In the year just ended 30th June 2006, the production was 1,60,000. So here actual output 1 lakh. Sir, volume variance exists, sir. Yes, volume variance exists. Reason? We are budgeting output 1,80,000, but actual output is 1,60,000. Actual output is less than budgeting output. Under recovery of fixed production overheads, under absorption costing method, not marginal costing method, under absorption costing method. Clear? Next. Actual output 1,60,000. Sales volume, sir. Sales volume. Sales in units, sales quantity. 1,50,000. Sales quantity 1,50,000 units. So general sense 10,000 closing stock, but here closing stock not 10,000, sir. Closing stock is mentioned in the problem 20,000 units. Closing stock on June 30th, 20,000 units. 20,000 units, sir. Closing stock. How it is possible? There is a opening stock. There is a opening stock, I think 10,000. Production 1,60,000. Opening stock 10,000. Total availability 170. 170 minus 150. Tallied. So opening stock. Opening stock 10,000 units. 10,000 units. Next. Sir, fixed cost. Fixed cost means fixed production overhead cost or fixed admin overhead cost or fixed selling and distribution overhead cost. If there is no specific information, that is assumed as fixed production overhead cost. Fixed production overhead cost. Amounts are fixed production overhead. Fixed production overhead cost amount 3,60,000. Anusha, interbit fixed production overhead cost. Up to 1,80,000, not up to 1 lakh, up to 1 lakh. That is very, very important for traditional costing because rate calculation very, very important. Up to 1,80,000 rate equal to 2 rupees. Some students are saying up to 1,60,000, sir. Rate important. Rate important. Under absorption costing, rate very, very important. So fixed production overhead costs are those costs which do not vary with the volume of output. Fixed production overhead costs are those costs which do not vary with the volume of up to 1 lakh. Therefore, fixed production overhead rate, fixed production overhead rate per unit, overhead rate per unit. Budgeted fixed overhead cost divided by budgeted output. Budgeted fixed overhead cost 3 lakh. Budget output, sir, 1,80,000. 2 rupees per unit. It is very useful in absorption costing method. And marginal costing method no use. Reason, marginal costing method, all fixed cost elements are treated as period cost. No need to calculate rate. This rate is used only in absorption costing method. Clear? Next. Next one. Next, variable selling cost 3 rupees per unit. Variable selling overhead cost 3 rupees per unit. Next, fixed selling overhead cost 2,70,000. Next, price structure. Price structure, selling price per unit 20 rupees. Selling price per unit 20 rupees. Sir, here one information, sir, very, very valuable information. Variable production cost. Variable production cost includes, madam, sir, under marginal costing technique, only variable elements are charged. Variable production cost. Under marginal costing technique, closing stock is valued at variable production cost. Am I right? So, variable production cost includes direct middle cost, direct wage cost, direct expense cost, variable production. Four elements already mentioned. So, here already mentioned, sir. Variable production cost. Variable production cost means direct middle cost, direct labor cost, direct expense cost, variable. These four elements summation, sir. Variable. Sir, here standard word, sir. Standard indicates last year. Standard indicates. Oh, last year variable production cost 11 rupees. Sir, current year variable production cost, sir. Last line. See the last line. So, current year variable production. First, we calculate current year variable production cost. Current year variable production cost. Sir, as per old rates, here production volume 1,60,000 units. So, as per old rates, 1,60,000 into 11. How much? 17 lakhs. 60. As per old rates. But here clearly mentioned, the actual variable production cost for the year were 35,000 higher than last year. Standard means last year. So, compared to last year, how much extra amount incurred, sir? 35,000. So, plus 35,000, plus 35,000, plus 35,000, plus 35,000. 17 lakhs. Madam, current year variable production cost per unit, madam, 11.21875. 11.21. Last year variable production cost per unit 11. This is very useful under marginal costing technique. Marginal costing technique, variable manufacturing cost per unit is very valuable. Under absorption costing technique, total production cost per unit. So, variable production cost per unit. Variable production cost per unit. Variable production cost per unit. 17,95,000 divided by 1,60,000 units. Okay, 11.21. All ingredients ready. Basically, modern method, traditional method. Under traditional method, total production cost per unit. Under marginal costing method, variable production cost per unit. What is the difference, madam? Total production cost per unit, variable production cost per unit. Fixed production overhead cost per unit. Total production cost per unit minus variable production cost per unit equal to fixed production overhead cost per unit equal to 2 rupees. Am I right? 2 na? Variable production cost per unit 2 rupees. Total production cost minus variable production cost equal to fixed production overhead cost. Fixed production overhead cost. Okay. Total production cost per unit minus variable production cost per unit equal to fixed production overhead cost per unit. Here fixed production overhead cost 2 rupees. Variable production overhead cost 11.21875. Therefore, total production 13.21875. 13.2. So, for absorption costing, unit cost equal to total production cost. Total production cost per unit. Unit cost equal to total production cost per unit. 11.21875 plus 2 equal to 13.21. 13.21 for marginal costing. For marginal costing, unit cost equal to variable production cost per unit. Variable production cost per unit is equal to 11.21. Clear? These two related to current period. These two related to Rakesh. One question. I ask you one question. Last year, unit cost under absorption costing method. Last year, unit cost under absorption costing method. Sriram. 13 correct answer. Reason, last year 11. 2 is same. 13. Last year unit cost under marginal costing 11. Now all ingredients ready. Now calculate the profit under absorption costing method. Calculate the profit under marginal costing. Sir, one thing is pending, sir. That is under recovery of fixed production overheads. Here actual volume is less than budgeting volume. But actual volume 1,60,000. Under recovery of fixed production overheads 40,000 rupees. How, sir? Here fixed production overhead rate 2 rupees. Interpretation, for 1 unit output produced in the factory, 2 rupees recovered. 2 rupees recovered. For 1 unit output, 2 rupees amount recovered. So 1,80,000 units produced, 3,60,000 recovered. But here only 1,60,000 units produced. So total amount recovered 1,60,000 into 2, 3,20,000. But paid amount is 3,60,000. Gap amount is, that is under recovery of fixed production also. That is called volume variance adverse. Volume variance adverse. So next point, under recovery of fixed production overheads. Under recovery of fixed production overheads equal to volume. Under recovery volume 20,000 units. 20,000 units under recovery volume. Unutilized volume. This is unutilized volume. Unutilized volume into is equal to 40,000 rupees. Sir, all ingredients ready, sir. Now you can easily calculate profit under absorption costing. You can easily calculate profit under marginal costing. Ready? Okay. First, marginal costing method. Sorry, first one, what they are asking this question? Absorption cost. So profit for the year. Calculation of profit. Listen. Calculation of profit under absorption costing method. Absorption costing method. Absorption costing method. Particulars. Amount. Sir, format, sir. Rakesh. Sales minus cost of goods sold. Gross profit. Under recovery of fixed production overheads. Actual gross margin. Less indirect expenses. Total admin, total selling and correct? Sit down. Sales. I think sales volume 1,50,000 units. Price structure 20. 30 lakhs. Yeah. Next. Less. COGS. Cost of goods sold. So how to calculate cost of goods sold? First calculate total production cost. Total production cost. That is production volume 1,60,000 units. Sir, under absorption costing the unit cost, sir. 13 point value 15. Add opening stock and closing stock. Adjust the inventory levels. Add opening should be added, closing should be. So opening stock 10,000, madam. 10,000 into 13. 1 lakh. Sir, unit cost as per last year, sir, 13 rupees, sir. 11 plus 2, 13. Next, less closing stock. Under absorption costing method, closing stock is valued at total production cost. So total production 20,000 into 21. 2 lakhs. Sir, adjust. 19 lakhs. 625. This is CO B point. A minus B. Gross margin. 10 lakhs. Sir, here adjust the under recovery of fixed production overheads. Here volumes not met with the budgets. So definitely volume variance arise. So less under recovery of fixed production overheads. Amount, sir, 40,000. This is actual gross margin. Actual amount 9 lakhs 375. Next, less indirect expenses. Total admin overhead cost, total selling and here admin nil. I think there is no discussion about the admin content, so no need to write. Less total selling and distribution overhead cost. Selling and distribution overhead cost. Variable at the rate of 3 rupees per unit sold. Am I right? Selling expenses always varies with sales volume. Here sales volume equal to 1,50,000 units into 3 rupees. 4,50,000. Next, fixed, sir. 2 lakhs. Deduct. 370. This is the correct. Main concept important. Unit cost important. Absorption costing method, current period unit cost 13.21875, last period unit cost 13. Now start the work. Under marginal costing technique, current period unit cost 11.21875, last period unit cost, start the work. Main unit cost important. Under absorption costing method, another care, that is under recovery of fixed production overheads. Here actual volume is less than budgeting volume. Definitely volume variance arise. That can be adjusted. Okay. Next. Profit for the year under. Profit for the year under. Profit for the year under marginal costing method. Under marginal costing method. Check the format. Sales minus variable cost of sale, nothing but contribution, minus fixed expenses, profit. Here one thing, all fixed cost elements are treated as a period cost. Only variable elements are charged to the product. So that no need of volume variance, no need to calculate volume variance. Here volume variance doesn't exist. Here volume variance. Sir, a difference between marginal costing method and absorption costing method, important theory question. Under marginal costing technique, classification, variability basis. Under absorption costing classification, functional basis. Here closing stock is valued at variable production cost, marginal costing. Here total production cost. Here volume variance, marginal costing doesn't exist. Under absorption costing may exist. Here decision making is based on contribution. The decision making is based on theory question. Very, very important. Next. Sir, sales. Start with sales. 1,50,000 units into 20 rupees. 30 lakhs. 30 lakhs. 30 lakhs. Less variable cost of sale. This is very, very important. How to calculate variable cost of sale? First, variable production cost. Adjust the inventory levels. Variable COGS. Next, variable admin. Variable selling. Will get variable cost of sale. Variable production cost. Here, variable production cost. Variable production cost. Sir, variable production cost, production volume, 1,60,000. Unit cost, 17 lakhs. 17 lakhs 95,000. Adjust the inventory levels. Opening should be added, closing should be added. Add opening stock of finished goods. 10,000 into last year unit cost. Last year unit cost only 11 rupees. 1,10,000. Less closing stock of finished goods. 20,000 into current year unit cost 11.21875. 2 lakhs. 375. 375. Variable COGS, sir. Sorry. Variable COGS. Yes, variable COGS. 16 lakhs. 625. Next, variable admin, variable selling. I think variable admin, there is no information. Variable selling and distribution. Variable selling and distribution overhead. At the rate of, I think, 3 rupees per unit sold. Here sale volume 1,50,000 into 3. 4,50,000. Add them, 21 lakhs. 620. This is variable cost of sale. This is variable cost of sale. B point, ready. Now revenue minus variable cost of sale equal to contribution. Revenue minus variable cost of sale equal to contribution. Your contributions are 30 lakhs minus 21 lakhs 30,625. 375. 375. This is the contribution. Less fixed cost. So here fixed production overhead, all fixed cost elements are treated as a period cost, completely borne by the company. So fixed production overhead cost, how much? Total fixed production overhead cost, 3 lakhs. 60 is borne by the company. Next, I think fixed admin nil. Fixed selling overhead cost. 3 lakhs, 2 lakhs 70. Answer. 370. This is the nothing but EB80. Under marginal costing technique, EB80 is considered as a profit. Under marginal costing technique, EB80 is considered as profit. Sir, here one thing is observed, sir. Marginal costing profit, profit as per marginal costing, profit as per marginal costing, 2,39,375. Profit as per absorption costing, profit as per absorption costing, 2 lakhs, 2,59,370. Sir, here absorption costing profits is higher than marginal costing profits. Reason, sales volume is less than production volume. If the sales volume is, in this problem, sales volume 1,50,000, production volume 1,60,000. So if sales volume is less than production volume, in that case, absorption costing profits is higher than marginal costing. Here sales volume 1 lakh. Correct? Production volume 1,60,000. So that means sales volume greater than, less than production volume. In that case, absorption costing profits is higher than marginal costing profits. Absorption costing profits is higher than marginal costing. Fundamental rule. Sir, for example, sales volume, production volume, both are same, sir. In that case, profits are same. Sure, 100%. If the production volume equal to sales volume, in that case, absorption costing profits is equal to marginal costing profits. Okay. Next, sir, sales volume greater than production volume. For example, sales volume 1,65,000. Your total availability 170, madam. Am I right? Total availability 170. So sales volume 1,65,000. Production volume 1,60,000. In this case, marginal costing profits is higher than absorption costing profits. Marginal costing profits is higher than absorption costing. In ICAI study material, MCQs, last 3 MCQs, these 3 bits. Volumes are equal, production volume equal to sales volume. In that case, marginal costing profits equal to absorption costing profits. If sales volume is greater than production volume, marginal costing profits is higher than absorption costing profits. Suppose sales volume is less than production volume, in that case, absorption costing profits is higher than marginal cost. Is it clear? Now, one thing is clear. Due to method of inventory valuation, profits are deviated. Am I right? Sir, why, sir? Marginal costing profits didn't agree with the absorption costing profits. Only one reason. Only one reason. Only one reason. That reason is method of inventory valuation. Due to method of inventory valuation, both profits are deviated. Both profits are. I can prove with the reconciliation statement. I can prove with the reconciliation statement. So, reconciliation statement. Reconciliation statement. Reconciliation statement. Particulars. Amount. Suppose start with absorption costing method, we'll get marginal costing profits. Suppose profit as per absorption costing. Profit as per absorption costing method, sir. 2,59,375. One add element, one less element. Sir, here present start with the absorption costing. Sir, please stand in absorption costing income statement. Under absorption costing method, inventory is always overvalued. Correct? Reason? Here inventories are valued total production cost. Therefore, inventory is always overvalued. Inventory is always overvalued. So, opening stock. Under absorption costing method, opening stock value 1 lakh 30. Correct? Opening stock value 1,30,000. Overvalued by 20,000 because it includes fixed production overheads 2 rupees. It includes fixed production overhead cost per unit 2 rupees. So definitely says here opening stock is overvalued by 10,000 into 2, 20,000 rupees. So opening stock, that is debit side element of income statement. Correct? Opening stock, debit side element of income statement. Correct? So if debit side overvalued, automatically profits decrease. Debit side overvalued, profits decline. So profits decline, then you should add back 20,000. Next, closing stock. Closing stock under absorption costing method 2,64,375. It includes fixed production overheads. It includes fixed production overhead cost 2 rupees. 2 rupees into 20,000, 40,000. Therefore, overvalued by 40,000. Overvalued by, sir, closing stock overvalued by 40,000. Income statement credit side part. Credit side part overvalued by 40,000. Automatically profits increase. So, should deduct. 40,000 deduct. Final answer. That is the net profit as per marginal cost. Net profit as per marginal cost. So, very, very, very important question. Profit under marginal costing method, profit under absorption costing method. Difference also important. Next, going to discuss managerial decisions. Managerial decisions about BEP. Managerial decisions about BEP. Managerial decisions about BEP. So now calculate BEP point. For BEP, here also same rules applicable. Classification, variability basis, variable cost and fixed cost. Only variable elements charged to the product. Fixed cost elements considered as a period cost. Same rules applicable for break-even point. So break-even point in units equal to fixed cost divided by contribution per unit. Fixed cost divided by contribution per unit. So number of units to be sold for the recovery of fixed cost is nothing but a break-even point. Nothing but a break-even point. Suppose here fixed cost 10 rupees, contribution per unit 2 rupees. Therefore, BEP units equal to units. Break-even volume equal to 5 units. Break-even volume equal to 5 units. For example, 1 day information, listen. 1 day information. Fixed cost per day, 10 rupees. Fixed cost completely depends on budgeting volume. So, budgeting output per 1 day equal to 10 units. Budgeting output equal to 10 units. So, interpretation. Fixed costs are those costs which do not vary with the volume of output up to 10 units. Next, variable cost per unit 8 rupees. Variable cost per unit 8 rupees. Selling price per unit equal to 10 rupees. Selling price per unit equal to 10 rupees. This is the structure. Structure very, very important. So, here price structure, check there. Price structure means selling price per unit. Selling price per unit 10 rupees. Cost structure means variable cost per unit 8 rupees. Fixed cost amount equal to 10 rupees. Variable nature per unit constant. Fixed nature total constant. So, read the problem, collect the information. This type. Variable cost per unit. Fixed cost total amount. Budgeting volume 10 units. Selling price per unit. So, first budgeting output. Budgeting output revealed, then automatically fixed cost revealed. Reason, fixed cost completely depends on budgeting output. Budgeting output. Next, variable cost per unit 8 rupees, selling price per unit 10 rupees. So, here classification of expenses on variability basis. Variable cost and fixed cost. Variable nature per unit. Fixed nature total. So, here contribution per unit. Contribution per unit. Contribution per unit equal to selling price per unit minus variable cost per unit. Selling price per unit 2 rupees. With 2 rupees margin, total amount of fixed cost to be recovered 10 rupees. So, number of units to be sold 5 units. 5 units. Formula fixed cost divided by contribution per unit. So, this is the 10 rupees selling price per unit. Out of 10 rupees, 2 rupees margin, 8 rupees variable cost. Selling price includes 2 elements, certain amount to variable cost, certain amount to contribution, certain amount to contribution, certain amount to variable cost. Here out of 10, variable cost 8 rupees, fixed contribution, then express in percentage, So, out of 10, 2 rupees contribution into 100, that is equal, this is called PV ratio. This is called PV ratio or contribution ratio or profit volume ratio. So, here PV ratio 20%, variable cost ratio equal to variable cost ratio equal to 100 minus PV ratio. 100 minus, so 100 minus 20 is equal to 80%. 100 minus 20 equal to 80%. 100 minus 20 equal to 80%. So, PV ratio means it is the ratio of contribution to sales. It is the ratio of contribution to sales. It is the ratio of contribution to sales, nothing but PV ratio. Variable cost ratio, another way, variable cost divided by sales into 100. So, variable cost 8 rupees, sales 10 rupees into 100, 80%. That is equal to 80%. So, in this formula, please note this point. If numerator takes for 1 unit volume, denominator also takes for 1 unit volume. 1 unit volume. So, in this example, for example, in this example, BEP volume ready. BEP volume equal to BEP units equal to fixed cost divided by contribution per unit. Fixed cost amount 10. Contribution per unit 2. 5 units. Above 5 units is calling as margin of safety. 6th unit margin of safety. 7th unit margin of safety. 8th unit margin of safety. 9th unit margin of safety. 10th unit margin of safety. Margin of safety units contribution becomes profit. For example, today's sales volume 8 units. Today's sales volume 8 units. Out of that, minus 5, cut, break even to recover the fixed cost. Remaining 3 units is calling as margin of safety. So MOS in units equal to actual sales in units minus BEP in units. So actual sales units, sir. For example, actual sales units 10 units minus BEP units 5 units. Therefore, MOS units 5 units. Today's sales volume 10 units. Out of that BEP break-even sales volume 5. Therefore, margin of safety equal to 5 units. Sometimes question is asking activity level at BEP. It's very, very important. Activity level at BEP. Activity level at BEP or BEP in percentage. BEP in percentage is equal BEP in units divided by budget output into 100. BEP in units divided by, it's very, very important. BEP units divided by budget output into 100. BEP in units divided by budget output into 100. So here BEP in units, sir, in this example 5. Budget output, sir, 10 into 100. That is equal to 50%. Formula important, sir. Activity level at BEP. Activity level at BEP equal to, or BEP in percentage equal to BEP in units divided by budget output into 100. Or BEP in rupees divided by budget sales in rupees into 100. That is also correct answer. So this is very, very simple. BEP in percentage equal to BEP in units divided by budget output into 100. Okay. So here margin of safety, sales volume 10, BEP 5. Therefore, budget MOS equal to 5 units. Suppose profit calculation. MOS in units into contribution per MOS units, sir. First 5 units contribution to recover the fixed cost. Next 5 units contribution becomes, correct, sir? Sir, total 10 units, sir. First 5 units contribution to recover the fixed cost. Next 5 units contribution profit. So 5 units into 2 is equal to 10. As per this formula, MOS in units another way, profit divided by contribution per unit. Profit divided by contribution per unit. Okay. Right. Last one, sir. Sometimes desired profit is given. Desired profit is given. Suppose desired profit equal to, that is desired profit equal to 6 rupees. Desired profit equal to, then calculate the desired sales volume. Formula desired sales volume equal to fixed cost plus profit by, here fixed cost, profit, desired profit 6, contribution per unit 2. Clear? So MOS, next desired sales volume, next BEP. Okay. Under marginal costing technique, only variable cost elements charged to the product. Correct? So variable cost of sale, how to calculate variable cost of sale? I am asking variable cost of sale, how to calculate variable. Direct material cost to direct wage cost to direct expenses cost to variable manufacturing overhead cost. Variable manufacturing overhead cost or variable production overhead cost. These 4 summation is calling as variable production cost or variable manufacturing cost. Suppose if there were no inventory levels, that becomes variable COGS. Srividya, what next? Variable admin overhead cost, variable selling and distribution overhead cost. We'll get variable cost of sale. So sale less variable cost of sale, contribution minus fixed cost equal to profit. Under marginal costing technique, EBIT is considered as profit. Clear? Suppose PAT is given, then immediately converted into EBIT. That is treated as profit, especially in marginal costing technique. Sriram. Sir, CRD2, here company PVC Limited, sir, company sold 55,000 units of its product. Price structure is 375 rupees. So, nothing but selling price per unit, sir. Selling price per unit equal to 375 rupees. Sales volume equal to 55,000 units. Sales volume equal to 55,000 units. Next, variable cost, nothing but variable cost of sale. Variable cost of sale, shortcut name variable cost, 175 per unit. Here explanation also given in the brackets. Variable manufacturing cost 140. That means first 4 elements summation is 140. First 4 elements summation is 140. Next, variable admin content nil. Variable selling and distribution content 375. So finally, total variable cost of sale equal to 140 plus 35 equal to 175. So variable cost per unit to 175. 175. So contribution per unit equal to selling price per unit minus variable cost per unit. 375 minus 175 equal to 200 rupees. This is contribution per unit. Next, fixed costs are incurred uniformly throughout the year. That means daily fixed cost is same. Every day fixed cost amount is uniform, or every month fixed cost is uniform, or every quarter fixed cost is uniform. So a total amount of fixed cost is 65 lakhs. Out of that is one element, that is the non-cost fixed cost element. Non-cost fixed cost element is 15 lakhs. Therefore, cash from fixed cost, cash fixed cost equal to total fixed cost minus non-cash format of fixed cost, that is depreciation, 15 lakhs. So finally 50 lakhs. This is the cash fixed cost. Cash fixed cost, best examples, madam. Rent, very good. Rental charges, salaries paid to staff. Nothing but cash fixed cost. Cash fixed cost elements. So here cash fixed cost element summation equal to 50 lakhs. Total fixed cost is equal to cash fixed cost plus non-cash format of fixed cost. So non-cash fixed cost is nothing but depreciation 15 lakhs. Total 65 lakhs. In large size companies, first we have to calculate cash break-even sales quantity. Next, calculate the total break-even sales quantity. So in case of large size companies, definitely we need to find cash break-even. So cash break-even formulas are cash fixed cost divided by contribution per unit. So here cash break-even equal to cash fixed cost 50 lakhs divided by 200, 25,000 units. That is the cash break even. Next, total break even, sir. That is nothing but break even quantity. Break even sales quantity is equal to total fixed cost to 65 lakhs divided by 200. 32,500. So interpretation, sir. So number of units to be sold for the recovery of total fixed cost is 32,000. That sales quantity is nothing but the break even sales quantity. Next. Madam, specialities of break even point. At break even point, total cost equal to total revenue. Next, at break even point, total fixed cost equal to total contribution. At the break even point, neither a profit nor a loss. Sit down. Next, the PV ratio, sir. PV ratio. C by S into 100. If numerator takes for 1 unit volume, denominator also takes for 1 unit volume. Or if numerator takes for 55,000 units, denominator also takes for 55,000 units. You can select any mode. But condition is if numerator takes for 1 unit, denominator also takes for 1 unit. So here 1 unit value is readily available. Here contribution per unit 200, sales 375 into 100. 53.33%. Some students follows 2 decimals, some students follows 5 decimals. You can select any mode, but answer slight deviated. But 5 decimals gives exact answer, accurate answer. So 53.3333%. This is the PV ratio. Next one. Here there is no beginning or ending inventories. That means variable manufacturing cost, nothing but variable COGS. Am I right? Next. C point. Compute the number of units that must be sold to earn a profit of, under marginal costing technique, EB80 is considered as profit. So desired profit equal to 5 lakhs. 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 Then calculate desired sales volume. Desired sales volume. Desired sales volume. Desired sales volume. Sir, at 55,000 units profit, sir. Sir, here presently volume 55,000 units. At 55,000 units, calculate profit. 55,000 units, calculate profit. At 55,000 units volume, calculate profit. Simply contribution minus fixed cost. 55,000 units contribution equal to per unit contribution 200. 55,000 units contribution, 55,000 into 200. 110 lakhs. Correct? 110 lakhs. Minus fixed cost 65 lakhs. 45 lakhs. So at 55,000 units volume, profit equal to 45 lakhs. I am asked one question. Suppose if firm wants to earn a profit of 45 lakhs. If the firm wants to earn a profit of 45 lakhs, then desired sales volume equal to Directly given, madam. 55,000 units, madam. If the firm wants to earn a profit of 45 lakhs, then desired sales volume equal to 55,000 units. 55,000 units. Presently, desired profit not 45 lakhs, 5 lakhs. Check there one idea. 55,000 units volume gives 45 lakhs profit. So, 5 lakhs rupees profit, then number of units to be sold. Take the proportionate. Sir, logic, sir. 45 lakhs profit at 55,000 units volume. 5 lakhs profit at what volume? Take proportionate. Don't apply proportionate. Here, not applicable. Reason? Fix under marginal costing technique, all fixed cost elements are treated as period cost. All fixed cost elements are treated as period cost. All fixed cost elements are treated as period cost. So, only variable elements travel with the volume. No link with the volume and fixed cost, because under especially marginal costing technique, all fixed cost elements are treated as period cost. Here proposed is not applicable. Some students are saying, sir, logic, sir, 45 lakhs profit amount at 55,000 units volume, then 5 lakhs profit volume, proposed volume, sir. That is 100% wrong. Reason? Under marginal costing technique, all fixed cost elements are treated as a period cost. Here proposed is not applicable, sir. Definitely we can use the formula. We can use the formula. Formula F plus P by contribution per unit. Fixed cost. Desired profit 200. 35,000. So at 35,000 units volume, profit equal to 5 lakhs. So if the company wants to earn a profit of 5 lakhs, then desired sales volume equal to 35,000 units. 35,000 units. Here greatness is desired profit is expressed in rupees. Sometimes desired profit is expressed in percentage. Clear? Sit down. Next, D point. D point. Sir, compute the sales level. Sales level means your question is asking desired sales in rupees. Desired sales in rupees. But here profit expressed 5 lakhs, that is after tax profit. Then immediately converted into EBIT. Then immediately converted into, under marginal costing technique, EBIT is considered as profit. So here profit after tax 5 lakhs, tax rate 40%. That means after deducting the 40% tax, then remaining amount equal to 5 lakhs. So 5 lakhs is equivalent to 60%. So 5 lakhs divided by 60 into 100. EBT equal to 8,33,333. Correct? Sir, your interest on long term debts nil. Therefore, EBT becomes EBIT. So finally, EBIT equal to 8,33,333. So EBIT nothing but desired profit, sir. Desired profit. Desired profit equal to 8,33,333. Desired profit equal to 8,33,333. Next, desired Sales in rupees. So fixed cost plus profit by PV ratio. So here fixed cost, sir, 65 lakhs. Profit, sir, 8,33,333. PV ratio, sir, 0.533333. 137 lakhs, 50,000, 59, 50,859. Sometimes students follows only 2 decimal points. In that case, answer slightly deviated. That is also correct. But this is accurate answer. So desired sales in rupees completed. Next one. So here important, sir, EBIT. Again calculate sales value, but firm wants to earn a profit of, company wants to earn a profit of 20% on sales means desired sales. 20% on sales means 20% on desired sales. So here desired profit equal to EBIT. Desired profit equal to 20% of sales means desired sales. Compared to previous bids, here desired profit expressed in percentage. In previous problem, desired profit expressed in amount, rupees. In this case, a simple logic. When desired profit is given in terms of percentage, then finding factor is assumed to be X. So here finding factor, sir, desired sales in value. So desired sales in rupees, nothing but X rupees. Then desired profit equal to 20% of X, 0.2X. Now you can easily answer the question, sir. Formula desired sales in rupees equal to F plus P by PV ratio. X rupees equal to fixed cost 60 plus profit divided by PV ratio 33333. So cross multiplication, sir, 0.5333333x minus 0.2x equal to 65 lakhs. 0.5333333x minus 0.2. 33x equal to 65 lakhs. X equal to 65 lakhs divided by 0.3333333. Answer 195 lakhs. So this is the final answer, sir. So this is the EBIT, sir. Next, F. Compute the number of units that must be sold. Here company wants to earn a profit of 25% on cost. So your desired profit is given in terms of percentage. So desired profit equal to desired profit equal to 25% on cost. On cost. Then immediately converted into on sales, sir. 25 by 125 on sales. 25 by 125 by 25 by 125 on sales. 25 by 125 nothing but 0.2 on sales. Here desired profit is given in terms of percentage, but here percentage on cost, then immediately converted into on sales. Okay. Thumb rule, standard rule is desired profit is given in terms of percentage, then finding factor is assumed to be X. Here finding factor, sir. Number of units to be sold, nothing but desired sales in units. Desired sales in units equal to X units. Next, desired sales in rupees. Desired sales in rupees. X units into selling price per unit. Correct? Desired sales in rupees equal to desired sales in units into selling price per unit. Here selling price per unit. So final answer 375x. So here desired profit to 0.2%, 0.2 on sales. On sales means desired sales. On sales means, so therefore desired profit equal to desired profit equal to 0.2 into 375x. 75x. Now apply the formula. Desired sales in units. Desired sales in units is equal to F plus P by contribution per unit. So here desired sales in units, sir, X units. Fixed cost 65 lakhs plus desired profit 75x divided by contribution per unit 2. So 200x minus 75x is equal to 65 lakhs. X equal to 65 lakhs divided by 125. 52,000 units. So this is desired profit expressed in percentage. Desired profit expressed in. So marginal costing over, sir. Now next chapter, process costing. Process costing. Basically in cost accounting, two modules are there. Types of costing, techniques of costing. In techniques of costing, standard costing technique, marginal costing technique, absorption costing technique, budgetary control technique. Next, types of costing, job costing, batch costing, unit costing, process costing, service costing. Contract costing deleted in CA intermediate portion. Multiple costing no need. So finally 5. Unit costing, batch costing, job costing, process costing, service costing. Here major chapter is process costing. So cost is ascertained at each stage of production separately. Such type of cost ascertaining program is nothing but process costing. Here more than one stage, not completed in a single stage, not completed in a single stage. So production activity more than one stage. Best example, sugar industry, jaggery industry. In jaggery industry, 2 stages. Process 1, process 2. Process 1, juice extraction. Process 2, boiling. And let them cut the solidified blocks. So that is the process 2. So here 2 stages. Cost is ascertained at each stage of production separately. Such type of cost ascertained program is calling as process costing. Next, main important features. Here classification of expenses. Next, here product cost. Here period cost. Money. Here classification of expenses on what basis? Functional basis. Classification of expenses on functional basis. Total production cost, total admin overhead cost, total selling and distribution overhead cost. Total production cost, total admin overhead cost, total selling and distribution overhead cost. Next, total production cost elements directly charged to process account. Production cost elements directly charged to process account. Anusha, production cost elements includes direct material cost, direct labor cost, direct expenses cost, total production overheads, that includes variable and fixed. Variable and fixed. So same features already discussed in absorption costing method. Same features already discussed in absorption costing method. So here classification on what basis? Functional basis. Production cost elements, total admin overhead cost elements, total selling and distribution overhead cost elements. Production cost elements directly charged to process account. Next, admin overhead cost, selling and distribution overhead cost. These 2 elements directly charged to costing P&L account. So don't charge to process account. Total production cost element, total production overhead cost, total production cost element, process account. Admin overhead cost elements, total admin overhead cost elements to total selling and distribution overhead cost elements. Don't charge it to process account. These 2 elements directly charge it to costing P&L account. So before entering into the chapter, first rules and regulations very, very important. Here classification, functional basis. First one is total production cost elements. Second one is total admin overhead cost elements. Third one is total selling and distribution overhead cost elements. Next, total production cost elements, nothing but product cost. Total production cost elements directly charged to process account. It includes direct material cost, direct wage cost, direct expenses cost, total production overhead cost or total total manufacturing overheads. Production overheads or manufacturing overheads or factory overheads. Here important point, total admin overhead cost elements, total selling and distribution overhead cost elements don't charge to process account, directly charge it to costing P&L account. Costing P&L account. Now here 3 models are there. First one, if there is no work in progress in process unit, if there is no work in progress, if there is no work in progress in process unit, in process center, if there is no work in progress in process, if there is no work in progress in the process center or in process unit, that means all units fully completed. All units, if there is no work in progress in process unit. Next, second model, model 2. If there is a closing work in progress, if there is a closing work in progress in process center, if there is a closing work in progress in process center. Third model, if there is a opening work in progress and closing work in progress in process center. 3 models. If there is a no work in progress in process center, if there is a closing work in progress in process center, if there is a opening and closing work in progress in process center. In last model, unit cost calculation either FIFO method or weighted average method. In last model, unit cost calculation either FIFO method or weighted average method. I will explain these three models with one example, right? Listen. Siva Sports Limited. Company produces and sells a single product. Listen. Cricket bat. So a cricket bat stages, two stages. Stage 1, wood stumps. Buying the wood stumps and converted into bat. Here raw material name is wood stumps. That wood stumps processed into bat shape. That is process 1. That is the forming process. That is the forming process. So forming process. Forming process. Forming process. After completion of forming process, then apply the stickers and glazes. That is the finishing process. That is the finishing department. Finishing process. So this process in forming department, this process in finishing department. So here 2 stages or 1 stage? 2 stages. So then cost is ascertained at each stage. This type of cost ascertaining program is calling as process costing. 2 stages, not a single stage. Suppose total production complete in single stage, that type of costing is calling as unit costing. More than 1 stage, that is called process costing. That is the difference. That is the difference. So forming process, finishing process. Now take process 1, forming process. So before going to cost ascertaining program, first we have to prepare the production statement. First we have to prepare the production statement. Right. Model 1. Model 1 production statement. Model 1 means if there is no work in progress, there is no work in progress in the process center. All units are fully completed. No partly completed units. All units are fully completed. So model 1 production statement. Listen. Production statement. Production statement. Particulars. Process 1 in quantity. Process 1 in quantity. Sir, input in units introduced in process 1, 50. 50 wooden stumps introduced in process 1. Less normal loss as per industry norms. As per industry norms, there is no normal loss. This type of industry, there is no normal loss. Here no normal loss. Normal loss is nil. That is 50 expected output. Expected output. Expected output to 50. Less actual output. Actual output. Actual output also 50. Abnormal loss or gain. Abnormal loss or gain nil. Sometimes actual output is more than expected output, that is called abnormal gain. Sometimes actual output is less than expected output, that is abnormal loss. But here there is no abnormal loss, there is no abnormal gain. So in this model, there is no work in progress. All units are fully completed. For this processing, cost details. For this processing, cost details. Cost details. Raw material cost, that is the wooden stumps cost 7,500 rupees. Next to labor cost for the conversion of wooden stumps into bat. So raw material cost incurred 2,000 rupees. Next overhead cost incurred 6,000 rupees. Total amount 15,500 rupees. 15,500 rupees. Now calculate cost per 1 unit. At the stage of process 1. At the stage of, now prepare the process 1 account, sir. Process 1 account. Process 1 account. Listen. Sir, rules and regulations. Production cost elements directly charged to process 1 account. Admin overhead cost elements, selling and distribution overhead cost elements don't charge to process 1 account, directly charge to. So here, to input raw material introduced. To input raw material introduced. Input raw material introduced. 50 bats, 50 units. Quantity 50 units. Rate per unit. Amount. Here amount is 7,000 and therefore rate per unit 7,500 divided by 50. 150. Next, here there is no additional raw material cost, sir. Here there is no additional raw material cost. Next, direct wage cost. 2,000 rupees, sir. 2,000 rupees. Next, direct expenses nil. Next, total overhead cost. Sir, this overhead nothing but factory overheads. If there is no specific information that overheads incurred during the production process, that nothing but related to factory. If there is no specific information, then that overhead nothing but to factory overhead cost or manufacturing overhead cost. Here manufacturing overhead cost is 6,000. 6. So production cost elements charged to process 1 account. What next? As per industry norms, normal loss units charged to customer. Normal loss units charged to customer. Here important note, while calculating the unit cost, please follow the industry norms. While calculating the unit cost, please follow the industry norms. So as per industry norms, normal loss units charged to customer. Normal loss units, but luckily here normal loss units nil. Now calculate average cost per unit or cost per unit or cost per unit. So step 1, all production cost elements charged to process account. Step 2, as per industry norms, normal loss units pass on to customer. Here important note, while calculating the unit cost, please follow the industry norms. Another important note, don't charge total admin expenses, total selling and distribution cost elements, admin cost elements, selling and distribution cost elements directly charged to. These two nothing but indirect expenses. Clear? Next, cost per unit. Here cost per unit equal to input cost minus realizable value of normal loss. Realizable value of normal loss divided by input in units minus normal loss in units. So eliminate the normal loss units, automatically good units rate per unit is inflated. So as per this formula, one thing is clear, normal loss units eliminated, automatically good units rate per unit is inflated. Suppose in case there is a realizable value of normal loss, that amount also deducted from input cost. So net cost incurred divided by good units, automatically rate per unit is inflated. Okay. Next. So here input cost, sir. Here input cost 15,500 minus realizable value of normal loss nil. Input in units 50 minus normal loss units, nil. Answer. 3-1. Unit cost calculation completed. Once unit cost calculation completed, check. Is there any abnormal elements in this process? Is there any abnormal elements in this process? Rakesh, is there any abnormal elements in this process? There is no abnormal elements, already discussed. Here abnormal loss or gain nil. In case there is abnormal loss, for example 2 units, then immediately calculate cost of abnormal loss. Cost of abnormal loss in that case 2 units into 310, 620. 6, that is the cost of abnormal loss. In case there is abnormal gain 1 unit, so 1 unit into 310, that is cost of abnormal gain. But luckily there is no abnormal loss, there is no abnormal gain. Clear? Huh? Next. Units, settle the account. Settle the account. Units transferred to next process. Units transferred to next process. Units transferred to next process. Here number of units transferred to next process, sir, 50. Per unit value, sir, 15,000. So 50. Don't put up the rate per unit value in total box. Next, 15,000. 15,000. Sir, here one important note, sir. Only cost details are recorded in process account. So here, no profit or loss findings. That means process centers are not responsibility centers. Process centers are only cost details are recorded. Debit side input cost details, credit side output cost details. Always tallied. It is always tallied, sir. That means process centers are not responsibility centers. Process centers are not responsibility centers. This is the model 1. Next, going to process 2. Same procedure. Same procedure. So this is the model 1. Next, model 2, sir. Model 2. Model 2, sir. Listen. Model 2. Production statement in quantity. Process 1 account. Process 1 in quantity. Particulars. Sit down. Sir, same example, but in second model, there is a closing work in progress. There is a closing work in progress. Input in units 50 units, less normal loss, nil, then 50, less closing work in progress 10 units. Closing work in progress. Closing work in progress means introduced in current period but not completed. Units introduced in current period but not completed. That is the closing work in progress. Here closing work in progress work completions 2 types. One is uniform style and another one is non-uniform style. Now I am discussing non-uniform style. Non-uniform style means all raw material items are introduced at the beginning of the process. Next, entering into labor and overheads. This type of work is calling as non-uniform work completion. Once again, all raw material items are introduced at the beginning of the process. That means material work completion is always 100%. After that, labor introduced and overheads introduced. That means these two less than 100%. These two, for example, here raw material work completion 100%, labor work completion 60%, overhead work completion 60%. Overhead work completion 60%. 40. This 40 is calling as expected output as per industry norms. Expected output as per industry norms. Compare with the actual output, sir. Compare with the actual output. 40. So your abnormal loss or gain, nil, sir. Abnormal loss or gain, nil. So this is the second model. What is the specialty in the second model? There is a closing work in progress. In model 1, no work in progress. In model 2, there is a closing work in progress. In this case, how to calculate unit cost? So don't start with the directly process account. First, work is work in progress units converted into equivalent units. Work in progress units converted into. Next, calculate unit cost. Next, apportionment of cost. Next, apportionment of. Then prepare the process account. Then prepare the. But in model 1, directly start with the process 1 account. Directly, all production cost elements directly charged to the product. As per industry norms, normal loss, pass on to customer. Next, calculate unit cost. As per unit cost, units transfer to next process. That is very, very simple. But in this model, work in progress units converted into equivalent units. Equivalent units means nothing but deemed to be fully completed. Next, cost per equivalent unit. Cost per. Next, statement of apportionment of cost. Statement of apportionment of cost. So here, material cost incurred 7,500. Material cost incurred 7,500. Labor cost incurred, sir. See the above information. Labor cost incurred, sir. 2,000, sir. Labor cost incurred 2,000. Overhead cost, sir. 6,000. Same example, convert into model 2. Sir, material cost 7,500. For this amount, work result. Chakradhar, work result. For this amount, material work fully completed for 50 units. Material work fully completed for 50 units. Reason, 25 units already in all segments fully completed. 25 units material work 100% complete. See this. 10 units. 50, total 50. Total 50. Out of 50, 40 units 100% completed in all segments. 40 units 100% completed. All segments. Material work 100% completed. Labor work 100% completed. Overhead work also 100% completed. Correct? Remaining 10 units material work also 100% completed. So, for this amount, 40 units 100% completed plus 10 units also 100% completed. Finally, 50 units. Sir, 50 units material work 100% complete. 50 units material work 100% complete. Just for 7,500. So, for that amount, work result is 50 units material work fully completed. 50 units material work. Next, labor segment. In labor segment, how much cost amount incurred? 2,000 cost incurred. Work result, sir. 40 units 100% completed. 10 units 60% completed. Equivalent units 46. So, For 2000 amount, for this amount, 46 units labor work fully completed. For this amount, 46 units labor work fully completed. For 2000 amount, result 46 units labor work fully completed. So this is the conversion work. Work in progress convert into finished goods or equivalent finished goods. Next, overheads. Overheads. For 6000 amount, 40 units 100% completed. 10 units 60% complete. For this amount, number of units fully completed, sir. 46. Simple logic, sir. Here amount incurred in material account, amount incurred in labor account, amount incurred in overhead account. For that amount, number of units to be fully completed. Then easily calculate unit cost. Here unit cost is equal to 7500 divided by 50. 7500 divided by 50. 150. Next 2000 divided by 46. 43.478. 478. So 47, 5 digits. 2, 6. Next 6000 divided by 46. 4347. So add these three, 150 plus 43.47826 plus 133.43478. Unit cost 323.9130. Is it clear? This is model 2. But in the examination, presentation is different. This information presented in two statements. One is statement of equivalent production. Second one is statement of cost per equivalent unit. Statement of cost per equivalent unit. Statement of cost per equivalent unit. Now, statement of equivalent production. Statement of equivalent production. Statement of equivalent production. Particulars, units in raw materials segment, percentage equivalent units, in labor segment, percentage equivalent units, overhead segment, percentage equivalent units. Dialogue number 1. Units introduced and completed. Sir, here introduced units 50, but introduced and completed, sir, 40, sir. Introduced and completed 40. In all segments, 100% work completed. In all segment, 100% of 40. Next, here, normal loss nil. Next, closing work in progress. Closing work in progress. 10. 100%, 60%, 60%. So 10, 6, 6. Now for 50 units metal work, 50 units fully completed. For 50 units labor work, 46 equivalent. Here for 50 equivalent, 46. 2.5 marks. Clear? Next, statement of cost per equivalent unit. Statement of cost per equivalent unit. Statement of cost per equivalent unit of each element. Statement of cost per equivalent unit of each element. Particulars. Particulars. Raw material cost, labor cost, overhead cost, then total cost. So now input cost posted less realizable value of normal loss, then we'll get net cost incurred divided with the equivalent units. Then we get same process, sir. Model 1 also, in model 1 input cost, same input cost details posted less realizable value of normal loss, then net cost incurred divided by denominator equivalent units. Denominator, for that cost amount, number of units to be fully completed. For that cost amount, number of units to be. In model 1, there is no work in progress. Then directly calculate. Now, there is a work in progress. Then converted into finished goods, equivalent finished goods. So, cost incurred in process 1. Cost incurred in process 1. Sir, raw material cost. Labor cost. Overhead cost. 6. Total cost. Less realizable value of normal loss. Realizable value of normal loss. Nil. Net cost incurred. Net cost incurred. Net cost incurred. So net cost incurred. $15,000. This is A. For this amount, number of units to be fully completed. For this amount, number of units to be. So that is equivalent units. Equivalent units. Equivalent units. 50, 46. Then cost per equivalent unit in each element. Cost per equivalent unit under each segment. Sir, 150. Next one. What? Example. Okay. Example. 43.47. 43.47. 826. Next. 130.43478. 130.43478. Total 323.9130. 5 marks completed. 2 statements. Statement of apportionment of cost. Statement of apportionment of cost. Statement of apportionment of cost. Another name, process cost sheet. This is another name. This is also calling as process cost sheet. Particulars. Amount. Units transferred to next process. Units transferred to next process. I think 40 units. Am I right? 40 units, 100% completed in all aspects. So then equivalent unit cost 323.91304 value 12,000. 957 approximately. 957. Next, cost of closing work in progress. That is 10 units. That is 10 units. That is 10 units. Listen. Sir, your work completion uniform or non-uniform? So then calculate cost segment wise. Raw material cost 10 units into, I think 100% work completed, into 1 answer. 150 into 10, 1500. Labor 10 units into 60% into unit cost 43.47 value to 261. Next, overhead 10 units into 60% into 130.4347. 780. Add them. 540. Was here a small adjustment, sir. This is 260. 2000. 540. Add them. 12,957. 2,543. Tallied. Sometimes 1 rupee excess, sometimes 1 rupee shortfall. In that case, you can adjust that. But main target is here total cost incurred 15,500. So in third statement, apportionment of cost summation is also 15,000. Sometimes 1 rupee may be excess, sometimes 1 rupee may be shortfall. In that case, please adjust in anywhere. So definitely 15,500, here also 15,000. Now process account, prepare the process account, sir. Prepare the process 1 account. Process 1 account. Same to input raw material introduce. To input raw material introduce. Input raw material introduce, sir. 57,000 per unit, 150. Next, direct wage cost 2,000. Overhead cost 6,000. Production cost elements directly charged to process account. Completed. Next, as per industry norms, normal loss nil. Next, by closing work in progress. Closing work in progress 10. So don't put up the unit value because these units are work in progress, not fully completed. 10 units value 2,000. 2,543. 2,543. Next, units transferred to next process. Units transferred to next process. 40. Unit value 323.2. 323.91. 304. 12,957. Tally, sir. 15,500. 15,000. Sir, model 2 completed, sir. Model 2 completed. Next, going to discuss model 3. Model 3, sir. Model 3. So, next period, listen. Next period. Please gathering the details. Next period. Sir, process 1 closing work in progress becomes process 1 opening work in progress. Process 1 opening work in progress. Process 1 closing work in progress becomes again process 1 opening work in progress. These units are not fully completed. Still in process 1 unit. Pending work. Here pending work is labor work pending 40%, overhead work pending 40%. First we have to complete this pending work and then transfer to process 2. Otherwise, still in process 1. So process 1 closing work in progress becomes process 1 opening work in progress for the next period. Anusha, clear? So process 1, listen, process 1 details, opening work in progress, cost already incurred, previous period cost incurred, equal to 2543. Now previous period work completion details, previous period work completion, raw material work previous period 100%, labor work sir, overhead work sir 60%. This is the previous period work completion of opening work in progress. Now pending work is material 0, labor 40, overheads 40. For the next period, first take these units. Now to complete the pending work. Next take the current input. So current input details. Current input 50 units. Raw material cost again 7,500. Labor cost 2,000. Overhead cost 6,000. Now closing work in progress. 5 units. Closing work in progress 5 units. Raw material work 100% completed. Labor work 60% completed. Overhead work 60% completed. Overhead work. Now question is asking calculate cost per unit under FIFO method. Calculate, because in this model there is a opening work in progress. If there is a opening work in progress, then unit cost can be calculated in 2 methods. One is FIFO method and another one is weighted average method. So here calculate unit cost. Calculate unit cost under FIFO method. Calculate unit cost under FIFO method. Sir, simple logic, sir. FIFO method, under FIFO method, cost per unit equal to, please consider current period cost amounts, current period works, current period cost amounts, current period work completion details, current period work completion. That is unit cost under FIFO method. Unit cost under weighted average method, not only current period cost, but also consider this amount, previous period cost incurred for opening work in progress. Denominator, not only current period work details, but also consider previous period work details. So this part opening work in progress part, opening work in progress, previous cost incurred, previous work completion. These part consider, then it is weighted average. Suppose this part eliminated, that is FIFO. Correct, huh? So while calculating the unit cost, this part is considered, that is weighted average method. This part is eliminated, FIFO method. FIFO method means current period cost incurred divided by current period work completion. Current period work completion. Weighted average method, current period cost incurred plus previous period cost incurred of opening work in progress divided by current period work completion plus previous period work completion of opening work in progress. So main difference, opening work in progress, previous work, previous cost. Opening work in progress, previous period work, previous period cost, consider, that is weighted average method. Not consider, that is FIFO method. Clear? Huh? Is it clear? Right. Now, so calculate unit cost under FIFO method. First, production statement. Production statement. Production statement in quantity. Production statement in quantity. Ashrit, in this case, how to prepare the production statement? Okay. Sit down. Opening work in progress, process 1 in quantity. Process 1 in quantity. Opening work in progress. Opening work in progress, sir. Opening work in progress. I think here 10 units, huh? Sir, opening work in progress. 10 units. Next, add current input. Add current input. Current input. Current input to 50. Total 60. Less normal loss. Here normal loss nil. Normal loss nil. 60. Less closing work in progress. Closing work in progress. I think here 5 units, huh? Yes, 5 units. The expected output as per industry norms. Expected output as per industry norms. 50. Next. Next, less actual output. Actual output. 55. Abnormal loss or gain. Abnormal loss or gain nil. Lavanya, units introduced and completed, how much? Units introduced and completed, how much? 45. I will check. Sir, here actual output 55. Opening work in progress units already. Pending work completed. That unit 10, sir. 10 already including actual output. Am I right? So, beginning of the month, first we have to complete 10 units pending work. Then it becomes fully completed. So, the 10 include in actual output. The 10 include in actual output. So, remaining introduced and completed. Introduced and completed. Introduced and completed. Introduced and completed. 45 correct answer. In second way, in second alternative, simple logic. Here current input introduced. Units introduced during the current period 50. Less total scrap nil. Again 50. less closing work in progress 5. So 50 minus 5, 45 is nothing but units introduced and completed. So the best logic in actual output, simply deduct opening work in progress units will get introduced and completed. Introduced and completed. So in model 3, two elements, dangerous elements, opening work in progress and closing work in progress. Right. Next, unit cost calculation under which mode? FIFO mode or weighted average mode? FIFO mode. FIFO mode means eliminate the previous period cost incurred for opening work in progress. Eliminate the previous period work completion of opening work in progress. Only consider current period works, current period cost. Correct, sir. FIFO, previous period work completion of opening work. Eliminate previous period work completion of opening work in progress. Previous period cost incurred for opening work in progress. Only consider current period. Only consider current period. So, statement of equivalent production. Statement of equivalent production. Statement of equivalent production. Statement of equivalent production. Under which method? FIFO method. FIFO method. Particulars, units, raw material, percentage, equivalent units, labor, percentage, equivalent units, overheads, percentage, equivalent units. Sir, method important, sir. FIFO, yes, this method, FIFO method. FIFO method means eliminate previous period work completion of opening work in progress. Only consider current period work completion of opening work in progress. Sir, opening work in progress, current period work completion, Ashrit. Opening work in progress units 10 units, current period work completion. Material already 100% completed. Labor already 60 completed, 40 current period work completion. This is also, so under FIFO method, only consider current period work completion. Here eliminate previous period work completion of work in progress. Only consider current period work completion. So 40% of 10. Next dialog. Units introduced and completed. Here units introduced and completed. 45. 45. In all segments, work completion is so 100%, 100%, 100%. 45, 45. Next, normal loss, nil. Next, closing work in progress. Closing work in progress specialty, units introduced in current period but not completed. Am I right? So here 5. Material work, sir. Material work 100%. Next, labor, overhead. So 5, 3, 3. Sir, in material segment, for current period amount, number of units to be fully completed 50. In labor segment, current period incurred amount 2000, sir. For this amount, number of units to be fully completed, sir. 52. Correct, 52. Next, this is also 52. This is 60. Clear? Now calculate unit cost. Calculation of cost per equivalent unit. Calculation of cost per equivalent unit of each element. Under FIFO method. That means eliminate the previous period cost incurred for opening work in progress. Only consider current period cost incurred. Only consider current period cost incurred less realizable value of normal loss. Then we get net cost incurred. Then take the current period equivalent units. Current period. Then we'll get the unit rate as per current data. Unit rate as per current data, nothing but FIFO. Okay, right. Raw material cost. Next, labor cost. Next, overhead cost. Next, total cost. Next, total cost. Particulars. Sir, FIFO method, sir. Current period cost incurred. Current period cost incurred. Sir, current period cost incurred, sir. In material segment 7,000, labor cost, overhead cost, total. This is A. B. For this amount, number of units to be fully completed. So this is the equivalent units. This is the equivalent units. For this amount, number of units to be fully completed, sir. 50. Next, 52. Next, 52. Sir, cost per equivalent unit, sir. Cost per equivalent unit. A by B. 150. 30. 15. 4615. 46154. Next. 115.38462. Summation. 303.8461. This is unit cost calculation under FIFO method. Unit cost calculation under FIFO method. So next apportionment, next preparation of process account, that is common. Main important these two statements. Unit cost calculation very, very important. Next, sir, weighted average method. Weighted average method. Weighted average method. Statement of equivalent production. Statement of equivalent production. Particulars, units, raw material, percentage equivalent units, labor, percentage equivalent units, overheads, percentage equivalent. Now, here, not only current period work completion, but also consider previous period work completion of opening work in progress. Now, see the difference. Listen, opening work in progress. Last time opening work in progress, sir. Only current period work completion is considered. Now not only current period work completion, but also take the previous period work completion. So that means 0 plus 100. 0 plus 100 means 100%. 0 plus 100, 100%. 0 current period work completion. Previous period work completion 100. Next current period work completion 40. Previous period work completion equal to 100. Current period work completion 40 plus previous period work completion equal to 100%. So 10, 10, 10. That is the difference. Next remaining part, introduced and completed. Introduced and completed, sir. 45, 100%, 100%, 100%. 45, 45. So now total units completed, sir. Total units completed. Total units completed 50. Total units completed 55. 100%, 55. 100%, 55. 100%, 55. In the examination, no need to show the segregation. No need to show the directly units completed, take 55. Units completed, take 55. Just for classroom purpose, segregation mentioned. Otherwise, no need. Just difference between FIFO and weighted average. In the examination, directly start with total units completed equal to 55. Total units completed equal to 55. So in all segments, 100% completed, sir. Here opening work in progress 100, 100, 100. Introduced and completed 100, 100, 100. So all units are put in one bag. All units are put in one bag. Because all units are in 100% segment. So no need to show the segregation. Directly start with the total units complete. Total units complete. Next, normal loss, sir. Normal loss, nil. Closing work in progress, sir. Closing work in progress 5. Next, 100% work completed, 60% work completed, 60% work completed 5, 3, 3. Sir, 60, 60, 58, 58. Okay, now calculation of cost per equivalent unit of each element. Calculation of cost per equivalent unit of each element under which method? Weighted average method. Weighted average method. Particulars, units. Next, sorry, not units. This is the cost per equivalent. Raw material cost, labor cost, overhead cost, total cost. Total cost. Dialogue number 1. Sir, under weighted average method, not only current period cost incurred, but also consider previous period cost incurred. That is the difference. Previous period cost incurred. Previous period cost incurred for opening work in progress. For opening work in progress. Previous period cost incurred for opening work in progress. In material 1500. Material 1500. Next 260. 260. Madam, adjusted, madam, 1 rupee. Next 783. 783. Summation. 2000, 2543. 2543. Next, current period cost incurred. Current period cost incurred. Current period cost incurred. 7,500, 2,000, 6,000. Total 15,000. Next, less realizable value of normal loss. Realizable value of normal loss. Nil. Then we'll get net cost incurred. Net cost incurred. Net cost incurred. Sir, net cost incurred, sir. 9,000. Next. 2,260. 6,000. Okay. 18,000. 18,043. Okay. Now, B point. Equivalent units. For this amount, number of units to be fully completed in material segment, sir. 60. For this amount, number of units to be fully completed in labor segment, sir. 58. This is also 58. So, cost per equivalent unit. Cost per equivalent unit. A by B. 150. Okay. 55. Next. 94. 82. Summation. 305.913. All models completed, sir. All models completed. First, there is no work in progress. Next, if there is a closing work in progress. Next, if there is a opening and a closing work in progress, in that case, before and so take the problem. Sir, an English willow company who manufactures cricket bats. Company manufactures cricket bat. Buys wooden stumps as it is a direct material. The forming department processes the cricket bats, and the cricket bats are then transferred to finishing department where stickers are applied. Stickers are applied. The forming department began manufacturing 10,000 initial bats. So that is the input quantity introduced. Input quantity introduced 10,000 bats, sir. During the month of December for the first time. This is the beginning of the year, sir. That is the first year. There is no openings. There is no opening work in progress. Okay. So here input quantity introduced, sir. Input to 10,000 units or 10,000 bats. Next, sir, cost details are as follows. Direct material cost 33,000. Conversion cost means labor and overheads merge. The summation of labor cost and overhead cost is nothing but conversion cost. So in this case, we can provide only two columns. One is material segment and another one is conversion segment. Okay, next. A total of 8,000 cricket bats were completed. So that means 8,000 cricket bats were completed means 100% completed in all segments. Next, and transfer to finishing department. Okay, Rest of them 2000. That means total introduced 10,000, 8,000 100% completed, 2,000 closing work in progress. Closing. Here one thing is clear, normal loss nil. Less normal loss nil. Normal loss nil. So 10,000. Let's closing work in progress, sir. Closing work in progress 2000. Expected output. Expected output 8,000. Expected output to 8,000 less actual output 8,000. Abnormal loss or gain? Nil, sir. Right. So next, the rest of 2000 were still in forming process at the end of the month. All the forming departments direct metals were placed. That means all material items are placed at the beginning of the process, so that material work completion is always. All material items are introduced at the beginning of the process, so that material work completion is always 100%. But on average, only 25% of the conversion cost was applied to the ending work in progress inventory. That means here conversion segment work completion is only 25%. In material segment work completion is 100%. So this is non-uniform. This is non-uniform. Non-uniform. Right. Now, shortcut method. 33,000 material. In material account, 33,000 cost incurred. Output details, 8,000 bats, 100% completed. Next, work in progress, 2,000 bats. This is also 100% completed. Finally, 10,000. So 33,000 amount gives 10,000 bats. 100% material work completed. 100% in material segment, 33,000 rupees cost incurred. For that amount, number of units to be fully completed, 10,000. Next, labor and overheads. Here 8,000 units, 100% completed. 2,000 units only 25% completed. 8,500. So finally 33,000 divided by 10,000 unit cost 3.3. Next 17,000 divided by 8,500 2 rupees. Finally 5.3. Correct, sir? So first bit equivalent units of production, sir. Equivalent units of production. Equivalent units of production. Equivalent units of production 10,000 units, 8,500 units. Next, calculation of cost per equivalent unit of each element. Each element, one element 3.3 and another element 2 rupees, total 5.3. Next, cost of closing work in progress and cost of finished goods. So here cost of finished goods value, sir. Finished products, units transfer to next process. Units transfer to next process 8,000. 100% completed into 5.3, 42,400. Next, work in progress. Work in progress, sir. One by one, raw material work, sir. 2,000 into 100% work completed, sir. Into 3.3, 6,600. Next, conversion cost 2,000 units, sir. 25%, sir. Into 2 rupees. 1 total, sir. 7,600 plus 42,400, sir. Tallied, sir. In case this question is appearing in MCQs, you can easily answer. 2 marks, 2 marks, 2 marks, 6 marks. In MCQ, each question 2 marks. Part 1, paper 1, part 1. Okay, right. This is the model 2 or model 1, this one? Model 2, model 2. Model 1, no work in progress. Model 2, there is a closing work in. Model 3, opening and closing work in progress. In opening and closing work in progress, again, two options. FIFO method, weighted average method. So this is the solution, sir. Next, CRD2. CRD2. Sir, Healthy Sweets is engaged in the manufacturing of jaggery. Its process involve sugarcane crushing for juice extraction. That is process 1. In jaggery industry, process 1 is juice extraction from sugarcane. Next, juice filtered and boiling along with some chemicals and then letting it cool to cut the solidified blocks. That is process 2. So finally, process 1 is juice extraction, process 2 is filtered and boiled. So that means here 2 stages, not a single process. It is a 2 stages. So cost is ascertained at each stage of production. Such type of cost ascertained program is calling as process costing. Next. So here experience provided, sir, for manufacturing 10 kgs of jaggery, nothing but 10 kgs of output, nothing but 10 kgs of output. 100 kgs sugar cane is required. 100 kgs sugar cane introduced into process 1. It gives 10 kgs output. It gives 1, 2, final will give 10 kgs output. But in process 1, first 100 kgs sugar cane introduced, juice 45 liters. Juice, sir, doubt, sir, material unit kgs, sir, juice unit liters. Don't worry, here clearly mentioned. Here consider mass of 1 liter equal to 1 kg. That means 1 liter nothing but 1 kg. 1 liter nothing but 1 kg. So here clearly mentioned 100 kg sugar cane introduced in process 1. Therefore, process 1 output equal to 45 liters or 45 kgs of juice. 45 liters or 45 kgs of juice. So that means as per industry norms, 55% of input is normal loss. That is the processing loss. That is unavoidable loss. Correct? So here normal loss internally given, mentioned in the problem, not straight away, indirect way. So 100 kg sugar cane introduced in process 1, it gives process 1 output only 45 kg of juice. So that means 55% on input is nothing but normal loss. Next. Sir, here only process 1 details are given, sir. So don't do the process 2, only process 1, sir. Following information relating to process 1 has been obtained from the manufacturing department of Healthy Sweets for the month of January. For the month of January month. Okay. Ganesh, January month opening work in progress quantity 4,500 liters. Last month process 1 closing work in progress. December month process 1 closing work in progress becomes January month process 1 opening work in progress. Clear? 4,500 liters, nothing but 4,500 kgs. Sir, previously cost incurred for opening work in progress, sir. Previously cost incurred for opening work in progress 50 1545. 1 lakh. 1 lakh. 10,000. Sit down. Chakradhar, previously work completion for opening work in progress. Previous period work completion details for opening work in progress. Not available in the problem. There is no information about previous period work completion. There is no information. Hello, there is no information about previous period work completion of opening work in progress. Don't worry, because here questioner is asking weighted average method. Under weighted average method, advantage, previous plus current, add them, will get 100%. So that no need of that information. Under weighted average method, flexibility, weighted average method, previous period work completion plus current period work completion, always equal to 100%. So no need of previous period work completion details of opening work in progress under weighted average method. In case FIFO method, definitely we need. In that case, definitely provided that information. But here questioner is asking weighted average method. Under weighted average method, no need of previous period work completion of opening work in progress, because here segregation not required. So here our total units completed equal to 100%. Equal to, already I told in example. Okay. Next, sugar cane introduced for juice extraction. This is the current input, sir. Is the current input, sir. Next, current input to material cost, sir, 5 lakhs, sir. Labor cost, sir, 2 lakhs, sir. Overhead cost, so here abnormal loss. Degree of completion of sugar cane 100%, labor 80, overheads also 80. Closing stock of work in progress 9,000 liters. Sugar cane 100%, labor 80%, overheads also 80%. Finally, juice extracted and transferred to process to only 39,000. That is the actual output in process 1. Actual output in process 1. Now prepare the production statement. Now prepare the production statement. Production statement. Sit down. Production statement in quantity. Production statement in quantity. Ashrit format. Opening work in progress number 4500 liters or kgs. Here 1 liter equal to 1 kg. So you can select any unit. So process 1, that is juice extraction from sugar cane. So in kgs. Opening work in progress. Opening work in progress 4,500. Next, add current input, sir. Add current input. I think here current input is 1 lakh kgs. Total input, sir, 1,04,000 less normal loss. Normal loss, that is 55%. Already experience given. As per company experience, 100 kg sugar cane introduced. 100 kg sugar cane introduced. It gives only 45 kg juice. That means 55% on current input. Always current input, sir. So 55% of 1 lakh. 55,000 units. 49,500. So less closing work in progress, sir. Closing work in progress 9,000. So expected output as per industry norms 40,000. 40,500. 40,500. Less actual output, sir. 39,000. So abnormal loss or abnormal gain, sir? Abnormal loss. One. So please cross check. Here abnormal loss also mentioned 1,000 serum. Clear? Now, Rakesh, out of 39,500 introduction completed. So in 39,500 opening work in progress units 4,500. Opening work in progress 4,000. Introduction completed 35. So in another way, current input 1 lakh. Let's total scrap per unit. Total scrap means expected plus unexpected. 55 plus 1, 56. Total scrap means expected plus unexpected. 56. 1 lakh minus 56. 1 lakh minus 56. 44. 44 minus closing work in progress 9,000. Tallied, huh? Tallied, sir. But a simple shortcut, take the actual output, deduct opening work in progress, then we'll get units introduced and complete. Units introduced and completed, sir. Now, first statement of equivalent production. Statement of equivalent production under WAM, weighted average method. Weighted average method. Particulars, units, raw material segment, percentage equivalent units, labor segment percentage equivalent units, overhead segment percentage equivalent units. Percentage equivalent units. Sir, first opening work in progress. No need to segregate because opening work in progress previous plus current both are equal to, both summation equal to 100%. Introduction complete also 100%. So that means here 39,500 units, all units are in same work completion. That is 100%. So finally, no need to segregate, sir. Simply total units completed. Total units completed. Sir, total units completed, sir. 39,500. 39,500. 100%. 100%. 100%. 100% of 39,500. Here also. Next, sir, eliminate the normal loss units, sir. Here normal loss units 55,000, sir. Eliminated. 55,000 is eliminated. Eliminate means hyphen. So no need to count that. Simply hyphen. That means eliminate the normal loss units. Automatically good units rate per unit is inflated. Next, closing work in progress, sir. 9,000. Percentage of work completion, sir. 100, 80, 80. 100, 80, 80. So 100% of 9,000, sir. 80% of 9,000. Here 7,000. Correct, huh? Next, abnormal loss. Sir, definitely consider the abnormal loss. Suppose you cannot consider, ultimately this loss also pass on to, that is fundamentally wrong. That is fundamentally wrong. Suppose this element cannot consider, automatically good units rate per unit is, that is fundamentally wrong. Only normal loss pass on to customer. Only normal loss pass on to, abnormal loss can't pass on to customer, sir. So abnormal loss units 1000. Yes. So 1000 units percentage of work completion, sir. 100, 80, 80. 1000, 800, 800. Now 39,500 plus 55,000 plus 9,000 plus 1,000. 1 lakh. Please check total input also 1 lakh. Tally 1 lakh 4,500 correct answer. Next. 49,000. Next. 47,000. Clear? Next. Second statement. Statement of cost per equivalent unit. Statement of cost per. First point, previous period cost incurred for opening work in progress, because this is weighted average method. Under weighted average method, not only current period cost but also consider previous period cost. So here mention, sir. So cost of opening work in progress also consider. Next, current period cost incurred also consider, sir. So previous period, current period, both are considered. So therefore total cost 5 lakhs 50, 2 lakhs 15, 6 lakhs 45, total 14 lakhs. Less realizable value of normal loss. Here realizable value of normal loss, I think nil. Nil, sir. Realizable value of normal loss nil. So net cost incurred, this is A. Equivalent units, then cost per equivalent unit is 11.1111, 4.526, 13.57. Next, same statement of apportionment of cost. Next, process account. So this is the process costing, sir. So next chapter ABC. Right. Sir, already overheads charged to each product under absorption costing method already discussed. Suppose if company produces a single product, in that case absorption costing method is sufficient. In case company produces more than one product, in case company produces more than one product, in that case definitely we can use ABC approach. Otherwise cost distortion arises. Otherwise cost distortion. Suppose in case if company produces more than one product, in that case company follows absorption costing method, definitely cost distortion arises. Cost distortion means undercosted or overcosted. Undercosted or. So final conclusion, in case company produces more than one product, we can use ABC approach. We can use ABC approach. What is the difference between absorption costing and activity based costing? Under absorption costing method, we assume that total factory overheads varies with a single driver. Under absorption costing method, we assume that total factory overheads varies with a single driver. So that mission hour rate is used. And for example, choose the mission hours as driver name. Then write down the assumption. What is the assumption? We assume that total factory overheads varies with mission hours. So that mission hour rate is used to charge the overheads to the product. Then calculate the rate. That rate can be used for calculating absorbed overhead cost or overhead charged to product. So that is the absorption costing method. But practically, total overheads doesn't move with a single driver. Total overheads can be divided or can be identified different activities. For example, total factory overheads can be identified 3 different activities. One is machine setup activity, machine running activity, product inspection activity. All these cost elements varies with the machine hours, totally wrong. But in absorption costing method, assumption. In absorption costing method, assumption. What is the assumption? All overhead elements moves with the single driver, namely machine hours. But in practically, that is wrong. That is wrong. Because in machine setup time, overhead cost amount incurred, that overhead amount linked with machine setup time, not machine running hours. Machine running time overhead cost amount incurred, that amount to link with the machine hours. That is correct. Next, product inspection activity. In case of product inspection, company has set up a laboratory for testing its quality of its goods. Definitely overhead cost amount incurred. That overhead cost amount linked with the setup time. But in absorption costing method, not like that. Purely write down a simple assumption. All overheads varies with the single driver, that is machine hours. So that definitely cost distortion arises. Cost distortion. Suppose in case company produces single product, in that case no problem. For suppose company produces more than one product, definitely we can use activity based approach. Otherwise cost distortion arises. Clear? So this is the fundamental rule. In absorption costing method, we assume that total factory overheads varies with a single driver, namely, for example, machine hours. Therefore, machine hour rate is used to charge the overheads to the products. But in reality, total factory overheads not linked with the machine hours. Out of total factors, certain amount to link with the machine hours. Remaining amounts link with other drivers. But absorption costing method, write an assumption. Assume all overheads amounts link with the machine hours. Break that assumption. Now break that assumption. Then ABC approach is entering. Under ABC approach, overhead rates calculated, not single rate, multiple rates. Suppose total factory overheads can be identified 3 different activities. You can calculate 3 different rates. Suppose total factory overheads can be identified 5 major activities. You can calculate 5 driver rates, 5 rates. These rates are used to allocate the overhead cost to each product, or these rates are used to charge the overhead cost to each product. Then calculate the overhead cost per unit. This is more accurate value. This is more than absorption costing method value. So in this chapter, 3 models are there. One is manufacturing concern. Second one is trading concern. Third one is service sector. Service sector means banks. So manufacturing concern. Next, trading concerns. Next, service sectors. In manufacturing concerns, calculate manufacturing cost per unit. So in manufacturing cost per unit, what are the elements involved? Money. In manufacturing cost, what are the elements involved? Direct material cost, direct labor cost, direct expenses cost, and also overhead cost, Factory overhead cost or manufacturing overhead cost. Add them, we get manufacturing cost per unit. In trading concerns, questioner is asking calculate the operating income. How to calculate operating income? Sales plus COGS will get gross profit less operating activities cost. Operating, here operating activities cost nothing but administrative overheads and selling and distribution overheads. Calculate the rates and allocate operating activities cost. We'll get the operating income. Next, service sectors. Here service overheads are given. Calculate the rates and allocate the service sector products. So these are the models. Now I will explain one model, that is the manufacturing concerns. Basic rule, simple. Total factory overheads identified with different major activities. Next, rates calculation. Next, allocation. Finally, we'll get overhead cost per unit. Compare with absorption costing method, then definitely cost distortion arises. So to avoid the cost distortion, stop the absorption costing approach, implement the ABC approach. In case company produces more than one product, definitely we can use ABC approach. In case single product, we can continue with the absorption method. Right. Siram. Right. Okay. So there is no information about activity based costing. Don't worry. I will explain with one example. Okay. Right. Example. Listen. Total factory overheads during a certain period. Total factory overheads during a certain period of 1 lakh rupee. Next, here driver name, machine hours. Presently, company follows absorption costing method. So choose the driver name, machine hours. Next, total machine hours spent during the period. 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 10,000 hours. 10,000 hours. Next, here production details. Product A, product B. So your company produces 2 products. In this case, definitely we can use ABC, but presently company use absorption costing method. So here production units, 100 units, 200 units. 200 units. Production units, 100 units, 200 units. So calculate calculate overhead cost per unit under absorption, overhead cost per unit of each product under absorption costing method. Under absorption costing method. Absorption costing method, another name, conventional method or traditional method. Traditional method. Now take the solution. Choose the driver name. Driver name is mission hours. Next, to write down the assumption. We assume that total factory overheads varies with mission hours, so that mission hour rate can be used to charge the overheads to the products. Correct? Huh? So mission hour rate or overhead rate per mission hour. Total factory overhead cost, how much? 1 lakh. Divided by 10,000 hours. 10 rupees per mission hour. 10 rupees per mission hour. That means 1 hour mission running in the factory, estimated overhead amount equal to 10 rupees. Correct? Huh? Okay. Now, this is the mission hour rate. What next? Charge. This rate is used to charge the overheads to the products. So, product A, product B. Absorbed factory overhead cost. Absorbed factory overhead cost. So, I think rate into actual mission hour spent. Actual mission hour spent. So, here total 10,000 hours, sir. Out of that 4,000 hours spent for product A, 6,000 hours spent for product B, sir. 4,000 hours spent for product A, 6,000 hours spent for product B, sir. So, here 4,000 hours into 10 rupees equal to 40,000. Here 6,000 hours spent for product B, 6,000 hours into 10 rupees equal to 60,000. Okay, now production volume. Production in units. Here 100 units, here 200 units. Finally, overhead cost per unit. Per unit value 400. Here per unit value 300. So, this is the overhead cost per unit of A, overhead cost per unit of B under which method? Absorption costing method. This is very, very simple. But here this is not correct, because here company produces multiple products. Definitely we can use ABC approach. Definitely cost distortion arises. I can prove. I will calculate cost distortion. Now going to ABC approach. ABC approach. In ABC approach, first point, total factory overheads can be identified different major activities. Suppose here activity name or cost pool name, activity name or cost pool name, cost pool name. So here activity name, first activity, machine setup activity, machine setup activity, next machine running activity, machine running activity, next one is product inspection activity, next one is product inspection activity, product inspection activity. This is in-depth analysis. So totally incurred 1 lakh. Out of 1 lakh, During the machine setup time, cost pool amount, cost pool in rupees equal to, that is the overhead cost amount equal to 15,000. 15,000. So during the period of setup time, overhead cost element summation equal to 15,000. Next, during the running time, overhead cost amount. During the running time, overhead example, power. Best example, power. Power consumption only in running time. So during the running time, power cost 60,000. Next, after completion of the product sent to laboratory for testing its quality, in quality inspection cost, overhead cost 25,000. During the inspection time, overhead cost amount equal to 25,000. Total, sir? Total 1 lakh. This is more accurate. Previously, total amount varies with machine hours. Now, only machine running time varies with machine hours. But 15,000 amount driver name, not machine hours, sir. This is setup time. This is setup time. Setup time increases. Machine setup time, suppose machine setup time increases, overhead cost amount also increase. Setup time decreases, overhead cost amount also. So there is a link between the setup time and machine setup cost. Clear? Next, inspection time. This driver name is inspection time. Inspection time. Previously, total 1 lakh varies with machine hours. Now, only 60,000 amount varies with machine hours. Remaining amounts, 15,000 varies with the setup time. 25,000 amount varies with inspection time. That is directly given in the problem. Directly given in the activity names directly given, activity amounts directly given, driver names also directly given. Just select machine running activity driver name, machine hours, machine setup activity driver name, setup time. Suppose sometimes setup time not given in the problem, then take the second alternative, setup number of setups, number of first priority, first select the first priority. If there is no information about the first priority, then take the second alternative. Second alternative in case number of setups. Next, inspection time. Suppose if there is no information about inspection time, then take the second alternative, number of inspections. Number of inspections. Clear? Now, sir, total machine hours spent in this example. Total machine hours spent, I think 10,000 hours, sir. 10,000 hours, sir. Yes, 10,000 hours. Out of that, 4,000 hours spent for A, 6,000 hours spent for product B. Okay. Now, setup time. Setup time 5,000 hours, sir. Inspection time also 5,000 hours. Inspection time also 5,000 hours. 5,000 hours. So, this is the cost driver name. Cost driver name. 15,000 cost driver name is 15,000 cost driver name setup time. 60,000 amount driver name is machine hours. 25,000 driver name is inspection time. 25,000 driver name, sir. Inspection time. Next, this is the CDQ, cost driver quantity. Cost driver quantity. For 15,000 amount total working hours 5,000 hours. For 60,000 amount working hours equal 10,000 hours. For 25,000 amount working hours equal to 5,000 hours. Clear, sir? Now, here cost driver quantity product wise, sir. Cost driver quantity details product wise. Product A, product B, product A, product B, total. First, inspection time, driver name. Inspection time. Total inspection time, sir, 5,000 hours. Out of that, 1,500 hours spent for product A. 1,500 spent for the production of product A. Total setup time equal to 1,500 hours. Product B spent for 3,500 hours. 3,000. Next, machine hours, machine running time. Machine hours. Product A spent previously 4,000 hours. 4,000 hours. 6,000 hours. Total 10,000 hours. Next, inspection time. Sorry, inspection time already mentioned. Next one, setup time. Setup time. Setup time is, this is 3,000 hours. This is 2,000 hours total. This is the information. This is the information. Calculate overhead cost per unit of each product under ABC approach. Previously, overhead cost per unit under absorption costing method. Now, ABC approach. Calculate overhead cost per unit. Calculate overhead cost per unit under ABC approach. Under ABC approach. Under ABC approach. Under ABC approach. So, first, same procedure. First, calculate rate calculation. Previously, that is called overhead rate. Now, it is called as cost driver rates. Now, it is called as. So, cost driver rates calculations are simple. Activity name, cost pool name, cost driver name, cost driver quantity. Last one is cost driver rate. So, here, cost driver rate. Cost driver rate. Column 1, column 2, column 3, column 4, column 5. So, cost driver rate. So, a total amount incurred during the machine setup time 15,000. Total hours spent 5,000 hours. 15,000 divided by 5,000 hours. 3 rupees per setup hour. Next, during the running time, overhead cost amount incurred 60,000. 10,000 hours machine running time. So, 10,000 hours amount is 60,000 per hour amount 6 rupees per machine hour. Next, 25,000 divided by 5,000. 5 rupees per inspection of inspection hour. Inspection. So, definitely here allotted 3 marks, sir. So, main presentation important. Activity name, cost pool amount, cost driver name, cost driver quantity, cost driver rate. Cost driver rate. Now, these rates are used to allocate the overhead cost to each product. To allocate the overhead cost to each product. So, statement of apportionment of overhead cost. Statement of apportionment of overhead cost and overhead cost per unit and overhead cost per unit of each product under ABC approach. Under ABC approach. So, statement of apportionment of overhead cost and overhead cost per unit of each product under ABC approach. So, here particulars. Sir, names. Product names. Product A, CDQ amount. Product B, CDQ amount. CDQ amount. Now, charge one by one cost element. Here, three cost elements. One is setup cost. Second one is machine processing cost or machine running cost. Third one is inspection cost, product inspection cost. First one is machine setup cost. Machine setup cost at the rate of 3 rupees per setup. So your number of setups consumed for product A, 3000 hours. Correct? Huh? Setup time 3000. Here 2000 hours. 3000 hours into 3. Here. So summation 15 tallied. Huh? Next cost. Machine running cost or machine processing cost. Machine running cost or machine processing cost at the rate of, I think 6 rupees, madam. 6 rupees, huh? 6 rupees per hour. 4,000 hours. 6,000 hours. 4,000 hours into 6. 24,000. 36. 24 plus 36, 60. Tallied, huh? Tallied, sir. Tallied. 15,000 tallied, 60,000 tallied. Next, product inspection cost. Product inspection cost. Product inspection cost at the rate of 5 rupees per inspection hour. Sir, product A inspection hours 1500 hours. 3,500 hours. 7,000. Next. Summation 20. So total overhead cost, sir. Total overhead cost of product A 7500, 24,000, 9,000. 24 plus 9, 33. 40,000. Here 59,000. Correct? 17,500, 36,000, 6,000. So 59,500. 59,500 plus 40,500. 1 lakh tallied. So now A, B. Production in units, sir. Production in units. 100 units. 200 units. So here overhead cost per unit. Overhead cost per unit 405. This is the accurate value. 297.5. Original values. Accurate values. Now, statement of cost distortion. Statement of cost distortion. Cost distortion. Product A, product B. Product A, product B. Particulars. Right. Overhead cost per unit on machine hours basis. Overhead cost per unit on machine hours basis. On machine hours basis, overhead cost per unit of A. 400, sir. 400. 400. But accurate value, sir, overhead cost per unit under ABC approach, sir. Overhead cost per unit under ABC approach. Under ABC approach. 400. So, suppose if company follows absorption costing method, in that case, 400 rupees overhead cost amount charged. Am I right? But in reality, original value is, so that is undercosted. That is undercosted. Automatically margins declined. Company margins declined. Company margins declined. Automatically profits affected. Profits affected. So here original value 405, but if company follows absorption costing method, in that case overhead amount charged to product A equal to only 400 rupees, but real value 405. So undercosted by 5 rupees. Undercosted by 5 rupees. Undercosted by 5 rupees. So due to undercosted, margins declined. Margins declined. Product margins declined. Product margins declined automatically. That affects profits declined. Next. This one. 300. 297.2. Sir, original value 297.5, but charge amount is 300. This is overcosted by 2.5 rupees. Overcosted by 2.5 rupees. Automatically sales graph gradually decrease compared to other competitor. So here product price extra amount 2.5 rupees. Same product, same quality, but our company product selling price increased by 2.5. Automatically sales gradually decrease. Sales decrease, automatically profits decline. So this is overcosted. So undercosted, overcosted, both are negative. Undercosted, negativity to the negative sign to the company. Overcost is also negative sign to the company. So to stop the undercosted, overcosted, please use the ABC. So we can use ABC approach simply to avoid the cost distortion. Simply to avoid the cost distortion. Cost distortion. So this is the activity based costing. This is the activity based costing. Okay. Next. Right. So this is another important chapter. Cost accounting system. Nothing but bookkeeping. Nothing but bookkeeping. In cost accounting, bookkeeping, two styles. One is non-integrated accounting system, integrated accounting system. Non-integrated accounting system. Second one is integrated accounting system. So in cost accounting, bookkeeping can be done in two ways. Non-integrate mode, integrate mode. Non-integrated means where two separate sets are maintained. It is the accounting where two separate sets are maintained. One for cost records and another for So it is a system of accounting where two separate sets are maintained. It is a system of accounting where two separate sets are maintained. One for cost records and another for financial records. So in financial records, only actual data posted and then calculate the profit through trading and profit and loss account. Through trading and profit and loss account. So it is a system of accounting where two separate sets are maintained. One for cost records and another for financial records. So how to prepare the financial records? Simple. Only actual data. Only. So actual material cost incurred, posted. Actual wage cost incurred, posted. Actual direct expenses incurred, posted. Actual overhead cost, actual factory overhead cost incurred. Actual admin overhead cost incurred. Actual selling and distribution overhead cost incurred, posted. And very, very important. Suppose this is the trading and profit and loss account. Actual material cost incurred, actual wage cost incurred, actual direct expenses incurred, actual factory overheads incurred, actual admin overheads incurred, actual selling and distribution overheads incurred. Only actual information posted. And here important, pure financial expenses, non-cost related expenses also recorded in financial books. Pure financial expenses, non-cost related expenses are appearing only in financial books, not in cost books. Pure financial expenses, give some examples. Checker. Bad debts, reserve for bad debts, cash discount allowed to customers, preliminary expenses, rate of interest on long-term deposits, interest on long-term loans. Interest on deposits means that is a non-operating income. So this is non-operating expenses. So pure financial expenses, bad debts, reserve for bad debts, cash discount allowed to customers. Next, any expenditure incurred in connection with raising the capital, preliminary expenses write-off, preliminary expenses written off. Next, interest on capital, interest on loans, interest on loans. These are the examples of pure financial expenses. Next, non-cost related expenses means loss on sale of fixed assets, loss on sale of investments. Next, write-off intangible fixed assets, write-off intangible fixed assets, write-off intangible fixed assets. Next, direct taxes like income tax, provision for income tax, provision for income tax. So these are the posted. These items are appearing, these items are appearing, these items are appearing only in financial books. Credit side, by sales, by closing stock, by closing stock, by closing stock. Closing stock means closing stock of work in progress, closing stock of finished goods, finished, sir, closing stock of raw material, sir, here mentioned direct material consumed, direct material, that means opening stock of raw material, no need to write, purchase of raw material, no need to write, closing stock of raw material, no need to write. So these three summation, adjustment, opening plus purchase minus closing, nothing but direct material consumed. So in closing stock appearing only elements, closing stock of work in progress, closing stock of finished goods. Next, non-operating incomes, non-operating incomes. So interest credited on bank fixed deposits, interest credited on share transfer fees. Next, dividend received on other company shares, interest received on other company debentures. Those are the examples of non-operating incomes. Non-operating incomes, very, very important. These incomes are appearing only in, not in cost books. Now find out the profit or loss. Suppose net profit as per financial records. Net profit as per. Next, open the cost records. Open the cost records. So, same cost sheet pattern. First, material control account. Next, wage control account. Next, direct expense control account. Next, factory overhead control account. Next, work in progress control account. Work in progress control account. Next, admin overhead control account. Next, finished stock control account. Finished stock control account. Next, cost of sales account. Here, selling and distribution overhead control account. Next, cost of sales account. Next, sales account. Next, costing P&L account. Costing. So, prepare these accounts. Costing P&L account mention some profit. Net profit as per cost records. Net profit as per cost records. So, here some amount mentioned. So, one thing is observed. Net profit as per cost records didn't agree with net profit as per financial records. Net profit as per cost records didn't agree with net profit as per financial records. Why? Reasons, 5 reasons, sir. 5 reasons. Check there, one reason. Pure financial expenses, non-cost related expenses and non-operating incomes are appearing only in financial books, not in cost books. That's why cost books profits increased. Cost books profits, sir, here separately discuss, sir. First one, cost records profits, financial records. Listen. Financial records. Pure financial expenses, non-cost related expenses. These expenses are appearing only in financial books, not in cost books. Automatic cost records profits overstated, that is increase, overstated. Financial records profits understated. Suppose in the reconciliation statement, if you start with the cost records, so this element overstated, simply deduct. Suppose if you start with the financial records, that is understated, simply add. Understated, add. Overstated, deduct. That is the treatment in reconciliation statement. Next, non-operating incomes. Non-operating incomes, sir. Non-operating incomes means credits. These credits are appearing only in financial records, not in. Automatically, incomes not recorded, cost records profits understated. Treatment, add them, add back. So this is this understated? This is overstated. Suppose if you start with the financial records, treatment less. Clear? Next. So first point completed. Rakesh, next one. Next reason, under or over absorbed overheads. Sit down. Suppose factory overheads charged in cost books, that means cost sheet 1 lakh, but actually incurred 1,20,000. Actually incurred 1,20,000. So in cost records 1,20,000. Sorry, in financial records 1,20,000. In cost record charge amount is only 1 lakh. So that means factory overheads under charge in cost records. Factory overheads. So overheads under charge in cost records. Overheads under charge in cost records. Overheads means debit element or credit element. Debit element. This is expenses. So income statement debit side element. Debit side element under charge. Debit side element under charge, automatically profits increase, overstated. Profits overstated. So overheads under charge in cost records. That means overheads overcharge in financial records. Am I right? Undercharge in cost records means overcharge in financial records. Debit side overcharge means profits understated. Profits understated. So like that overcharge. Okay, next. Two reasons completed. One is pure financial expenses, non-cost related expenses are appearing only in financial books, not in cost books. Next, non-operating incomes are appearing only in financial books, not in cost books. So first 1A, 1B completed. Next, due to under or over absorption of overheads completed. Next one. Method of inventory valuation. Method of inventory valuation. Cost accountant follows FIFO method. Financial accountant follows weighted average method. In that case, method of inventory valuation differed. So definitely profits affected. Definitely profits affected. For example, in cost books, opening stock overvalued. In cost books, that is opening stock overvalued in cost books. Sir, is it debit element or credit element opening stock? Debit side element. Debit side element overvalued in cost books. Debit side overvalued, profits declined. Am I right? So this is understated. Here overstated. Understated treatments are add. Overstated treatments are less. Suppose if you start with the financial books, less. If you start with the cost books, add. Here. Next, closing stock. Closing stock overvalued in cost books. In cost books. Closing stock debit element or credit side element? Credit side element. So credit side element is overvalued. Profits increase. So that is overstated. Overstated. Here understated. Understated. So 3 points completed. So third point is method of inventory valuation. Method of inventory valuation. Next, fourth point, method of depreciation. Method of depreciation. Method of depreciation, sir. So suppose in cost books, straight line method, cost accountant follows straight line method. Financial accountant follows written down value method. In that case, in cost books, depreciation overcharge. Depreciation is depreciation overcharge in cost books. In cost books. Depreciation overcharge in cost books. Depreciation debit side element or credit side element? Debit side element. Debit side means expenses, sir. Expenses overcharge. So debit side overcharge cost books profits understated. This is overstated. Overstated. So 4 points completed, sir. Method of depreciation, method of inventory valuation. Next, under or over absorbed overheads. Under or next, non-operating incomes are appearing only in financial books, not in cost books. Pure financial expenses under non-cost related expenses are appearing only in financial books, not in cost. Last one. Last one, sir. Notional expenses. Notional expenses or notional items. are appearing only in cost books. So in cost books, expenses charged as per industry norms. But in financial books, actual amounts charged to financial books. Am I right? So notional expenses means here there is no cash outflow, but artificially created. There is no cash outflow. In reality, no cash outflow, but it is artificially created. For example, rent paid on own factory premises. Rent paid on own factory premises. That means here no cash outflow, just created. Rent paid on own factory premises. Rent paid on own factory premises. This is the notional expenses. This element is recorded only in cost books, not in financial books. Not in financial books. Reason? There is no payment. In reality, there is no payment. So, financial accountant not recorded this transaction, but cost accountant recorded. Reason? As per industry norms, all companies charged rent on factory premises. But in our company, there is no rent on factory premises because own premises. But as per industry rule, charged. As per industry rule, charged. So artificially created. That is the notional item. So notional expenses are appearing only in cost books. Notional expenses are appearing only in cost books, not in financial books. Notional expenses are appearing only in cost books. Automatically cost books profits understated. This is overstated. So this theory question very important. So what are the reasons for the disagreement of cost records profits and financial records profits? So these 5 points very important. Now take the problem. CRD 1, sir. CRD 1. Listen. Listen. So R Limited sir, R Limited showed a net loss of 35,400 as per their cost accounts. Good news, no need to prepare cost records. Reason, cost records discloses a net loss of 35,400 directly mentioned in the problem. However, financial accounts disclosed a net profit of 67,800. So no need to prepare trading and profit and loss account as per financial books. Reason, financial books disclosed a net profit of 67,800 directly given. The following information were revealed as a result of scrutiny of the figures, cost accounts and financial accounts. These points are as follows. So here clearly mentioned, prepare reconciliation statement by taking costing net loss as base. That means questionnaire clearly mentioned, please start with cost books. Suppose there is no information. Suppose there is no information. Don't worry. Start with the cost books. Start with the cost books. Sometimes specifically mentioned by taking net profit as per financial accounts as base. Then start with the financial books. Start with the financial books. So, if questionnaire specifically mentioned, start with that books. Suppose there is no specific information, start with the cost books. Start with the, but here clearly mentioned by taking costing net loss as base. By costing net loss as base. So net loss as per cost records. Net loss as per cost records, how much, sir? 35,000. 35,400. So net loss indicates minus, that is simply put up the brackets. So that indicates minus value. That indicates minus value. Next, add. Next, less. So please follow the theory question. So as per theory question, first check the pure financial expenses and non-cost related expenses. Check it. Goodwill written off, pure financial expenses. Next, provision for doubtful debts, pure financial expenses. Next, income tax provided, non-cost related expenses. Loss due to obsolescence, non-cost related expenses. Am I right? So finally, EF, J, I. 4 elements. Pure financial expenses, non-cost related expenses. These expenses are recorded only in financial books, not in cost books. Automatically cost books profits overstated. Cost books profits overstated. So cost books profits overstated, treatment less. Treatment less. First one. Goodwill written off. Amount 25. Next, provision for doubtful debts. Provision for doubtful debts. 15. Next, loss due to obsolescence. Loss due to obsolescence. 16. Next, income tax provided. 43,000. 1 year completed. 1 year completed, sir. Next, 1B. Non-operating incomes. So this is interest credited on fixed deposits. Next, dividend received. 2 items. Only 2 items. Non-operating incomes. These incomes are recorded only in financial books, not in automatically cost books profits declined. That means understated. So treatment, add. Dividend received amount 20. So interest credited on bank fixed deposits 13,000. So successfully 1A, 1B completed, sir. 1A, 1B completed. Next, under or over absorbed overheads. So here clearly mentioned scrutiny already completed, sir. So directly sentences provided. Factory overheads, over record means overcharge. Sir, in which book, sir? Recovered means in cost books. In cost books. So factory overheads, expenses overcharge in cost books. So that means expenses overcharge, debit side overcharge, profits understated. So understated means add factory overheads, overcharge amount 1,35,000. So expenses overcharge in cost books. Expenses overcharge means profits declined. So profit declined, add back. Next administrative overheads. Administrative overheads, so this is also debit side element. So expenses undercharge. Expenses undercharge. In which books? In cost books. Expenses undercharge in cost books. Cost books profits overstated. Overstated. Treatment less. Amount 25,000. 25,500. 25,500. Sir, 2 points completed, sir. Next, method of inventory valuation. Your method of inventory valuation, sir. Opening stock, debit element. Opening stock, please observe cost books amount to financial books amount to. So cost books amount 1,65,000. So clearly mention cost books amount overvalued or undervalued. Overvalued how much? 20. So debit side overvalued in cost books, profits declined. Profits declined. Add. So opening stock overvalued. How much? 20,000. Next, closing stock. So your closing stock cost accounts 1,25,000, financial accounts 1,32,000. So closing stock undervalued or overvalued? In cost accounts, presently base element is cost books. So please question on cost books. In cost books, closing stock overvalued or undervalued? Undervalued. So closing stock credit side element or debit side element? Credit side element undervalued in cost books, automatically profits decline. So decline means add. So closing stock undervalued. How much? So successfully 3 elements completed. Next, 4th element. Method of depreciation. Here depreciation already scrutiny completed, sir. Scrutiny completed, sir, directly given. Depreciation undercharge in cost accounts. Depreciation expenses or income? Expenses undercharge in cost books, profits overstated. Overstated means treatment less. Depreciation undercharge 20. Sir, 4 elements completed, sir. Last and final, sir, notional elements. Here available information. Sir, notional rent of own premises charged in only in cost. Expenses appearing only in cost accounts. Cost accounts profits decline. Decline means understated. Understated means treatment add. Notional rent. How much? 60. Add them. 2,55,000. 2,55,100 minus 35,400. 2,19,000. 19,700. Next, 51,000. 67,000. This is the net profit as per financial records. Financial records. Clear? Correct. Sometimes Question is asking not statement, prepare account. Prepare account. So statement expressed in T shape, that is called as account, that is memorandum reconciliation account. Memorandum reconciliation account means statement can be expressed in T shape format, is called as memorandum reconciliation account. Memorandum reconciliation account. Memorandum reconciliation account. First, how to show the balances. Simple. Here 4 models. Both books shows profits. Both books shows losses. One cost books profits, financial books losses. Cost books losses or financial books 4 models. For example, both books shows profits. Profits means credit balance. Profits means, in that case, by net profit as per cost books. As per cost books. To net profit as per financial books. So both books shows profits. In that case, how to show that? So profits means credit balance. Opening credit balance, by balance brought down. Closing credit balance to balance carried on. Next, add items always shown on credit side. Less items always shown on debit side. So less items add with to and preposition. Add items with by preposition. Next, memorandum reconciliation account. Memorandum reconciliation account. Suppose both books shows losses. Losses means debit balances. Opening debit balance to net loss. Net loss as per cost books. Net loss as per cost books. By net loss as per financial books. Add items always shown on credit side. Less items always shown on debit side. Next, last, memorandum reconciliation account. Memorandum reconciliation account. Memorandum reconciliation account. Now, cost books shows net loss. Financial book shows net profit. So, cost book shows net loss. Net loss means debit balance. So, to net loss as per cost books. Next, financial book shows net profit. Net profit means credit balance. Closing credit balance or opening credit balance, closing. Closing credit balance means to net profit as per financial books. So present problem same, like net loss 35,000, 35,400. Next, add items shown on credit side. Here add items totals at 2 lakhs, 2,55,000, 2,55,100. Less items always shown on debit side. Less items value 1,51,000, 1,51,900, 1,51,900. So here 2,55,100, 2,55,100. Balance amount 67,800. That is the net profit as per financial books. Net profit as per financial. So like this. So next problem, CRD2. Okay, only one problem. Right. So last technique, sir. Listen. budget and budgetary control. Right, listen. So this is the last technique, budget and budgetary control. Already standard costing technique completed, marginal costing technique completed, absorption costing technique completed. Next, budget and budgetary control. In this technique, classification of expenses, variability basis. In this technique, classification of expenses. So same principles like marginal costing. Classification of expenses, variability basis. Variability basis means variable expenses, fixed expenses, semi-variable expenses. In this case, calculate profit. Same pattern. Sales less variable cost. You get contribution less fixed cost. Profit. Most of the others budgets can be classified into 4 types, sir. One is capacity budgets. Capacity budgets. Second one is functional budgets. Third one is master budget. Next one is periodical budgets. Examination point of view, only these 2 are very, very important. Capacity budgets, functional budgets. In capacity budget, 2 types are flexible budgets, fixed budgets. Nowadays, fixed budgets nil. It gives meaningless comparison. When it is suitable, sir, throughout the period, demand conditions uniform. Throughout the period, demand conditions uniform. In that case, fixed budgets gives good result. But nowadays, demand conditions day by day changes. So, fixed budgets no need to prepare. Only prepare flexible budgets. Flexible budgets. Next, functional budgets. Next, functional budgets. So, functional budgets, each department head prepared some functional budget. For example, material department prepare material purchase budget, material consumption budget, material purchase budget, material consumption budget. Sales department prepare sales budget, sales budget. Production department, production manager prepares production budget in quantity, production budget in rupees. Okay. HR department prepare labor budget, that is the wage cost budget in hours and wage cost budget in rupees. So, functional budgets very, very important. All functional budgets collectively prepare one budget, that is called master budget. So, master budget, how to prepare? Collectively, functional budgets collectively and prepare one statement, that is called master budget. So, we can prepare with the functional budgets, that is called as master budget. So, periodical budgets no need, sir. So, examination point of view, flexible budgets, functional budgets important. Functional budgets important, right? Flexible budget. Flexible budget. Listen. For the preparation of flexible budget, 2 rules very, very important. One is, in variable nature, per unit is always constant. In fixed nature, total remains constant. These 2 rules Keep in mind. In variable nature, per unit constant. In fixed nature, for example, variable cost per unit at 10% capacity 2 rupees. At 20% capacity also 2 rupees. At 30% capacity also 2 rupees. At 100% capacity also 2 rupees. In fixed nature, total remains constant. For example, at 10% capacity level, fixed cost amount to 1 lakh. At 50% capacity level, 1 lakh. At 100% capacity level, 1 lakh. So in fixed nature, total remains constant up to 100% activity level. These are the characteristics of fixed cost, characteristics of variable cost. That's all. So while preparing the flexible budgets, these characteristics very important. Variable nature characteristics per unit always constant. Per unit remains constant at any level of capacity. Per unit remains constant at any level of capacity. In fixed nature, total remains constant. These two very important. In case for the coming period, fixed expenses will go up by 10%. In that case, that 10% injection given to total amounts, that 10% injection given to, for suppose variable elements will go up by 5%, that 5% injection given to per unit. So first characteristics, variable nature, per unit remains constant at any level of capacity. In case in coming period, variable expenses will go up by 5%. That 5% injection given to per unit. Injection given to, not total amount, madam, per unit. In fixed nature, total remains constant up to 100% activity level. In case for the coming period, fixed expenses will go up by 20%. That 20% injection given to total amount. Plus, flexible budget is completed. Just 2 rules important. Now take this problem. Listen. So here problem number 1, sir, CRD1. CRD1. ABC Limited is currently operating at 75% of its capacity. So present operating capacity 75%. In the past 2 years, the level of operations were 55% and 65% respectively. Correct? So presently the production is 75,000. So one thing is clear, at 75% capacity, volume equal to 75,000 units. So capacity can be expressed either in percentage or in units. Capacity expressed in percentage or in units. So 75% capacity, 75,000 units. 65% capacity, 55% capacity, 55,000 units. 55,000 units. Next, the level of operations for 55 and 65 respectively. Presently, the production is 75,000. Next, the company is planning for 85% capacity level during the year 13-14. So for the coming period, company operating capacity 85%. 85%. Now, the cost details are as follows. Direct material cost. Sir, direct material, is it variable or fixed? Variable. So please check it. 11 lakhs divided by 55,000. 20. 13 lakhs divided by 65,000. 15 lakhs divided by 75,000. That means per unit is same for all capacity levels. That indicates variable. Per unit is same for all capacity levels. That indicates variable cost. For example, total remains constant for all capacity levels. That indicates both are dancing, semi-variable. Per unit same for all capacity levels, variable. Per unit is same for all capacity levels, indicates variable. Total remains same for all capacity levels, both are varying, Per unit varying, total also varying. That indicates semi-variable. Semi. So, in case semi-variable expenses, first find out the variable part and next find out the fixed part. Next, direct labor. So, 5,50,000 divided by 55,000. 10 rupees per unit. 6,50,000 divided by 65,000. Next, 10 rupees. So, this is variable. This is variable. So, in variable nature, per unit remains constant at any level of capacity. Next, factory overheads. Sir, please check 3,10,000 divided by 55,000. 5.64. Next, 5.0. So, here per unit varies. Per unit varies, total varies. Therefore, this is semi. Now, listen. Factory overheads. In semi-variable, certain portion fixed, remaining portion variable. Am I right? Now, calculate the variable factory overhead rate per unit. Check the formula. Change in factory overhead divided by change in activity level in units. Am I right? So, change in, you can select any two, either 55-65 or 65-75 or 75-55. Your option. 1 and 2, sir. 55-65. 3,10,000, 3,30,000 difference. 20,000 divided by 10,000 units. 2 rupees. 2 rupees per unit. Correct? 2 rupees per unit. Now, total fixed overhead cost amount. Total fixed factory overhead cost. Fixed factory overhead cost. Total overhead cost minus variable factory overhead cost. Select one level. Suppose select 55,000 units. At 55,000 units, total amount, sir, 3 lakhs minus 55,000 units into 2. So, final answer 2 lakhs. Next one. Selling overhead, sir. So, selling overhead, so 3,20,000 divided by 55,000. Next, 3,60,000 divided by 65. So, vary, per unit vary, total vary. So, this is also semi-variable. Selling overhead cost. Selling overhead cost. So, variable selling overhead rate. Variable selling overhead rate per unit. Variable selling overhead rate per unit. Change in selling overhead cost. 40,000 divided by 10,000 units. 4 rupees per unit. That is variable selling overhead cost. Fixed selling overhead cost equal to. Fixed selling overhead cost equal to total selling overhead cost at 55,000 units. 3 lakhs minus 4 into 55,000. 3,20,000 minus 2,20,000. 1 lakh. Completed. So that is the fixed selling overhead cost. Fixed selling overhead cost. Next. Sir, see the administrative overheads. Administrative overheads total remains constant. Total remains constant. 1,60,000, 1,60,000, 1,60,000. So this is fixed. So two variable elements, one fixed element, two semi-variable elements. In case semi-variable elements, calculate variable part and fixed part. Now, profit is estimated at the rate of 20% on sales. Here rate of profit given, sir. Rate of profit is 20% on sales. So here selling price per unit not mentioned. Rate of profit is given. Cost details are given. So cost details are given. Variable cost details given. Fixed cost details given. Semi-variable. So semi-variable already calculated. Variable part, fixed part. So add them, we'll get total cost. We'll get to. So here rate of profit on sales, then converted into on sales, on cost 20 by 80 on cost. 20 by 80 on cost. Next. Next. The following increase in costs are expected during the year. Sir, for the coming period, variable elements will go up by, this is variable element, this is variable, variable, variable. So variable elements will go up by, sir, material cost will go up by 8%, labor cost will go up by, factory overheads will go up, variable factory overheads will go up by, variable selling overheads will go up by. So injections, 8% injection given to per unit. In variable nature, injections given to. In fixed nature, injections given to. Total. That is the main point. Next, prepare flexible budget for the period 2021. Sir, here printing mistake. 2013. 2014. Flexible budget. At 85% level of capacity. At 85% level of capacity, volume of output equal to 85,000 units. Also ascertain the profit. Also ascertain the variable cost elements noted. Fixed cost elements noted. Then we'll get to total cost. Then we'll get to total cost. Total cost, add profit. Add profit. Here profit equal to 20 by 80 on cost. Total cost readily available into 20 by 80. We'll get profit. So profit plus total cost equal to sales. Profit plus total cost equal to sales. Then, sir, question is asking contribution. Sales minus variable cost equal to contribution. For example, sales amount directly given or selling price per unit mentioned in the problem. In that case, start with sales less variable cost, contribution plus fixed cost, profit. But in this problem, there is no information about the price structure. About the price structure means selling price per unit. In case price structure is available in the problem, then 85,000 units into selling price per unit sales amount less variable cost will get contribution, less fixed cost will get profit. But here there is no information about the price structure. In that case, start with variable cost and fixed cost will get total cost. Add profit will get sales. Again, sales minus variable cost equal to contribution. Okay, right. So now flexible budget for the period 13-14. Flexible budget. Flexible budget for the period 2013-14. 2013-14. Listen. Particulars. Working notes. Working notes. Next. 85% capacity level, that is 85,000 units per unit amount. Per unit amount. Sir, variable expenses. One by one. Variable expenses, sir. Direct material cost. Direct material cost at the rate of 20 rupees. That is old rate. But clearly mentioned, the following increase in costs are expected during the year. So 20 into 108%. 20 into 108% equal to 21.6. Wait, next, direct material cost complete. Next, direct labor cost. So old rate 10 into 105%. 10.5. Next, variable factory overhead cost. Variable factory overhead cost. So here variable factory overhead cost 2 rupees, sir. For the coming period will go up by 5%, 105%. 2.1. Next. So here variable admin nil, sir. Variable selling overhead. Variable selling overhead cost. Variable selling overhead cost. 4 into 108%. 4.32. Now, total, sir, main presentation important, sir. Total variable costs 38.52, right? Now multiply with each 185,000 units. 18 lakhs. 8 lakhs. Next, 1 lakh. Next, 32 lakhs 70. This is A. This is A. So variable expenses complete. Next, fixed expenses. Fixed expenses. Fixed expenses. Fixed expenses. Fixed factory overheads. Fixed factory overheads. Sir, in fixed nature, injections given to total amount, sir. So yet total amount to 2 lakhs will go up by, so 110% of 2 lakhs. 2 lakhs. Next, fixed admin overhead cost. So fixed admin directly given 1,60,000 will go up by 110% of 1,60,000. 1,76,000. Next, fixed selling and distribution overhead cost. So already calculated, sir. 1 lakh. He will go up by 115% of 1 lakh. 1 lakh 15,000. Okay. So total fixed cost 5 lakhs 1. This is B. So A plus B equal to total cost. A plus B equal to total cost. 5 lakhs 11,000 plus 32 lakhs 74,200. 37 lakhs. Correct? Huh? Next, here rate of profit is given, sir, but on sales given. Then immediately convert into on cost. Rate by 100 on sales, rate by 100 minus rate on cost. Correct? Huh? So 20% on sales, 20 by 100 on sales, then 20 by 80 on cost. 20 by 80 on cost. 300 sales 47 lakhs. This is the sales. Now question is asking contribution, sir. Contribution. So less variable cost. Sir, contribution formula sales minus variable cost or fixed cost plus profit. Here sales readily available, simply deduct variable cost. Here variable cost equal to 32 lakhs 74,000. So finally 14 lakhs. This is the contribution. So next segment to functional budgets. So in functional budgets, order is important. First order 1, sales. Budgeted sales. First one is budgeted sales. Next, budget sales readily available, then calculate budgeted production. Then calculate budgeted production. Calculate budgeted production. Here production in units or in rupees. In units and or in rupees. Next, budget production readily available, then calculate raw material consumption budget. Raw material consumption budget in quantity. Raw material consumption budget in quantity. Next, order raw material purchase budget. Raw material purchase budget in quantity and in value. And in value. Sometimes information given in the question paper, prepare raw material purchase budget in quantity and in value. Then student start with sales. Sales budget. Next production budget. Next raw material consumption budget. Next raw material purchase. Sometimes budget sales directly available. Then immediately adjust the inventory levels. Inventory levels. So sales in budget sales in quantity plus closing stock in quantity minus opening stock in quantity will get the production quantity. Will get the production quantity. So sometimes budget sales not given in the problem. Then you should calculate. In that case, desired profit is given. In that case, desired profit is given. If desired profit is given, then budget sales quantity equal to, F plus P by contribution per unit. So if desired profit is given, then budget sales quantity equal to F plus P by contribution per unit. In some other cases, cost of sales provided and variable cost of sale also provided. In that case, budget sales quantity equal to cost of sales amount divided by variable cost of sale. Variable, nothing but this is variable cost of sale, sir. Variable cost of sale divided by variable cost of sale per unit. Automatically, we will get budget sales quantity. Generally, desired profit is given. In case desired profit is given, calculate budget sales quantity F plus P by contribution per unit. Sales quantity ready, then adjust the inventory levels. So, budgeted production in quantity equal to budgeted sales in quantity. Adjust the inventory levels. So this is the sales bottom figure. In reverse mode direction, closing should be added, opening should be deducted. So here add closing stock of finished goods, madam. Closing stock of finished goods in quantity minus opening stock of finished goods in quantity. Then production budget ready. Sometimes calculate production budget in rupees. Simple. Production budget in units into production cost per unit. Sir, how to calculate production cost per unit, sir? Direct material cost per unit, direct wage cost per unit, direct expenses cost per unit, total factory overhead cost per unit. Add them, we get them. Production cost per unit. Production cost per unit into production units, you will get production budget in rupees. So, next order, sir. Budget sales, okay. Budget production, okay. Next, raw material consumption budget. So, raw material consumption budget, sir. Raw material consumption budget. Most of the students says, sir, raw material consumption easy, sir. Raw material purchase plus opening inventory of raw material minus closing inventory of raw material. But raw material purchase value not available, sir. Here raw material purchase next order, sir. Purchase raw material purchase is not available, sir. Then how to calculate? Simple. Production in units into raw material required for 1 unit. Raw material required for 1 unit. So then raw material consumption budget ready. Raw material consumption budget in quantity ready. Next, raw material purchase budget. Raw material purchase budget ready. Raw material purchase budget, this is the last one. Raw material purchase budget equal to in quantity equal to. Now, raw material consumption, reverse mode direction, closing should be added. Opening should be, so closing stock of raw material should be added. Closing stock of raw material should be added. Closing stock of raw material in quantity minus opening stock of raw material in quantity. Opening stock of raw material in quantity. So finally raw material purchase budget in quantity completed. But question is asking raw material purchase budget in quantity and also in rupees. So raw material purchase budget in rupees. Raw material purchase budget in rupees. How to calculate in rupees? Simple. Raw material purchase budget in quantity into unit price of raw material. Into. So raw material purchase budget. Raw material purchase budget in quantity into unit price of raw material. Unit price of raw. So this is the procedure. So in the examination, data provided, prepare raw material purchase budget in quantity and in value. Start with sales budget. Start with sometimes budget sales quantity readily available. No need to prepare the sales budget. Start with production budget. Start with production budget. How to prepare production budget? Sales in quantity plus closing stock of finished goods in quantity minus opening stock of finished goods in quantity will get production budget in quantity. Next, after preparation of production budget, what next? Raw material consumption budget. Raw material consumption budget, how to calculate? Don't say purchase plus opening minus closing. Here purchase not available. So here production in units into raw material required per unit. Raw material required per. Okay. Raw material consumption budget. Okay. Next, raw material purchase budget. Purchase budget equal to raw material consumption plus closing stock of raw material minus opening stock of raw material. Last one, rupees. Rupees raw material purchase budget in quantity into unit price of raw material. So last one, sometimes questioner is asking prepare wage budget in hours, wage budget in rupees, wage budget in hours and wage budget in rupees. In that case, same, start with first sales budget. Sales budget. Next production budget. Sales budget in quantity. Next, production budget in quantity. Production budget in quantity. Production budget in quantity. Next, wage budget. Wage budget in hours. Next, wage budget in rupees. Wage budget in rupees. First, prepare the sales budget. Next, production budget. Next, wage budget. Next, wage budget in rupees. So here clearly mentioned sales budget already. No, I know. Suppose desired profit is given, then F plus P by contribution per unit, or sometimes variable cost of sale amount readily available, variable cost of sale per unit readily available. Then easily calculate the volume. Variable cost of sale amount divided by variable cost of sale per unit will get the sales volume. So budget sales volume. Okay. Next, production budget. Production budget means sales in quantity plus closing stock of finished goods minus opening stock of finished goods. Production ready. Now wage budget in hours. Wage budget in hours. Wage budget in hours is equal to production in units into production in units into standard time required for 1 unit. Standard time. Standard time required for 1. Standard time required for 1 unit. That is also given in the problem. So wage budget ready. Next, wage budget in rupees. Wage budget in rupees. Simple. Wage budget in hours into wage budget in hours into R. R means hourly wage rate. R hourly wage rate, sir. That is the rate per hour, sir. Wage rate per hour. So this is the functional budgets. So these two very important for examination point of view. Okay. Thank you. Wish all the best.